T-minus 90 seconds and counting. All systems are go. We're about 90 seconds from the launch of Space Shuttle Discovery. T-minus 60 seconds and counting. We are transferring to orbiter internal power at this time. Discovery is now running off its 3 onboard fuel cells. Coming up on a go for auto sequence start. And we have a go for auto sequence start. Discovery's onboard computers have primary control of all the vehicle's critical functions. T-minus 17 seconds and counting. 15, 12, 11, 10, 9, 8, 7, 6, 5, start, 2, 1, boost ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
Separation confirmed. Guidance now converging. Discovery's onboard computers commanding the main engine nozzles to swivel, aiming the shuttle for its precise target in space for main engine cutoff.
You have a good forward link now in SM.
Okay, you sound good.
Discovery Houston, negative return.
Copy, a negative return.
From my brain, oh no, oh, oh, oh. Good morning, you filthy apes. Welcome to AMC and ADD, where we buy, we hold, and we screw the hedgies. Screw them! Oh man, I gotta show this to you guys. I gotta just show this. And Brian, I was tickled pink. Tickled pink, I think, is probably the best way I could possibly describe how I felt when I saw this picture. Let me copy and paste it here real quick. Let's see here. This I enjoyed. I enjoyed very much, and I'm considering making a an intro that's going to change or I don't know. I'm at a loss for words. That's going to be stemming around this whole. Brian drew this. Brian Carpenter drew this, guys. So it's got Butthead and Beavis and Butthead on here, and Beavis is over here all yeah yeah, and then Butthead saying cool, and I'm over here going 2 weeks. This made me laugh so much. It's got the AMC logo shirt on with the KC hat. Oh man, I couldn't get enough. I almost wanted to say that you put a 69 over here, but didn't. It was almost like you were like, just you like you're trying to make it look like that, but not really. It was maybe it was far reaching of me to see that. I don't know. It was still funny to me. I was laughing. I laughed my head off for a while. Man, I love it. I think that's so awesome. That's gonna get framed somewhere in my house. We we talked about it last night. We've got a wall of pictures from movies and stuff like that, specifically Marvel movies. And then on this other wall we have some family pictures. We got the Joker. Actually, we have two pictures of the Joker, but we have one picture of two different actors who are playing the Joker, which I think I've shared before on the channel that somebody drew. I think she lives in India. She drew on Reddit live, and I purchased it from her. I love it. I think it's the most coolest picture ever because it's the last two people who played Joker and Heath Ledger and I'll never remember this guy, the latest one's name, but Hakeem, whatever. You know who I'm talking about. It's got the both of them in there, and it's just the coolest picture ever. And then we've got another picture of I can't think of her name. I'm not at a loss for names. Anyways, Harley Quinn and Harley Quinn over there, and she's like looking over at the two different Jokers, and it's like I think it looks cool. My wife doesn't really like it, but anyways, this picture is gonna have to go up there somewhere, somewhere, somewhere on that wall. This picture is gonna have to go up there. I love it. I think this is so cool. I love it. I don't know what to say. Thank you. That's what I need to say. Thank you. Made me happy. Moving on though, there is some news, some breaking news from yesterday that I saw. Posted those up on the Discord, but I'll share them here as well. I told you guys, I said, one of the signs that this is starting to be over is going to be, people walking out with their boxes in their hand. And JP Morgan lays off hundreds of employees in mortgage division. Is the article that I'm in referencing here. Let me pull it up for you guys. Hundreds of employees in mortgage division as rates spike. So these rates are really kind of eating them alive. JP Morgan Chase is laying off employees this week in response to the spike in mortgage rates that has rocked the housing market. Our staffing decision this week was a result of cyclical changes in the mortgage market, JP Morgan said in a statement. Hundreds of JP Morgan employees will be laid off, while hundreds of others will be reassigned, a person familiar with the matter told CNN Business. News of the layoffs was first reported by Bloomberg News. We were able to proactively move many impacted employees to new roles within the firm and are working to help the remaining affected employees find new employment with Chase and externally, JP Morgan said in a statement. This isn't the end, guys. I mean, this is the beginning. These are the kind of things that we need to start seeing within institutions, and that includes banks. That's going to tell us that we're getting close. These are the first signs. When the institutions have to start laying off people is some of the first signs that you're going to see. There was another follow-up article, which may be locked behind the Bloomberg paywall. Let's see what we got here. Big banks led by JP Morgan set to return 80 billion to investors. Fed's stress test will determine size of buybacks, dividends. COVID halted buybacks in 2020, inflating last year's capital. Of course, it's paywalled. I'll read what I can. U.S. banking giants are poised to return 80 billion to shareholders after this year's Federal Reserve stress test. Less than last year's elevated level that followed a pandemic-driven buyback pause. JP Morgan Chase and Company is set to lead the group with 18.9 billion in combined dividends and share buybacks, even as the biggest U.S. lender spends more this year to build out offerings and fend off competition. Bank of America, which is one of the ones that I thought would be the first ones to fail, and Wells Fargo Company are expected to return 15.5 billion and 15.3 billion, respectively, according to data, and I can't read the rest. I can't read the rest. There's another line here, but I can't. Wait a minute. No. Based on compiled by the Bloomberg, based on estimates provided by analysts at Barclays. I can never say that. Barclays. Barclays. Is it Barclays or Barclays? It's Barclays, I think. I can't read it. Anyways, big stuff going on here. Stuff starts rolling downhill when the banks start going down. I think those are some pretty big news pieces. Sorry about the delay on starting out this morning, guys. Kind of an interesting technical difficulty. It is Barclay. I thought it was Barclays, but I don't know. I've heard it pronounced different ways. But interesting thing happened to me this morning. I woke up and Webull was logged out. Never happens. Never, 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 never. Good morning, Menji. Manjeet, I've been saying Manjeet's name wrong for a long time. It's actually Manjit. Manjit. It's like a hard I. It's like an I. She forgives me. She never even says anything, even though I get it wrong all the time. She's so kind. So I got logged out of Webull. It was really, really strange. Never, ever, ever logged out of Webull. I wake up this morning and I'm completely logged out. Normally, they'll just log me out of the trading function, and it's just a quick, easy password that I put in. It's like a 4 or 5 digit code, but they completely logged me out. And so when I went to go log back in, of course, I don't remember what my password was. This is an important lesson. This is a very important lesson to all of us. Do not know what your passwords are when it comes time to have MOASS, because I can almost guarantee you every single one of our banking institutions will permanently log us out and force us to remember our passwords. Have those written down somewhere, guys. Please. I have all of them in my phone, but I really need to have a second source place where I can find those passwords quickly. So please make sure you have your passwords ready to go someplace. It is a very important learning lesson for me this morning, because I had to kind of finagle my way into logging back into. It wasn't as easy as just hitting forgot my password, because they wanted me to go through my banking institution to verify I was who I was online, but I was able to bypass that by going through my phone and change. Since my phone was still logged in, I was able to just change the password straight from a logged in version, which didn't require me to use my banking institution to do all that crap. So luckily, I was able to bypass all that, but it took me, 10 or 12 minutes late today to get that done. But it is that time of the morning. It's time. It's actually beyond that time of the morning to start taking a look at our numbers. So I'll start beating around the bush here. Yishin says that they let go of seasonal temp workers. Seasonal? That sounds more like I don't know. Hundreds is seasonal? Well, maybe. All right. We'll go with it. We'll go with it, Yishin, and say that it's not big news. That's fine. I'm not. I'm not really considering one institution laying off a couple hundred employees as the end. So I'm okay with it just being, that's fine. We do. I definitely would agree that we need to see much bigger news than that. And your friend at JP Morgan told you? Yeah, that's cool. We don't need it to be MOASS. All right, the glasses are clean. We can start heading through the numbers here and taking a look at everything. I read, and I'm not certain of this, but I read that the stress tests were actually already completed and that the results of the stress tests were being released today. I don't know if that's the case or not. I do know that the Fed is speaking again. Mr. Asset Bubbles himself is talking tonight. Oh, I did post something on Twitter. One more thing I wanted to say. Oh man. So we all heard about Gasparino. I got another one. I'm calling them Gassy and Assy. those are the two nicknames I'm giving them, Gassy and Assy. And I put this. This is the what in the world? Why does this say promote? I don't know what that means. All right, let's take a look at this real quick here. I put, in my humble opinion, Gassy saying he didn't say we couldn't hit 1K, and now Assy begging us to do our worst means they're desperate for options plays. Don't step in those cow patties. Apes no. I'm telling you right now, guys, I really do think, Gassy suddenly coming out and being in support of us being able to hit a 1K number, and then Assy starting to say, what's the, do the worst you can possibly do to me. Why would they say that? They don't say what it is that they want to say. They tell you the opposite of what they try to get you to do what it is that they want you to do. So they use these like reverse psychology kind of things, right? They want you to go out and they want you to go buy FOMO options is what they want. That's what I think. I think that's the whole reason why they're saying the things that they're saying. Prometheus says abso-freaking-lutely, and I liked it just now. I actually haven't even looked at Twitter yet today, so I got some reading to do apparently. Balaclava says, check your DMs. Man, I got so much more sleep. Hold on a second, Balaclava. Oh, that is pretty looking. That is very pretty looking. June, first run up, second run up. You got the ABCD pattern here. That is really, really beautiful. I mean, I don't disagree with this at all. I like what you've done here. You've got this is the what pattern is this? This isn't oh, this is not a crab, is it? What is this? Is this a Is this a bat? Remind me what this is, Balaclava. Is this the bat pattern formation, or is this the what is this? I'm forgetting the name. There's a couple different ones I posted a long time ago on Reddit about us having crabs. But I don't think this is the crab pattern. This is something else. Let me go back and see what I have for posts. I'll look into this in a little bit. Let's cover our numbers though. It's got the right. Are these the right percentages? Does it fit? Does it meet the conditions for? Because I see you got 0.899 and I see you have a 0.989 here. Not quite the same percentages, and I know that they have to fall within a certain percentage to meet the criteria for the formation of the pattern. Does it meet the correct criteria? Do you know what it is I'm talking about, Balaclava? Yeah, it's supposed to be bullish, but it's a bullish bat. That's what it is. Okay. Yeah, I thought it was a bullish bat. I couldn't remember if it was, it doesn't look like a crab. It looks like a bullish bat. If it meets the correct criteria for the percentages, then yes, it is a bullish bat. But I don't know what off the top of my head, I can't remember what the percentages are supposed to be. So, but yeah, that certainly looks like one to me. Looking at it and knowing the percentages are two different things, though. I am a huge numbers guy, and I will be the first to tell you that if it doesn't, just because it looks like it doesn't mean that it is. You gotta have the right percentages. All right. So, yeah, let me dive into that a little bit here after I look at the numbers because I'm already kind of running late here, Balaclava. But let's take a look at the numbers first, and then I'll go and pull up the information that I have on some of this. There is on TradingView. There's actually there's already some indicators pre-set up that you can pull. I'll have to go back in my notes and research what indicator it was I pulled from the past. But there is some good stuff. Let me log into Fidelity and I'll take you guys over to the other page and we'll take a look at numbers. Good morning, hun. All right, two-factor authentication. If you don't have it, you might want to consider it. It could save you in the future. It's definitely going to slow you down when you log in, so know how long it takes you. But it's mere seconds. Also, Webull had me sign off on a couple different things, new policies yesterday, which I thought, of course, nobody ever reads those things. I didn't go through and read it all. I can only imagine that they are mitigating all kinds of risk with their new policies, which things like probably like we can take away we can take away the options trading for any security that we want to at any given time. I'll bet you that's in there. I can almost guarantee you that's in there. All right, let's take a look at these numbers. And remember, guys, I'm not going to be able to see what it is that you guys are writing. So hold all of those thoughts. Let's see here. Let's take a gander. What do we got going on? Price prediction tallies. I think everybody got a point. Let me see. Yeah, everybody got a point yesterday. I had 1168 to 1468. Eric had 1150 to 1450. Keto had 1039 to 1339, and Monty had 1074 to 1374. All of us getting a point. Short exempt volume. Numbers from yesterday on short exempt volume slightly decreased to 80.6 thousand. Just a slight decrease. Utilization, this is the number everybody always is waiting to hear. Let's see what that is. It's showing 100%. Let me verify that the date is correct on this before I commit to it. It is saying that's the reporting of June 22nd, so that is correct. 100% utilization for day number 94. 94 straight trading days of utilization being 100%. Those are big numbers. Let's see what's next. Day-over-day price change. Yesterday we had an increase of 0.8%. The markets did not do what I thought they were going to do. I literally thought we were going to have a red day yesterday. I thought we were going to have a red day today as well. Right now, as it stands, it's looking like green, but we'll take a closer look at that here in just a minute. Off exchange. What were our total values for off exchange as of yesterday by the end of the day? Refreshing that, the final numbers for the off exchange was 50.13, and the CBOE EDGX, which is the ETF options, off exchange was at 13.97. So I'm going to add that to the 5013, and the total value traded through the off exchange yesterday was 64.1% of our total volume went through the off exchange. That is actually very normal. Very, very, very normal day of volume going through the off exchange. I expect to see 64% on average. So, normal amount of shenanigans, for lack of better terms. Taking a look at the Hortex data, you'll see this morning that there was a return of shares. I actually pulled up Hortex last night on my phone, and I saw that they, at the end of the night, they did those, last minute trades of the day that the prying eyes don't see. And they did return some shares. So the shares on loan today is a little over 1 million shares less, like 1.2 million shares less than what it was yesterday. It's at 192.19. We'll take a look at the actual numbers here in just a few minutes, but the estimated current short share interest of the free float is now at 22.56%. Moving to the top right-hand side, utilization by institutions, 190.048 million. Let's give that a refresh and see if it's changed any. I don't expect to see some big changes in that from the Q2 reportings until mid-July. That's when we should start seeing some big institutional changes once they get those filings in. They're 13Fs. Moving down to the options, max paying $12.50. I'm going to say that it's going to stay the same. It was $12.50 yesterday. It was $12.50 the day before. So Tuesday and Wednesday were both $12.50. I think it's going to be $12.50 again. Let's refresh it and see. $12.50 it is. Most of the options have been trading between $12 and $13. Let's see who our lottery ticket losers are down here at the very bottom of the options. Let's see. At a $31 strike price, yesterday there was 9.8 thousand contracts. Today there's 9.6. Some of the positions were closed out. Some of those really, really deep out of the money call options were closed. Highest amount of volume currently in open interest for calls, still at a $13 strike price. Yesterday there was 14.2 thousand contracts. Today there's only 14.1. Again, more call options being closed out at a $13 strike. And at a $12 strike yesterday, the highest amount of open interest for puts was at 5.9 thousand contracts, and today is at 5.2. So, I'm sorry, yeah, that's correct. 5.5 to 5.2. Not 5.9, 5.5 to 5.2. So it's some of the puts close some of their positions as well, which is bullish to have a put close. 12 to $13 is the range that open interest is kind of indicating that we'll hit by the end of the day for tomorrow, which means we're probably not going to have a whole lot of movement from where we're at to tomorrow, at least based off of what options are seeing, the futures. Let me move over a couple screens real quick and we'll take a look at some of the other data in more depth. Alrighty. This is what your brains look like on drugs. Don't do drugs. That's my message. That's my little service public service announcement to hedge funds. This is your brain on drugs. Don't do drugs. 100% utilization for 93 straight trading days. On loan amount slightly decreasing. Now, remember, guys, I told you that one of the things that you see have happen just before you have a big run in price is you tend to see short interest drop, you see on loan amount drop, you see cost to borrow drop. Why? A bunch of shares get a bunch of short interest will close out their positions, close out the positions just before the run because they don't want them on the books. That can tend to see a little bit of a dip in price when that does happen. But on the backside of that is that you get this big, huge price increase as there's a bunch of buying that goes on, forced buying, and price just starts massively increasing. We are starting to take a little bit of a dip here. It's not massive yet by any means. I'm going to zoom in just a tad bit more. Day over day, we went from 193.35 million shares on loan to 192.19. The effects of this should be an increase of on loan average age per day. If it's not, if there's a decrease on this, or it's even sideways, then I would suggest that the positions are being closed out. So let's take a look. It's still going up. It went from 88.7 to 89.39. So not a whole. If positions were closed, it wasn't a lot. Estimated short share interest of the free float dipping ever so slightly day over day from 22.65 to 22.56. Security lending volume, a little bit of a bigger amount day over day. Not much. Let's make sure we're not on a threshold list. I doubt we are. We'd have to see some pretty large numbers on failure delivers before that would happen. Let's see what else. Is there anything else I need to cover on this page? I don't think so. We're good. Based off of orders traded on Fidelity yesterday, AMC came in 17th with 57% buys to 43% sales. That's about 3% lower than I like to see as a minimum. I do think that will hurt future price discovery. Perhaps Friday or Monday. GME came in at 21st with also a 57% buy to 43% sell. But do note, guys, that GME is getting more volume than they have because they've been struggling to make the top 30 list. So they're getting more volume. The problem is that 2 days ago, GME had massive amounts of their buy ratio was in the 40% range. That's going to hurt. That sell off, that retail sell off at that period of time. Those shares will show back up on the market, and likely you'll see a price dip here on GameStop shortly. Today's trigger price for SSR is $11.34. They've been busy with the shares available to borrow. At 6 o'clock this morning, they brought back in 150K and have since borrowed almost half of it. There was 527,000. Let me figure out and see how many shares here they've borrowed so far this morning. Looks like I'm going to round down on this one because I'm showing 359,000, but I'm going to round down to 350,000. So 350,000 shares borrowed so far this morning. Yesterday was 500,000. Gone are the days when they borrow in a normal day 4 million shares because they're not there. Fees are currently 18.6% to borrow. Out of the money calls, it's over 100K. This is the number I hate seeing. I hate seeing out of the money calls over 100K. 118.8 thousand contracts are out of the money on the calls versus 13.8 thousand contracts that are in the money. 36.1 thousand contracts are out of the money on the puts versus 7.7 thousand contracts that are in the money. You can already see here, guys, that the next 2 weeks is going to be very low volume in the derivatives. Very, very low volume. And this is partially why I was talking about, like Gasparino, Gassy and Assy both coming on and talking about, do your worst. What's the possible you can do? Or somebody else is saying it's like good cop, bad cop. I never said you guys couldn't hit 1K. I never said that. And Assy's like, what? Do the best that you can do. Apes, come at me. All right, guys. What kind of cow patties you want us stepping in? Because I see you're hurting for the next 2 weeks. Implied volatility does help positions. If they need more implied volatility to increase or help their position, you guarantee they're going to start talking about it and trying to get themselves helped. Don't help them out. We don't need to help them. Our money's good in our shares that we own. On the eastern side of the world, mostly up. Somewhere between 1 and 2%, most of them. Shenzhen was even up 2.19. Looking like a green day. I'm going to explore, well, I'll also say that for later. Let's see. So far, IWM is up 0.73%. In the pre-market, Tesla is up 1.3. Amazon is up 1.26. Cinemark is breaking even. Doge is up 3.38. Bitcoin is up 3.43. GameStop is up 1.34. HYMC is down 0.75. Hood is up 0.13. NCMI is down 0.96. And AMC is up 1.59 in the pre-market. And we're pushing right back on up into that range of 1275 to 1287. That we were struggling with in the past. Although I've already counted a synthetic price failure reset back here yesterday when we hit 1322. So we're either looking for new highs after 1322, or we're looking to hit a 19.5% failure in price, which puts us at 1064. A 20% failure in price would be 1057, and paper hands start at 1037, meaning that somebody sold some shares along the dip in price if we were to get that low. Let me readjust the SSR trigger point for the day today, which is 1134. Right there on that Fibonacci. Yesterday, our outflow versus inflow, we had $8 million more in inflow than outflow. Um, volume so far this morning pretty low at 18.92. We got about 6 minutes left before the pokey stick of volume. On the weekly, we have more buying pressure than selling pressure with an RSI of 38.42, which or 24 rather, which is below average. On the daily, we have more buying pressure than selling pressure with an RSI of 48.25, which is just about average. On the hourly, we have much more selling pressure than buying pressure with an RSI of 58.82, which is slightly above average. On a 30-minute interval, more buying pressure than selling pressure with an RSI of 60.65, which is above average. And on a 5-minute interval, more buying pressure than selling pressure with an RSI of 62.26, which is above average. Nothing quite signaling that we're overbought yet, just high. So a cooling off period would be good before market open. Ichimoto, I know you guys like to see it. It is a great indicator. I love it too. I like seeing it. I shouldn't say you guys like to see it. I like to see it too. I just forget about it sometimes. Lagging line is above price line. That's a good indicator. However, conversion line has crossed the baseline. That's not good. That's a sign to sell. However, price is above the cloud. If we saw a sharp price upwards swing, the conversion line could recross the baseline and it would turn this into a buy signal. But the conversion line is the only thing that doesn't look good right now. On the 4-hour, conversion line is above the baseline. Lagging line is above price line. We need to stay above $13 would be good. By the end of the day especially, that would put us outside the cloud at 1271. So anything higher than 1271 by the end of the day today would be amazing. Because it would turn a 4-hour Ichimoto chart into a massive buy for the next day. That's the magic number. Which is interesting because 1275 is the number that we need that we needed before to be 15% up from our previous bottom of 1109. Very interesting. And with that, I can see what it is you guys are writing again here. I'm going to start with everybody saying, Tammy, hope all goes well. So I'm going to scroll back up and see what Tammy did. I won't be able to pay close attention then. Tammy, what is Tammy saying? Ooh, Tammy, I'm sorry to hear about your husband going to the heart doctor. What is it, cardio something? I hope everything's okay. Myself says shills all seem to have ass in their names. Yeah, well, this world's not perfect. Good morning, Need for Speed. Good morning to everybody. UKU 788 says I sent you a link in your Twitter. Can we watch it? Let's check it out. Give me 1 second. How long is this?
I got it real quickly though. Charlie Gasparino. I talked about the support of the apes. These are amazing young people that are in these stocks like AMC.
All right, I gotta stop him right there. It's not all young people. I hate this. I hate it when people say that they start characterizing us as all being young that are in this play. I think there's people from everywhere. There is no demographic that is not hit by apedom. Everybody. There is everybody. There's all ages, there's all races, there's all sexes, there's everything is in this. So this idea, and we just hit our pokey stick of volume. Give me just 1 second. I'll come right back to this. I can't stand that though. I cannot stand it when they say those kind of things. I know this guy's on our side, but don't characterize us wrong. We're everyone. We are everyone, and we are all the same. All people equal. That's what an ape stands for. Our pokey stick of volume coming in at 31.3 thousand shares, and we're at 24,000 going into it. So very low volume for the day today. 20 to 40 million shares is going to be my prediction for the day. It's it's very low volume, super low. It's almost low enough to where I would say 15 to 25, but I'm not going to. I'm going to leave myself a little top room. So 20 to 40 million shares traded for the day today. Sorry, I don't mean to be I feel like I kind of already screwed up how funny this is going to be, but I don't like the mischaracterization of our community.
AMC and GME are trying to crush these out of control hedge funds that are shorting stocks and destroying companies. They're there and they're not backing off. And Charlie Gasparino, as you remember, Peter Navarro, he's a grease spot for the Wall Street oligarchs. This guy is a total great. Hey, Gasparino, I got news for you, buddy. You call my people and threaten me a lawsuit, dude? Bring it. You got nothing, okay? And I'm sorry. Oh, I'm getting intimidated. You're going to get a lot more intimidated. You're going to back off the apes, okay? Those people are amazing, and they got no give up and no back down, and they're going for the heart of this corrupt system. And you've been part of that system. All your tips you get from Wall Street, all the insider trading tips you give, we're not going to back up 1 inch. You're nothing but a Wall Street grease spot. Okay, Peter Navarro, your thoughts on Charlie Gasparino? So you can get added to the lawsuit.
I'm looking at Charlie's tweets, right? 128.21, right? Okay. Whatever happened to the dumbest economist ever, a.k.a. Peter Navarro, okay? So, Charlie, you want to take a shot at me? Here's a shot at you. You're nothing but a friggin' water boy, for the globalist establishment, Wall Street elite party of Davos. You drink champagne at lunch, not beer. Screw you, Charlie Gasparino, because what you do, here's your grift. Charlie. It's like whenever Wall Street wants a spin out on cable news, they call up Charles Gasparino. They got you on speed dial. That's how dumb I am, Charlie. Okay? I'm dumb enough to see that you are nothing but a grifter on TV. Yeah. You have done nothing but lose money for people with your so-called financial advice, and messenger boy, water boy, whatever you want to call it. You want to sue me, okay? It's like, there's your tweet, Charlie. Okay, back at you, brother.
Yeah, there it Charlie, is. Gasparino is a running dog. He's a running dog for the system. And what the apes are sitting there going, guess what? We're not there just to break a hedge fund. We're there to get to the heart of this corrupt system, and we're going to break that. And God bless them. I keep saying they're at the forefront of this populist revolt throughout the world. And remember, politically, they don't believe everything we believe, but this is a populist revolt. And it's got guys on the left and guys on the right, men and women on the left and right. And I got to tell you, the apes are to be admired. Okay? And Charlie Gasparino, as a running dog for the Wall Street oligarchs, is sitting there and trash talks them all.
He's a running poodle, okay? Let's be clear. He is a running poodle, Steve, okay? He doesn't even rate running dog because nobody listens to Charlie Gasparino. Everybody knows what his grift is. It's like if Goldman Sachs wants something, it's like it's just how it works. It's like Charlie will deliver the message, and he's done it on China. He's done it on everything. He was just a thorn in the side of the Trump administration from day one.
And he was wrong about every economic recommendation. Okay.
Yeah, that's a cool shout out. It's a cool shout out that they're doing for us. When did that come out? Let me see. Hold on a second. Got to pull it back open here. Published June 12th. So, like 11 days ago. Bitcoin still consolidating. Still consolidating. And Monty, I got your numbers, man. I got your numbers. Thank you. 1178 to 1478. Gotcha. Yeah, Bitcoin's still consolidating at that next dropping point of 19.4. It's doing something very, very similar to what it did last time when it dropped down to 28.6. Dropped past it initially, came back up and supported it for a while. I thought the breakout was going to be here. It was actually quite a few days after, so I was a bit wrong. I want to say that it's going to drop out earlier again on this one, like in this range here, but it could last out to the middle of July before seeing the breakdown to the next point of support, which would be 12.3. You want me to tweet that link? That's not a problem. Give me tweet the link. I got you. I thought you meant. I'll tell you what. There's one thing that I probably don't do a whole lot of, Tammy. And I try to keep politics out of this as much as possible. And it seems I don't really know who these guys are. A lot of you guys are going like, you don't know who Bannon is and Navarro. Yeah, I've heard the names, but I don't really watch them. But I can tell they're very just from this website. I can tell where they stand here, and I think it's great. I'm glad that they're supporting us, but I try to keep things very non-political related. So probably just not. I don't mind playing it, but I probably won't tweet it. But you guys are welcome to. I'll put it up here for you guys to tweet it. Let me see. It's not like I don't have a political opinion. It's just that I really feel like in what it is that we're doing here, it's not a political thing. We're not here. Salty Dog saying both Brandon and Navarro are heavy hitters. I'm not. I don't think that what we're doing here is political. I really don't. And I think for me to invite in people who are heavily politicized, kind of almost puts me on their side. And I'm saying like I welcome everybody. I don't care if you're on the right. I don't care if you're on the left. We welcome everyone. Everyone is welcome here to be a part of what it is that we're trying to accomplish. And And so I don't want to make it seem like I'm trying to favor one side over another. So it's not. I obviously have my political preferences, but I'm not going to be uh, a divider. Yep, Alex, the Pokey Stick was 24. We had 24,000 shares going into the Pokey Stick at 7 a.m. The Pokey Stick itself was 32.2 thousand shares having been traded, which put us at a total of like, what did I say, 24 and 32? Is that six? Yeah. 56? 56,000 shares having been traded or something like that when we went into into that minute. It's very low volume. Very, very low volume. So we're going to see like 20 to 40 million, I would guess today. Salty Dog says, damn autocorrect. I hate autocorrect with a passion. I really do. If you guys watch, I don't ever proofread. I never go back and proofread what I write when I send out messages. I've had to get better at that because of Twitter. I hate looking like a dumbass. So so I've had to get a little bit better about that with Twitter, but yeah, I agree. Balaclava says, I think Bitcoin will go to high 20s before going to 12K. I believe this drop was the third wave down, and we are about to see the fourth wave up before the five down to 12K or more. So I don't disagree with you, but I wouldn't say highs. Like you can see in the consolidation point here between or just before it broke 28.6. I have a Fibonacci that's set up here right here, and you can see how well it respected that Fibonacci. It broke past the Fibonacci level of support, came down, tested this Fibonacci level of resistance, never actually fully broke through with a full candlestick, and you can see it traded very well and came back up and touched the top of this Fibonacci. I would tend to say on this drive, the next drive up here, which if there is another drive similar to this one right here, I don't think it'll go much higher than 24/7. I don't think it's going to be high 20s though. I think we'll be lucky to see 25. Lucky if it does. But I think that those I think the Fibonacci lines that I have set up here are very, very good lines. I mean, like really good lines. I mean, check out these levels of support and resistance that are showing in here. I think some of the look at this how strong this is right here. It is very, very strong. You can see it. The Fibonacci's that I have set up on here, not only do they match up with on some of these yellow lines, but you can't see it because of the coloration. But there is a Fibonacci line on each one of my red lines that I have here. And I came up with these red lines prior to the Fibonacci. And what I did is I wanted to see if I made the Fibonacci match my red lines, what would happen to the other Fibonacci support levels. And sure enough, they lined up perfectly, just absolutely perfectly. So I think 24/7 is probably the highest you'll see us head back up to, because I do think that these are holding and supporting and resisting perfectly. Blackheart says, "Old J.P. Morgan, I mean Morgan." Yeah, I'm with you, Tammy. I'm with you. Keto's coming in 11:39 to 14:39. Keto, thank you very much. I got you down. Holy moly. You and I don't know what you and Monty are doing, but you guys are tracking each other like identically. I don't know what charts it is that you guys are looking at or what kind of metrics you guys are using, but you both are dialed in, dialed in. I can't even. It's amazing. Salty Dog saying, what do you think the results of the AMC moving to the Russell 1000 tomorrow will be? Historically speaking, most of the movement comes at the very end of the day on a Friday when the Russell securities are switched from one to the Russell one from the 2000 to the 1000 or 3000 to 2000 or 1000 to 2000. Doesn't matter which direction they go. Historically speaking, the most amount of trades and volume movements, happen in the end portion of the day. Why? Why specifically the end portion of the day? And I'll tell you why. There are triggers, market halts that are placed on securities when they move too much in one direction or another. You guys know about this. We've seen trading halts before. But what are the specific times that they are allowed to have additional amount of price movement within a security without tripping, halting, or halting a trading of a security? And the answer to that is from 3:35 to 4 o'clock. The grace amount is increased to 20%. Normally it's 5 and 10% throughout the trading day. But from 3:35 to 4 o'clock Eastern Standard Time, there is a 20% margin. So if there's going to be a big move, doesn't matter which direction, you'll probably see a lot of the forced trades, and I already think that they've been trying to reposition already. But if we're going to see a big move, it would be in those last 25 minutes of trading tomorrow, or in the aftermarket hours. I personally, based on all the research that I've been doing in the last week and a half or so of this move, from my understanding, AMC should have a sell-off of the ETFs because we have a lower market cap moving into the Russell 1000 than the rest of based on where our market cap stands in the Russell 2K, which means that there needs to be a redistribution of shares to the negative side, meaning that those shares will be sold back into the market and we should see a sell-off of some sorts. I think that there's going to be a massive demand for those shares. Massive. I expect to see some heavy buying happening. So just because they're selling off doesn't mean that somebody's not buying it. I fully expect it to go through the off exchange tomorrow. I fully expect. I can't even imagine them trading those to the market because we're talking about millions of shares. So I'm expecting to see something. I don't know what exactly, but I'm expecting to see something. Balaclava, percentages on the bat. Give me a second here and let me pull up my old data on this. Yes, I can. 1 second. It's been so long since I went over this. Let's see here. Here we go. Harmonic pattern detection. So if you don't know about harmonic, there's 4 key patterns that are seen. There's it's the Gartley. I think I'm saying that right. Gartley. Gartley harmonic pattern detection. It's there's a bat, there's a Gartley, there's a butterfly, and a crab. If you don't know what this is, you can research by looking up Gartley harmonic pattern detection. Let me actually just give you guys a link. So I'm just going to give you. Actually, I would rather do this one. So I'm going to give you an Investopedia link on this. And let me look up the percentages. I'll read about what Gartley pattern is first. And I'm just reading straight off of Investopedia, the same thing that I just linked you guys to. The Gartley pattern is a harmonic chart pattern based on Fibonacci numbers and ratios that helps traders identify reactions, highs and lows. In his book, Profits in the Stock Market, H.M. Gartley laid down the foundation for harmonic chart patterns in 1935. The Gartley pattern is the most commonly used harmonic chart pattern. Larry Pesavento later applied Fibonacci ratios to the pattern in his book, Fibonacci Ratios with Pattern Recognition. Gartley pattern is the most common harmonic chart pattern. Harmonic patterns operate on the premise that Fibonacci sequences can be used to build geometric structures such as breakouts and retracements in prices. The Fibonacci ratio is common in nature and has become a popular area of focus among technical analysts that use tools like Fibonacci retracements, extensions, fans, clusters, and time zones. Many technical analysts use the Gartley pattern in conjunction with the other chart patterns or technical indicators. For example, the pattern may provide a big picture overview of where the price is likely to go over the long term, while traders focus on executing short-term trades in the direction of the predicted trend. The breakout and breakdown price targets may also be used as support and resistance levels by traders. The key benefit of these types of patterns is that they provide specific insights into both the timing and magnitude of price movements rather than just just a look at one or the other. So taking a look at, let me see if I can pull this up here. This is the post that I did. When did I post this? 5 months ago. This is a post that I did 5 months ago on Reddit, and I said we got crabs. So, but this is a great indicator that you can use on it's TradingView, and it's called Harmonic Pattern Detection (LUX). And it will show you if you're triggering for a bat, Gartley, butterfly, or crab, and you can chart out the positional movements, the A, B, C, D, the A, B, C, D, and E patterns. I think this one's. Boy, I cannot see this. A, B, C. Here's the A, B, C, D, and this is the X over here. There are some percentages that have to occur between some of these points, and if they meet those percentages, then you get a check mark for whatever pattern formation it is that you're getting. You have to kind of know how to chart these correctly. You have to know where to pull the points at to be able to see if you've got it flagging or not. And it definitely flagged for a crab on this one. As you can see with the check mark over here. This is not something I'm extremely familiar with, but I do know about it, and I've experimented a little bit here and there with it. I am a huge fan, a massive fan of Fibonacci and retracements, and how they impact, as I just showed on Bitcoin, how they impact price movement and I guess I shouldn't say how they impact price movement, but how they can show where price movement's going to be moving to in the futures. So the idea that you can incorporate that into patterns of buying and selling points of resistance and support, I think is I don't know what the word. I'm in favor of it. Let's see here. So balaclava. Let me pull up trading view. You can get rid of those. This is probably going to take, you know, this is going to involve me having to. I'm gonna have to, in order to draw this out like you did, it's gonna take me a while to do, so I probably won't do it live on stream, because I would have to go through and mute a lot of the different things that I've already got showing up on my chart, and I really don't want to do that. But let's see if I can just throw the indicator on here. What was it called again? Harmonic pattern detection. All right, well, I guess it's on. I don't see it. Oh, that's right. You got to go in and you got to set up the. All right, set. So I'm gonna use your points that you used for your second image and see if I get the same thing. So give me just a second while I pull your message back up here. So you're going with A being here. Oh shoot, I think I already screwed up. I already screwed up. Hold on a second. I gotta delete this. Let's try this again. I'm not reading. Alrighty. Set the X time. So you got X right over here. I'm going to put X down here. A you have here. Next is B. You've got B sitting at here. C you have over here. And D you have at the very end down here. I'm showing X's across the board, meaning it doesn't fit the pattern. So I do not see, there is no pattern match for what you have here. It's showing up as green, but I don't see the pattern formation is not pulling a flag for this. I'm getting no bat, Gartley, butterfly, or crab required points met. So let me try to set up my own based off of how I remember doing this, just to see what the difference looks like. Does this do it? No. Guess I have to just recreate it. harmonic. That's not it. This one. And I'm gonna have to actually go back and do some research and see. Yeah, no flag on this one either. There's another indicator that I have that I had pulled up as well when I did harmonic searching for or Gartley. Fartley. I almost put in Fartley. Gartley predictor. This might have been it, but I don't think that it is. Might have been this one. Okay. I think it might have been this one right here. It's harmonic patterns. I don't remember. Let's see. I think it's the very top one, but it actually will track out. You got to go down to a smaller time frame, and it will actually tell you where the signals are found on a larger time frame. It doesn't. I guess either it doesn't see them, or because either they don't exist, or I'm not sure what. But when it's a red Gartley, so it's bearish. It's a bearish Gartley, which looks like it predicted it correctly. Here you have a bullish butterfly, which turned into some bullish movement. It did have it signaled also a bearish bat here, but did not actually happen. Here's a bullish bat. Here's a bullish Gartley that turned into a bunch of nothing. Bullish butterfly and bats showing up here, and we did have a price increase, but I'm not seeing anything showing up currently. If we take this out to, let's see if we can get something to show up on a 4-hour. On a 4-hour, it does show. And then I think it stops. Oh no, here I'm on the day pattern here, and it is showing some daily patterns. Nothing showing up for current pricing though. And let's see if I can do weekly. I mean, it's on the weekly here. It's showing a butterfly pattern, a bearish butterfly, which that signaled on the weekly, and sure enough, it was very, very accurate on that prediction. And the bullish Gartley pattern here was also correct as well. So this is, it's flagged for the weekly before, but not flagging anything currently. And let me just check one more indicator. I'm just curious if it'll let me use the pro version. Guess not. I used to have a, let me check my folder here. I used to have a page that I think I may or may not have saved with a bunch of the different pattern formations and how to know what you're looking for. Let me see if I still have that. Why would I not have saved that one? Yeah, I don't have it. There was a great website that I found one time that had a list of all the different types of patterns, how to identify the bullish and the bearish counterparts to each one of the indicators, and I'm not seeing that. I thought for sure I had saved it somewhere, but I don't see it. Yeah, I don't see it. It's not in my folder here. But I can probably find it again. But hopefully that helped you out. I don't know, maybe, maybe not. Let me go back and see what it is you guys are writing here. Oh man, there's a lot. All right, I'm just going to start at the very end. If you guys got specific questions for me, I'm just going to start where Apex says, morning, Casey. Good morning, Apex. Let's see here. I will check my messages. Ah, I see it. I see the bat that you're flagging for. Yep, checks out. Checks out for a bat for sure. But it signaled back in what are you on the weekly? Let me see here. Yeah, 1 week. You got this set up for the 1 weekly chart here, so I'll throw that up on the screen. It did signal for the bat, and you've got it on the 1 week, which you would think that there would be some kind of increase shortly thereafter once you have a signal like that. But we're not seeing anything as of yet, and we're already, what, 3, 4, a month and a half beyond that signal point. There was an increase in price that occurred, but this is such a massive amount of time that you're signaling for here. That I guess that probably has to be put into perspective, right? You've got a year and a half's worth of data all wrapped up into one signal. So the amount of time that it's going to take to get that bullish movement that would be that you should get out of this may take some time. So this month and a half that's right here may not be enough time to have this this trigger. And this is where going back and researching the requirements or what kind of things you would expect to see have happen based off of time and percentages amount that it would be increasing by is where you'd have to go back and you'd have to do some research on more into these Gartley signals and what they indicate. All right, I'm gonna go ahead to break here, guys. Let me just read through the rest of these real quick here. Um, just clarifying, Miss Tahiti did not say bless your heart. Yeah, the magic number for me, balaclava, is 20. It's always been 20. It was 20 last June. Well, I should say May. May a year ago. 20 was my magic number. It still is. Once we break into that 20 range, goodbye. Nat Nail, as far as the short score goes for Hortex, that's their they use a formula to calculate that, and I doubt they're going to give it away since it's a proprietary formula. And all they're doing is they're just taking a bunch of different factors and kind of compiling them into some kind of score that ranks on a scale of 0 to 100. And the closer it gets to 100 means that you've checked off the right boxes to their indications that you're getting really close to having a possible gamma move, gamma, or even a short squeeze, a squeeze of some type or another. Miss Tahiti, oh yeah, Yucca Frida, how's it going? Caitlin says, I looked at Fintel Gamma Squeeze top stock number, excuse me, number 7 has a market cap of 6.5 billion. Ugh, excuse me. Can you check and see if it's AMC? I don't have a subscription to Fintel anymore. So if it's pay locked, I'm not going to be able to see it either. Oh, you just don't have an account? All right, let me see if I can find it. Give me 1 second. Yeah, I don't have it either. It's pay locked behind mine as well. But you're right though. The market cap on 1, 2, 3, 4, 5, 6. No, I'm not seeing the same thing. Wait, what is our market cap? We have 6.51. I don't see a 6.51 listed on the list right now on current holdings. On their list, I'm not seeing, out of the top 10, I'm not seeing a 6.5 market cap on there. And this is what, oh shoot. This is the page I'm using to look at, but I don't have access to get into it either. I used to, but It was I didn't see the gains from holding a subscription there. But that's the web page I'm seeing. I don't see a market cap on there of 6.5 billion. Unless I'm reading it wrong. If you're looking at something different, let me know. How do you get to the next page to see number 11? I don't see the spot. Hold on, I gotta switch it. I gotta switch my visuals here. Ah, it's blinding. So bright. Good morning, Dana. I do have a subscription, Caitlin, but I don't have the paid subscription. I'm still logged in as a subscriber that doesn't have a subscription anymore. Oh, I didn't see it. You know what? I passed out. You know how I was severely lacking sleep last night, Jabibs? So I decided to do the responsible thing and fall asleep early. So I went to bed at like an hour and a half earlier than usual so I could get some extra sleep, and woke up this morning groggy and feeling like I felt better, but was still probably not near enough. I think it's a good thing. I think it's a good thing, Pumpy, but I don't know that it's necessarily going to like push us into doing anything strange. Yeah, Caitlin, absolutely. Um, you're set up for a link now. Apex, yeah, I can absolutely show it to you. You can see they've got, oh, that's nice. They got a nice little threshold list now, indicator that pops up on here. So if it pulled up the threshold list, you can see where they went on. Well, it's not showing up. Interesting. They may be on the threshold list currently, but it's not showing up on their report for some reason or another. It does say it's on a threshold list. The current short interest is 76.68, cost to borrow 952. Here's the big problem here. Anytime you ever look at any stock you're ever getting into, always make sure you know who the players are, and who's pushing, who's pulling. Those are very, very important topics to understand. And so when you take a look at that, what I would encourage you to do is go over to Fintel and check and see how many shares are owned by institutions and whether or not that's going to be something that's going to help you. Because guess what? You don't move the market. You don't. You absolutely have no impact on movement of the market whatsoever. Institutions do, not you. Institutions. And so if you come over to Revlon and you type in Rev on Fintel, You go to the U.S. Revlon Incorporated Institutional Ownership, and what you're going to see is that there is only 4.9, or basically 5 million, just call it 5 million shares of institutional ownership in this play. 5 million. That's it. That's how many are in this. So, and they actually are not providing a percentage, which they normally do. Normally there's a percentage in here that tells you what they have. So you come back over here and you pull up Rev. You see that their total float is 7.75 million. Oh, that's actually really high then. Never mind. Their free float is 7.75 million. They got institutions own 4.9 of this. That's a much higher. We'll just call it even 5 million because it's really close. But let's see what that ownership is. So this is there's two bad ways you don't want, right? There's two things. You don't want low ownership, because low institutional ownership means you have no bike chain. You're going to be pumping, but the people who are doing all the actual real work only own 10%, and they're going to be like, thanks for your money. See ya. But then there's the other side to that, whereas if the institutions own too much, then when they sell, you're going to be the one who's the bag holder, right? So you really need to have like this like sweet spot of institutional ownership that's not like, you want retail to be the majority holder, not the other way around, because if institutions are the majority holder of the free float, they're going to be the ones who get out before you do. And once they get out, it's over. And you're done, and you're going to be sitting there holding bags if you don't get out before them. And that's what this position is right here, because I'm seeing right here that it's saying that their institutional ownership is 5 million shares. And it looks like there's only 7.75 million in existence for the free float. Let's see. $7.75. Which means that they own what, 64.3% of the float? That's danger. That's danger zone. You might be able to get away with that. It's really, really close to danger zone. 30 to 60% is like ideal, right? It's just slightly over 64%. That's danger zone. It's getting close. If it was over 70%, it would be like be very, very, very careful what you're doing. 64% is getting really close to that. Really super close. But I guarantee you, though, and I've stated this for a long time, there's always going to be eye candy on the side of the road to try and keep us away from the things that hurt them the most. Picking up on those pieces of eye candy is really not necessarily you stealing money from institutions. It's you stealing money from probably fellow retail holders, because there's going to be bag holders in these positions, and those bag holders are not going to be institutions. So basically, when you think you're stealing money out of institutions, all you're doing is you're pumping something that's going to cause more retail baggage holding. So whose money are you really walking away with? And the answer to that is you're walking away with fellow retail's money. You're not walking away with what you think is institutional money, because the institutions aren't losing on these plays. Somebody in retail is going to be the losers. So all you're doing is you're getting a repositioning of money. You're putting money into the hands of institutions and taking from retail. That's what all this eye candy is. Where is my info? There it is. Alrighty, guys, I'm heading to break here. Let me put up my message and put on some music for you guys, and I'll be back 15 minutes before market open. All right, see you guys in just a bit.
Hey there, this is Josh.
motto.
Don't act funny, you need my money. Don't come back, go keep that dummy. What you got, don't need that honey. Keep that dummy, keep that dummy. Don't act funny, you need my money. Don't come back, go keep that dummy. What you got, don't need that honey. Keep that dummy, keep that dummy. Iced tea chillin', sit back and recline. Keep bad vibes on your side of the line. Don't call my phone, yeah, I'm doing fine. Look at the time, run with the lime. What you got? I don't need, I don't want it. What I got? You know me, I'm a fronted. Who you got? Ain't no me, they don't got it. La 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 la. Don't act funny, you need my money. Don't come back, don't keep that dummy. What you got, don't need that honey. Keep that dummy, keep that dummy. Don't act funny, you need my money. Don't come back, go keep that dummy. What you got, don't need that honey. Keep that dummy, keep that
Dummy.
Get it and go. You wanna come to my show? Sit in the front of the row. I'ma just have to say no. Attitude is stinking, yeah, you might need detergent. I'ma have to break it to you, baby, you ain't perfect. What you got? I don't need, I don't want it. What I got? You know me, I'm a fronted. Who you got? Ain't no me, they don't got it. La 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 la. Don't act funny, you need my money. Don't come back, don't keep that dummy. What you got, don't need that honey. Keep that dummy, keep that dummy. Don't act funny, you need my money. Don't come back, don't keep that dummy. What you got, don't need that honey. Keep that dummy, keep that
Dummy.
Ooh, child. Listen, I done had enough. Just keep getting these lemons sour all the time. I pucker my lips, yeah, I might get stepping on pills now. I don't slip, just keep getting these lemons. It should be a crime. What you gonna find is I don't quit. I'ma show out now. I'm the Life is giving lemons every second and hour. I think I used to be sweeter, but now I'm feeling too sour. I used to feel on top and now I'm losing my power. Now I just do it, get a check and get a meal and devour. I ran out of juice to make the lemonade. Lawyers like a bears, maybe I'm afraid. But only I don't have to operate. Feeling really fast when I hit this. Keep getting these lemons sour all the time. I pucker my lips, yeah, I might get stepping on pills now. I don't slip, just keep getting these lemons. It should be a crime. What you gonna find is I don't quit. I'ma show out now. I'm the I don't want 'em no more. No, I don't want 'em no lemons. No lemons, no. I don't want 'em no more. No, I don't want 'em no lemons. No, getting these lemons sour all the time. I pucker my lips, yeah, I might get stepping on pills now. I don't slip, just keep getting these lemons. It should be a crime. What you gonna find is I don't quit. I'ma show out now. I'm the keep getting these lemons sour all the time. Pucker my lips, yeah, I might get stepping on pills, yeah. I don't slip. Lemons, crime.
Hi folks, Johnny Boyle here. It's a privilege to see the brilliant content you're creating with my music. If you're enjoying Upbeat, why not go premium? I guarantee you won't look back.
It's a freaking clown show in here. Left it on Rev. What the heck? Who's running this thing? This circus. Good morning, Sammy. Wait, I had to throw my little yeah at the end of that. That music is hilarious. Hilariously bad. All right, I got to get myself a price prediction going on here. Yep, Powell speaking. Is it at 10 balaclava? I had a yesterday. I think it was showing 9:30, which was market open. So I'm gonna pull it back up again. Today is the 23rd. Yep, there it is, 10 a.m. You're right. You're not wrong. So what I'll do is I'll probably run the numbers a little bit earlier than what I'm used to doing and try and get done with them before 10 a.m. Eastern Standard Time, because that would be 30 minutes after trading starts, and then we'll try to watch his live. I know, War Dog, it was terrible. I don't know, man, and I had the wrong chart showing the entire time. You guys are probably sitting there going like, "Why is our price so low?" When you're trying to get beggars can't be choosers is what it is, War Dog. Beggars can't be choosers. I'm a beggar for free music, and that's what you get. All right, let's see. Where are we moving up in price? I do believe the market's looking like it's trying to head green, although the VIX is indicating some positive movement, which means that the market could come back down. The eastern side of the world was up mostly. I'm going to go with 1190 to 1490. Let me just pull back out here for just a second, just to make sure I'm seeing the big picture. Also, I owe somebody a chart. Um, I probably shouldn't name any names, but somebody was asking me about whether or not do I think price could go back into the $9 region range again, as they had heard something about that someplace else. I do want to note here that some of our particular price movement that we've seen from this last run up to 34.33 down had a very similar pattern to what we saw having traded from this point back up here, where price fell from 45.95 all the way down to, I guess, an eventual bottom of 12.90. So if you look at this, what you see here is you see this bottoming out here. It's almost like you got a little bit of a double W pattern followed by a double top. So you got a double bottom followed by a double top, and then a V shape price movement into the next run. And so what you have here is you have a fall, you have the double bottom, the double top is here, although the secondary top didn't quite hit the same mark, and the awful V-shape portion, which is not looking quite the same as it did back here. But it's similar. So what would cause this to be a more of a V-shape pattern, or maybe a stair-stepping pattern, which would make it a little bit different than this back here, is by having price move back down to a secondary down point after the double top, which would be below the original price movement downwards. And here the original price movement downwards was 970, meaning that the bottoming out of this V-shaped pattern would put us probably somewhere in like the low 9 range, 9 to 950 kind of ranges. And so that would give you your sharp V downwards, and it would also give short positions the ability to be able to close as many positions as possible above $10, and then seeing that big price movement upwards. So that is definitely a possibility that I'm considering. But I didn't draw that out for anybody, which I said I would. So give me just 1 second while I draw this. Um, Actually, I'm not going to draw this. I'm going to take a screenshot. And I'm going to draw it offline to the side. Give me 1 second. Alrighty. Let's get our Bollinger Bands back up there so we can see how price is moving compared to where we think it's going to move to. Good morning, Space Ape. What's your thoughts on the Charles video, new video? I said all the movement is pre-planned and stocks are being controlled as they put us in a great reset. I agree a lot. It's you can see the heavy amounts of control. And Chairman Powell essentially admitted to that yesterday in his testimony to the Senate. He essentially admitted that very exact thing. So, and his statement was that they're waiting on the SEC to approve some final rulings before they're gonna let things happen. So it is time to start the morning intro, guys. So I will see you after market open.
T-minus 90 seconds and counting. All systems are go. We're about 90 seconds from the launch of Space Shuttle Discovery. T-minus 60 seconds and counting. We are transferring to orbiter internal power at this time. Discovery is now running off its 3 onboard fuel cells. Coming up on a go for auto sequence start.
Go for auto sequence start.
And we have a go for auto sequence start. Discovery's onboard computers have primary control of all the vehicle's critical functions. T-minus 17 seconds and counting. 15, 12, 11, 10, 9, 8, 7, 6, main engine start, 2, 1, booster ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
Solid rocket booster separation confirmed. Guidance now converging. Discovery's onboard computers commanding the main engine nozzles to swivel, aiming the shuttle for its precise target in space for main engine cutoff.
Should have a good forward leg now and advance.
Dan, you sound good.
Discovery Houston, negative return.
Copy, a negative return.
Good morning, you filthy apes. Welcome to AMC and ADD, where we buy, we hold, and we screw the hedgies. Screw them! Good morning. Good morning, everybody. Kind of a mixed emotions, I guess, on which way we're gonna head here. The wicks on this is insane. Price really just struggling to decide which direction it's gonna head here. Right off the bat, we don't have a whole lot of volume. Which is what I was kind of anticipating. Earlier this morning, we didn't see a whole lot of pre-market volume. Let's see. What are you guys saying here? I think Keto says, Casey, can you explain what Pantheon gave you credit for on Boss Blunts' channel, referring to JP Morgan and meme stocks? In regards to the really weird movements that we've been seeing in the after hours of trading, a lot of people were wondering what this stuff was, because it's not just on AMC, it's everywhere, right? So here's AMC with its strange trading activity going on in the aftermarket hours, and then you can go back and you can look at like a lot of other stocks, and you can see those same kind of things occurring. Really, these like weird trades that occur, and nobody really seems to understand what those are. It doesn't look like it happened on HYMC. GME, let's see if it had it. Looks like GME didn't have it yesterday. Let's see if Cinemark did. Cinemark did, but it's harder to see because it's just a quick point up and then it goes back down. Amazon had it. You can see it right there. It shot all the way up there. And then Tesla. Let's see if Tesla has it. You can also see it in ETFs as well. Some of the ETFs will show it. I don't see it in IWM. Let's check SPY. There it is in SPY. SPY had it. So I mean, it's just this really weird trading that has been occurring for a couple weeks now, and everybody's kind of sitting there going like, a lot of people thought it was stop loss fishing, or there's just been a lot of like crazy kind of things that people thought it was, and I don't remember who it was that sent it to me, but if they want to take credit for it, they're more than welcome to, because it wasn't myself. I did not find it. It wasn't something I found. Somebody sent me a screenshot of, they happened to be watching Fidelity Active Trader Pro at the time and watching the order book being traded at the time, and sent me a picture, a screenshot of the movement. Now, I'll show you the difference. When I'm looking at it on time and sales on Webull, all I get is TRFs. They just show up as a TRF trade. And that doesn't really tell me anything that I need to know. But it was in that screenshot that they sent to me that said that the one of the exchanges that the shares were being traded, or the exchange that those shares were being traded through, was DF. And if you look into what exchange that is, it's actually the ADF exchange, and there's only one that's a Fintel off exchange that exchange those shares are trading through. There's only one active participant in ADF exchange trading, and that's JP Morgan. So I reached out to JP Morgan. They didn't send me back any information about what it is that they're doing with their aftermarket trades. of course. Why would they admit to anything? So then I sent Fintel a message I think it was yesterday. And believe it or not, I actually did get a response back. Let me see if I can find it here. Although it didn't really help me. There was nothing to be gained from the response that I got back. And I actually got the response back yesterday, pretty quickly. And I didn't mention it to you guys because there was really no good answer. Let me see if I can find it. Here it is. So I might need to contact them again, because apparently they weren't aware of what it was I was talking about, which is kind of odd to me, because there's only one active participant trading shares through ADF. So how they could not understand what it is I'm talking about, I really don't understand. But they said, I'm not sure what data you're looking at. But my experience, trades appended with the ADF facility includes trades excluded on a TRF, which is what is being reported through time and sales on Webull, which is a FINRA NASDAQ Chicago TRFs or FINRA NYSE TRF, along with ADF trades, will use the same indicator. Hope that helps. So all they basically told me is that ADF reports to TRF. which tells me, I mean, first off, I guess in that response, the only thing that they're really saying is like the reason you're seeing it reporting on the lit exchange is because ADF does report to TRF, which TRF shows up as a Nasdaq or NYSE TRF trade. So that's the reason why we're seeing these spikes, even though it's an off exchange exchange that's being traded. It reports to a TRF. So that's why we're seeing these spikes being reported. But I don't think it's actually moving price like that. It's just not. It's just getting reported through it. So that's the only information I got out of them. They're not gonna tell me what's going on. I'm sure FINRA's not gonna be like. They're probably not gonna say anything beyond what it is that they've told me already. So, but JP Morgan doing something. Not sure what, but they're doing something. Pro Jeweler says, is it related to Onyx? I don't know for a fact. I know Boss Blunts and Pantheon were mentioning Onyx. I had mentioned to Pantheon that Onyx is, they're in the testing phases of Onyx right now, which they use for settlement of trades that are occurring offshore. And I don't know. I don't know for a fact if that's the case. But it's a theory of mine that possibly maybe that's what we're seeing is some testing of Onyx. I don't know for a fact though. Morning Thick. Tammy says she sent it to me. Thank you, Tammy. I'm sorry I couldn't remember, Tammy. Actually I do remember you saying it now the other day when you came back in and said that was me. So I appreciate it, Tammy. It takes a community, guys. Everybody having eyes on different things all the time is really what allows us to discover the things that we discover. If it had not been for Tammy taking that screenshot and sending it to me and me doing some due diligence on trying to figure out what the heck that was, we never would have gotten to the point to where we're at now. And everybody still would have been sitting here thinking, twiddling their thumbs, wondering what the heck those things are, why we're seeing these trades occurring through that off exchange. So thank you, Tammy. Thank you for having open eyes. Hey, Bjork, it's okay, man. It's quite all right. It's not a problem. Life continues on. AMC will always be here. I sent a message. I was talking to Adam the other night, and I sent him this message. I thought it was kind of fun. I was just trying to be funny. I said he was telling me I need to be more careful with my health and making sure that I get good rest and stuff. A lot of you guys kind of care about me, and I appreciate that. And I said, but you know what? Nobody wants to live forever. I said, let's live in the moment and not worry about what tomorrow's fears await us as thieves in the bushes. We will be ready, and we will have lived. You continue to live life, guys. You go do the things that you do. AMC will always be here. Don't let it rob you of life. Still continue on and move on with your life. AMC is just going to happen. Don't let it rob you like a thief in a bush. And don't look up that quote because you're not going to find it anywhere. Damn it, I made it up. It kind of has it stems from other things that I've read in the past before, but it's a Casey quote. Leon says, Casey, do you know Charlie's vids? And do you disagree with his views that AMC and Jimmy isn't going to squeeze until 2023? I don't know the timing. 2 weeks, Leon. 2 weeks. I don't know the timing of this. I really don't. I know who Charlie's vids is, but he also is not an AMC holder. I can tell you that. I can also tell you that has on several occasions come out against AMC. I like some of his content because he really does great deep dives into NSCC filings and TCC or DTCC filings, and changes in rulings, and I really appreciate that out of him a lot. There are other things that we all have our strengths and our weaknesses. When he gets his tinfoil hat on, I have a hard time. I have a hard time with him. But I really do enjoy some of the deep dives that he does into some of the reports for rule changes. I said a thief in the bushes, Space Ape. I didn't say a thief in the night. I said a thief in the bushes. Because if you're living life, you're not sleeping, and that's what a thief in the night does. A thief in the bushes is waiting to rob you of your time as you're living life. Don't be afraid of those thieves in the bushes. You'll be ready for them because you've lived life. You know what, Need for Speed? I'm feeling like a little bit of plush myself. Let's play it tomorrow. I'll make it happen. Whenever I cook in the kitchen, I always turn on Stone Temple Pilots. My wife will attest to this. I love me some Stone Temple Pilots. I'm actually setting it up right now so that I have it ready to go so I don't have to think about it tomorrow. Because if I have to think about it tomorrow, I'll forget. That's how bad I am. All right, guys, I'm going to run through the numbers a little bit earlier than I normally do, just because of the fact that I know Jerome, our favorite person in the whole wide world, is going to be coming on and talking to the Senate one more day today. So I want to be able to cover that. So let me run through the numbers real quick here, just a little bit earlier than normal, and see where we stand, and then we'll go over and watch him. Corbin Dallas. I love that name, by the way. I love that movie. Fifth Element. I always think of Sixth Sense because it's all the same. It's Bruce Willis. Fifth Element is on my top 10 list. So I love the name. I know I've probably mentioned that to you before because I remember saying it, but saying it again anyways. And what we can do is we can go back and we can rewatch what Jay Powell said yesterday. I'll see if I can't find where I paused the video and then replayed what it was that he said on my video. And we'll take a look at that. But let me run through these numbers. We'll listen. I'll see if I have enough time to pull that up real quick and play it back for you so you can hear it for yourself. And it's not just a trust me, bro moment. Let me refresh Fidelity and try and get through these numbers as fast as I can. So I'm not gonna be able to see what it is you guys are writing any longer. Let's do a quick rundown of all of our numbers for the day here. This is the long run. Give me 1 second while I log into Fidelity. Two-factor authentication. Not a bad idea. Doesn't matter who your brokerage is. If they have it, it could help you. Could save you from a nightmare. Might take you a little longer to log into your brokerage, but it may be worth the protection. Let me move over a couple screens and we'll get started with the breakdown here. All right, let's try to run through these numbers really quickly. Starting with the top left-hand corner. One second. Price prediction for the day today. We are in a four-way tie. I have 1190 to 1490. Unless Eric's texting me back here pretty soon, he's going to have 1150 to 1450. Keto's got 1139 to 1439, and Monty has 1178 to 1478. We've all been very, very, very close to each other in price predictions so far every day this week of trading, which is very unusual. Typically, when that happens, I see weird things happen in price. So just throwing that out there. Short exempt volume on True Demons MOASS trigger indicators was 80.6 thousand yesterday, which is down by about 6,000 shares from day over day. Utilization, we are on day number 93 of having 100% utilization. Day over day price increase was an 80% or not 80%, 0.8% increase day over day. And taking a look at off exchange this morning, by this time in the morning, I would expect to see somewhere between 44% in the off exchange, and the EDGX being right around 10 to 11%. Let's see what they are. 45.71 for the off exchange, which is actually pretty close to normal, and that's unusual. And the EDGX is at 8.6. These numbers are looking very, very, very close to what I would expect to see normally. They're actually, one's high, one's low. The total for that is 54.31%. Those numbers almost reflect what it is I would think we would start seeing once we moved over to the ETFs from the Russell 2K to 1Ks. Taking a look at Hortex data, currently reporting there was a return of shares, about 1.2 million shares yesterday. Borrowed change amount so far for today is at 158,000 shares. That's going to have a slight increase effect on the estimated current short share interest of the free float to 22.57. The cost to borrow is at 20.36. Very, very high, but the range between the min and the max is not too far. So the max isn't as high as 30 like it was yesterday. Shares on loan did dip day over day, and we'll take a look at that here in just a minute, but it went down to 192.19. Moving up to the top right-hand side of the screen, institutional share ownership, 190.045 million. I'm refreshing to see if it's still the same. It is. Max pain is $12.50, the same number that it started the week out at. Let's see where the most volume is currently in options. On a $13 strike price, which was the same as where it was yesterday, there is currently 4.8 thousand contracts in calls. On the put side, that's a little elevated, but not highly. On the put side, the highest amount of volume at a $12 strike price, which is 50 cents lower than it was yesterday, there's currently 1.9 thousand contracts. So a little more than a 2-to-1 ratio in volume. And market kind of indicating maybe a closing price around $12.50 for the day today. Currently. Taking a look at Hortex's data. There's your utilization for 93 straight trading days. On loan amount, here's your decrease from 193.35 to 192.19. This should have the effect of raising on loan average age per day, and if it doesn't, if it makes it go sideways or down, then that means there was a closing of positions. But it did raise, but not as much as I would have expected, so there could have been some older closed positions here. It went from 88.7 to 89.39. Exchange reported short interest of the estimated short share interest of the free float day over day decreasing slightly from 22.65 to 22.56. And security lending volume had a little increase day over day. Not very much. Went from 7.7 to 9.16. AMC currently being traded 12th most heavily traded stock based off of orders. We currently have a 68% buy to 32% sell ratio. That looks very strong. GME coming in at 25th with a 58% buy to 42% sell ratio. They've been struggling. They have definitely been struggling on buy to sell ratio. I don't know why. SSR triggers today at 11:34. Shares borrowed so far for the day today. It looks like they returned a bunch of shares and then started borrowing again. There's 25K right there, and then they returned them. Let's see, that would have been 6 my time. So I saw the 238s. Okay, mostly returns on the ETFs. So they borrowed basically another 25K in, and I don't count that. I usually only count up to 50,000 in borrows to change my numbers. So far on Stonko Tracker, I've seen about 350,000 shares having been borrowed. If you want to add another 25K to it, whatever, but I'm not going to. Out of the money calls versus in the money, we have 124.3 thousand contracts out of the money versus 8.3 thousand contracts that are in the money. 31.8 thousand contracts are out of the money on the puts versus 12,000 contracts that are in the money. NASDAQ is up 0.27, Dow Jones is up 0.45, and the S&P 500 is up 0.4. We currently have 3,577 advancers to 3,088 decliners. The market is ever so slightly advancing. However, the VIX is up 0.79. IWM is pretty much breaking even right now. Tesla is down 2.21. Amazon is down 0.12. Cinemark is down 1.01. By the way, I'm gonna have to get rid of IWM here, guys, when we switch, because this is BlackRock's ETF, so I'm gonna have to switch this over to the ETF that we switch over to after Friday. I think it's gonna be IWB, I believe. I'm pretty sure it's gonna be IWB. I could be wrong. It might be IWN. I'll figure it out though when it happens. Let's see. Cinemark is down 1.01%. Doge is up 2.33. Bitcoin is up 2.29 and at 20.4 per 20.4K per coin. GME is up 0.82. HYMC is up 0.76. Hood is up 5.14. NCMI is down 10.68, and AMC is down 3.24 in the pre-market. Sorry, in the trading hours. So far, we've had about $4 million more in inflow than outflow, with 5 million shares having been traded after nearly 30 minutes of trading. Looks like we're going to have to go straight to Jerome Powell, and I'll have to pick up on that other portion later, Corbin, unfortunately. I'll tell you what, though, I will look for it while we're listening to Powell, and I can pause Powell at some point and then pull it up and play it. So give me a second here because I got to finish through the rest of this real quick. Let's see what kind of trading pace we're on for the day-to-day. In pre-market, I suggested we would see somewhere between 20 and 40 million shares. We're on pace for 71.7. Don't expect that to hold up. I just got a text from Eric. His final number was 1120 to 1420. Let's see here. On the weekly, there's more buying pressure than selling pressure according to the Hortex indicator. We have 37.65 for RSI, which is below average. On the daily time interval, we have more buying pressure than selling pressure with an RSI of 46.58, which is just about average. On an hourly, more selling pressure than buying pressure with an RSI of 40.17, which is below average. On a 30-minute interval, we have a divergence of the buying and selling pressure with more selling pressure than buying. within the last hour, which just changed. But that's RSI is at really low at 34.65, which is below average. On a 5-minute interval, we have more buying pressure and selling pressure, signaling oversold for quite a bit this morning so far. Currently showing 22.59 on that indicator. With that, real quickly on the Ichimoto, on the hourly, we had the conversion line dropping below the baseline and the lagging line dropping below the price line. This is not bullish. Price is actually now inside the cloud, not bullish at all, but it does mean that there's uncertainty about which way price would move from here. Taking a look at the 4-hour, again, uncertainty because we're inside the cloud. Conversion line is above baseline, and technically speaking, the lagging line is above price line, but it won't be by the next hour. So we would have to see price rise above, we'll say 12, 13. We'll have to say above 13 in order for this to continue to, or start looking like a positive buy signal. Volatility decreasing, volume being dropped. We are at not under 60K a minute yet. Getting there though. And let's see if we can't get Jerome Powell up here, see what it is he has to say.
Takeoff and cost in audiovisual check.
Good morning, Mr. Auchincloss. Are you good to go?
Sounds like they're doing audio checks. I don't know if this appears to be live. Is this not live? This doesn't seem live.
Takeoff and cost in
Let me re-verify the link that I've got here. Did I click on the? Oh, I clicked on the wrong one. All right, I got it.
The price of housing, gas, and groceries have skyrocketed. While it is important for the Fed to fight inflation, I would caution against any approach that ignores the Fed's maximum employment mandate and results in a recession with millions of people losing their homes and jobs. I hope you will also note that you should have noted that last week the House passed my bill, H.R. 2543, the Financial Services Racial Equity, Inclusion, and Economic Justice Act, which directs the Federal Reserve to consider the impact of all of its decisions, including setting interest rates on communities of color and underserved communities. Congress has a role in fighting inflation also. Housing is one of the largest contributors to inflation, and the housing shortage has allowed corporate landlords to hike up rents, forcing families to make difficult cuts elsewhere in their budgets. The Fed's interest rate hikes will make borrowing more expensive and thereby could help reduce
Can I put them
out-of-control
in the
housing
van?
prices.
I wonder if I could.
But without action by Congress, inflationary pressures will remain because there is simply not enough affordable housing being built, and there won't be until Congress makes necessary investments. That's why it's so important that we pass the housing title of the Build Back Better Act, which provides over $150 billion towards new housing construction, modernizing existing structures for the long term, and providing supports to people can be stably housed. We're also facing corporate consolidation and greed. Without healthy competition to drive down prices, mega corporations driven by profit are exploiting their economic power to squeeze Americans to the breaking point. Democrats in Congress put forth solutions to tackle inflation, but my colleagues across the aisle have consistently voted against every solution. Let me go over some examples. Democrats passed a bill with $28 million in funding to address the baby formula shortage, but Republicans voted no. We passed legislation to crack down on price gouging from oil, gas companies, and Republicans voted no. Last week, Democrats passed my Racial Equity, Inclusion, and Economic Justice Act, and you guessed it, Republicans voted no. Republicans can talk about problems, but they have zero solutions. Let's also not forget that the Federal Reserve has more duties beyond monetary policy. Bank mergers and banking deserts are affecting access to credit for low-income consumers and communities of color. And working families who turn to cryptocurrency to generate wealth are now seeing their hard-earned savings disappear. Now more than ever, the Federal Reserve must work with other regulators to properly oversee the cryptocurrency market and provide guidance on a more stable alternative to volatile cryptocurrencies. Lastly, the confirmations of Lisa Cook, Susan Collins, and Philip Jefferson are historic, but more must be done to ensure diversity at the Federal Reserve. So, Chair Powell, I look forward to hearing your testimony this morning, and I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes to give an opening statement. And for those who may have, please get muted so that Mr. McHenry can give his statement.
Thank you, Madam Chair, and thank you, Chairman Powell, for being back with us. A year ago, President Biden tried to buy support by signing into law a $2 trillion stimulus bill. What he did was sell out ordinary Americans who are now repaying all that quote-unquote free money. Inflation is the worst it's been in 40 years. American families are rethinking their long-awaited summer vacations because they can't afford a $5 a gallon price at the pumps. Costs are spiraling out of control for everything from housing and food to airfare, cars, medical care, and clothing. Democrats are still on the hunt for the scapegoat. They blamed oil companies, the war in Ukraine, and supply chain issues in Asia. But let's be clear. It's the Democrats' trillions in wasteful spending that resulted in higher grocery bills and soaring gas prices. President Biden continues to deny that the so-called American Rescue Plan contributed to inflation, recently calling that idea, quote, bizarre. Well, economists across the ideological spectrum, from former Clinton Treasury Secretary Larry Summers to Jason Furman to Michael Strahan, don't think it's bizarre. Even the left-leaning San Francisco Fed found that the American Rescue Plan contributed to price increases. So now millions of Americans need to be rescued from the Democrats' American Rescue Plan. I'm confident Chair Powell is taking this emergency seriously. And as I've said many times before, I think he's the right man for the job, and he is. But how the Fed manages the next few months will be as critical as any other period during the last 4 decades. No one at the central bank was prepared for prices rising at a clip of 8%, with even core inflation rising and running at 6% now. Republicans have long warned about the size of the Fed's balance sheet, but it grew by nearly $1 trillion over the last 12 months alone. And now it seems the previous predictions by the Open Markets Committee about economic projections are wrong, and they are altering course. Simply put, the Fed has its work cut out for it. Lastly, I want to address the left's ongoing efforts to expand the Fed's dual mandate. Republicans have been on the record opposing this, and I hope that the skyrocketing inflation unleashed under the Biden administration puts an end to these discussions. The Fed should be focused on price stability. That should be their single-minded focus at this moment in time. It's out of touch for Democrats to keep pushing mission creep at the Fed when American families are struggling to feed themselves and to get work. The Fed is a serious place with serious business to attend to. It needs to focus on the middle class, not the chirping political class. This was true before inflation broke out. It's all the more obvious to today. I hope that Chair Powell will deliver that message to his colleagues throughout the institution. And again, I want to thank Chair Powell for his testimony. Thanks for his willingness to engage with policymakers on the Hill. And thank you for his openness in what has been a more closed-off institution. We have a mess to clean up. And we know that you're taking your job seriously. I'm glad you're taking your job seriously. And with that, Madam Chair, I yield back.
Thank you, Ranking Member McHenry. I now recognize the Chair of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Connecticut, Mr. Himes, for 1 minute to give an opening statement.
Thank you, Madam Chair, and welcome, Chairman Powell. Congratulations on your confirmation. I don't remember a moment as consequential as this one for the Federal Reserve, or as potentially testing of its leadership. I think I have to go back to the end of 2008 and the first quarter of 2009 to think of a moment that was quite as important as Americans watched the economy collapse around their ears and their jobs and assets being lost. There is a very real possibility that Americans will be caught in a vice, an economic vice, not of their own making, between inflation, which makes their everyday lives unaffordable, and the possibility, much contemplated by economists, of a recession. Simply put, as one of the last members of Congress to get out of the chamber when it was under attack on January 6, 2021, I don't believe that our democracy can sustain either runaway inflation or another recession. And despite the rhetoric you'll hear all day today here, there's not a lot that we can or will do. Much of this rests on your shoulders. So Chairman Powell, I just ask that as you make your decisions, you think not just of the numbers and the economics, but of the importance of sustaining this nation's democracy.
Thank you, Mr. Himes. I now recognize the ranking member of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Kentucky, Mr. Barr, for 1 minute to give an opening statement.
As we face the worst inflation the country has seen in 4 decades, I am encouraged to have Mr. Powell leading our central bank, and I'm hopeful the Fed will rise to the occasion. At the same time, it's important to remember the following. Just last year, Democrats were ignoring inflation warnings to pass a $2 trillion stimulus bill. They were pushing the Fed to solve climate change and social ills, and they flirted with unconventional monetary tools like yield curve control. Today, as gas prices top $5 a gallon, these left-wing ideas seem like a fever dream from an alternative universe. But many Democrats fell for them at the time, and they'll likely pursue them again if inflation subsides. The lesson for the Fed is clear. It needs to focus on doing a limited number of jobs well and not get distracted by those who want it to be all things to all people. Specifically, the Fed should be laser-focused on its price stability mandate. And even as you acknowledge the risk of recession and as everyone desires a soft landing, I encourage the Fed to have fortitude to prioritize defeating this inflation scourge. Chair Powell, I hope you are hammering this message home at the Fed as ordinary Americans see their paychecks eaten away under Democrat mismanagement of our economy.
I want to welcome today's distinguished witness, the Honorable Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. Chair Powell, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. And I'll begin with one overarching message. At the Fed, we understand the hardship that high inflation is causing. We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Inflation remains well above our longer-run goal of 2%.
I'm going to stop that for just a second, guys, because I wanted to share with you what it was we said we were going to talk about. This is from yesterday's video live stream from Chairman Powell talking, and I'm going to have to turn down the volume on this a little bit. I have the volume cranked up all the way, I promise. You're getting full volume on this. I'm going to have to probably adjust the volume down here so I don't blow your guys' brains out here, but
happened with
let me get the volume correct
here. Cars
on
in
this one.
particular, you look there, it's been driven by semiconductor shortage.
Thank you, Chair Powell. Thank you, Mr. Chairman.
On behalf of the Chair, Senator Moran.
Mr. Chairman, thank you. Chairman Powell, thank you for your presence here today. Let me start just by...
Let me just find it.
...of that feeling and the inability to know what's around the corner is terribly damaging.
We're using our tools to do that, and the public should believe that we will get inflation back down to 2% over time. Again, there are factors that we don't control, but those factors do tend to wash out over time. Things like commodity prices don't tend to just keep going up. They may remain high, but essentially they're quite volatile over time. That's what the record shows. So we're doing what we can to get inflation down, the parts that we can address. So for whatever that's worth, that's what we can do and what we will do. In terms of the agricultural,
I may have passed it. I know I had it set up here because I saw what. Oh yeah. Son of a gun. Let me find what it is you guys wrote, because what you guys wrote was the important part. Could you play that again by myself? Well, when he said that, it was a little bit before this, so this might be it right here.
Extent on factors like how long does the war run and how long does it take supply chains to improve and that kind of thing. There's a lot of uncertainty around that. I would have a lot of humility about trying to predict with any clarity exactly where the economy is going to be in, the next 3 years, for example. But my assessment, though, is that there's certainly paths to get inflation down to 2% with outcomes that are substantially less, troubling than what you just read.
You've characterized a soft landing as getting back to 2% inflation while keeping the labor market strong. What's your confidence that the Fed can achieve this goal without causing a recession?
So I think that is our goal. That's our intention. I think it's going to be very challenging. We've never said it was going to be easy or straightforward. It's going to be challenging, and the events of the last few months have certainly made it more challenging. And nonetheless, there are pathways through which that could happen, and in particular, what we saw in the early part of 2021 when inflation went up was
this is it.
Very strong demand surged against what were unanticipated supply-side constraints, and the result was prices went up a lot, much more than could be explained by just the increase in demand. And so, in principle, if demand can move back down, then inflation could move back along that path just as quickly as it went up. In principle, no one's guaranteeing that, but the idea is this is not the same. There are relationships in the economy for how quickly inflation would move compared to demand moving. This could be an unusual situation because we have had what is in effect a vertical supply curve where there isn't any more supply, or a very steep supply curve. So you get really sharp increases in prices. You could get sharp declines for the same reason. So that could be a difference. And I think we'll find out, ideally. But ultimately, we need to see progress on the supply side, and we're not waiting for it. Our job and our tools work on demand. And that's what we're working on now, is getting demand down to a more sustainable level so that supply can catch up and is in better balance with demand.
Chairman Powell, thank you.
Thank you, Senator Daines.
That was not it.
Senator Ossoff, on behalf of the chair.
It's
Thank
like
you, Senator
right in
Tillis,
here. I know it
Mr.
is.
Chairman. Welcome back.
I stopped it and even replayed
Let me
it.
say at the outset, you have an extraordinarily challenging job in extraordinarily complex times, and much of what you are responding to and adapting to is beyond your control. Your success is the country's success to a significant extent. It's the world's success, and I fervently hope for your success and appreciate your continued efforts. I'd like to ask you to specify, if you can, what transmission mechanisms you believe are most sensitive right now to
considered and then implemented. So that should help on that front. I was thinking more of the Treasury market, for example.
Okay, here it is. Legit. Like I think he just basically said, admitted to bailing out Wall Street. Right there, that legit sounded like he basically said they're bailing out Wall Street until the SEC has everything in place to let things continue on. I don't think that I've ever heard an admission quite like that. I'd like to go back and review that for just a second, because I mean that really is what that sounded like to me. Let me just go back here like 30 seconds and re-listen to that. So what you're going to hear here is an admission by the Fed that they have basically been supporting or propping up the economy, waiting for the SEC to finalize some final rulings, in which case at that point they are going to stop supporting the economy doing what it's doing currently through whatever quote-unquote tools that they use. So listen to this very carefully.
Become illiquid.
Okay, maybe more than 30 seconds. Let's go back to 204. Let's go back a minute. 204:30. Here we go. Listen to this carefully.
Part of the financial system is critically very strong, and we saw that through the pandemic, and we see it now. To your point, though, capital markets did show real periods of illiquidity during the immediate aftermath of the pandemic, and so we've been looking at ways. I say broadly, the regulatory community has been looking at ways to address that.
So you remain concerned about money markets?
Well, that's a different. So money markets that's a part of the economy which where it has become illiquid because the assets that they were invested in were not able to be turned into cash quickly to fund depositors wanting to take their money back. So we stepped in and had to provide that liquidity for the second time. There are reforms going on there at the SEC which should address that, and they're in the process of being considered and then implemented. So that should help on that front. I was thinking more of the Treasury market, for example, which it became illiquid when at the very beginning when people wanted nothing but cash, nothing but the cash and most cash-like things. Treasury market has been functioning though all through this period when we've very significantly changed the stance of monetary policy. So markets have been functioning well, reasonably well, and
okay, my time's running short, and appreciate that. We'll probably follow up to talk a little bit more about financial risk with my remaining few seconds.
So that was it. I mean, he basically sat there and said, they're waiting for final rulings from the SEC that should take care of the liquidity problems in the markets. I'm going to go back through. I'm going to keep this up on my page here over to the side, and we can continue on with today's information. I'm going to quote that. I'm going to write down that quote on the side, I think, while we're listening to current day's no longer live hearing, and then just kind of get that quoted, and then that way I can read it back to you guys whenever you want to hear it, without me having to pull up the video.
2% over the 12 months.
This is live.
In April, Total PCE prices
Sorta.
rose 6.3%.
And the volume's up all the way.
Excluding the volatile food and energy categories, core PCE prices rose 4.9%. The available data for May suggests that the core measure likely held at that pace or eased slightly last month. Aggregate demand is strong, supply constraints have been larger and longer lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and fuel and is creating additional upward pressure on inflation. And COVID-19 related lockdowns in China are likely to exacerbate ongoing supply chain disruptions. Over the past year, inflation has also increased rapidly in many foreign economies, as discussed in a box in the June Monetary Policy Report. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we have seen in recent months should continue to temper growth and help bring demand into better balance with supply. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historic highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and price stability for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer-run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. In May, we announced plans for reducing the size of our balance sheet and shortly thereafter began the process of significantly reducing our securities holdings. Financial conditions have been tightening since last fall and have now tightened significantly, reflecting both policy actions that we have already taken and anticipated actions. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy.
I'm going to pause that right there and just show you an email that I just got from Fidelity. The next big thing, how to find opportunities with ETFs. They are really wanting people to throw money into the ETFs. Fidelity's heavily pushing this ETF. Dump your money here. This is where we need your money. This is the next big thing in how to find opportunity. They're heavily pushing this. They've got a 3-part workshop that they're going to start offering here that explores what exchange traded funds are and how investors can use them to capture the trends that could transform society. We'll close with an interactive discussion of the tools that investors can use to identify ETFs that best suit them and their financial objectives. They're really heavily pushing ETFs. Watch for trends with them. Where the market needs money is the things that they're going to push. They need money in the ETFs right now. They are at, it's a problem. There's obviously a problem going on.
We will make our decisions meeting by meeting, and we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook, and we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We're highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you very much, Chairman Powell. Chair Powell, at your Senate confirmation hearing, you were asked about the possibility that inflation is being driven by corporations in concentrated sectors of the economy. You said, and I quote, "That could be right. It could also just be, though, the demand is incredibly strong and that, they're raising prices because they can," quote, unquote. We're all seeing and feeling the effects of inflation on consumer pocketbooks, but corporate profit margins are not hurting. In 2021, the profit margins of the S&P 500 index surpassed 12%, the highest profit margin on record, and is expected to be even higher in 2020. Corporate greed and consolidation are driving higher and higher prices for consumers above and beyond any inflationary pressures. Just last quarter, Tyson Foods, which sells 1 out of every 5 pounds of meat sold in the United States, claimed that their higher prices are due to rising labor and freight costs. Yet, they still managed to net an additional $500 million in quarterly profits. When it comes to rents, a corporate landlord recently remarked, and I quote, "We have an unprecedented opportunity to really press rents on renewals because the country is highly occupied. And so, where are people going to go? They can't go anywhere. We have a tremendous opportunity to press both on renewing leases for existing residents and to reset market rates, which we've reset numerous times, even this year," end of quote. This kind of blatant profiteering on the backs of hardworking families is simply outrageous. Could you elaborate on the role that corporations play in setting prices and how that is affecting inflationary pressures today? Would you also elaborate on what you meant when you said perhaps corporations are raising prices, quote, because they can?
Son of a gun, I had the muted mic the whole time. Dang it. Yeah. I was on a soapbox. I'm sitting here just going off, and you guys are like, muted mic, hello? I'm going to side with her on one thing here. I'm just going to make this real quick. Company greed and not having a downturn in the market for this long is definitely part of the reason why we're here at where we're at. And so I can't disagree with what she's saying. However, the reason we're at this point right now is because of the fact that what we're currently seeing at this moment in time is an increase on interest rates in order to force a quote unquote soft landing of a market correction, a major market correction that should have happened years and years and years ago. So the idea that we can just tell companies that they need to just take a hit and tell them to suck it up and not raise interest rates, it's a little ridiculous. It's a little ridiculous. I think you have to force it. You have to force something to happen. So I don't know. I'm torn here.
Sure. So matters of concentration in the economy represent a series of interesting questions that are largely not settled. For one thing, it is clear that our economy has become more concentrated, largely due to lower levels of formation of smaller businesses. That has happened. It is not at all clear that there's a connection between a more concentrated economy and, for example, inflation. And of course, matters of corporate concentration are outside the jurisdiction of the Fed. Those are for the competition authorities and really not for us to discuss. In terms of why prices are going up, I think a lot of it has been, a lot of the places where prices have gone up quite a bit have been situations where supply is constrained and demand is very strong. And so take cars, for example. The demand for cars went up a great deal during the pandemic. People wanted to ride in cars rather than public transportation, and they wanted to move to the suburbs and things like that. Rates were low. The economy was stronger than people expected. But the companies couldn't really make more cars because they couldn't raise their output because of the lack of semiconductors. So when demand hits fixed supply, what happens is prices go up and margins went up. And so I think as the economy returns to normal, we would expect those profit margins to return to more normal levels.
Well, Chairman Powell, the example that I gave of Tyson, who said their prices were rising because of labor and freight costs, and yet they managed to net an additional $500 million quarterly profits.
I apologize. I'm having a hard time hearing your words. I'm sorry.
Okay. The example that I gave of Tyson Foods and the fact that they said that their prices were rising due to labor and freight costs, yet they managed to net an additional $500 million in quarterly profits. How do you explain that?
I'm not familiar with their profit and loss statement, but I will say, and again, there may be particular industries where there are competition issues. I don't know that. It's really not our focus or our authority.
Well, do you have the opportunity to look at rising costs and identify corporations where they are gaining substantial profits, yet they keep raising their prices? Do you have a way of examining that?
I think we can see that, but I think, our job is to keep, maximum employment and price stability. So we're not in the business of regulating individual companies or determining whether their actions, for example, are anti-competitive or that sort of thing. That's more for elected people and also for the competition authorities. So we do look at that, but again, I think a great deal of the price increases that you saw were a matter of supply being unable to meet demand, and the result was prices moving up. In many cases, that was the story.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Thank you, Madam Chair. I would, on this debate about corporate profits, I would commend to the committee Secretary Yellen's statement, where she rejects the idea of corporate greed, is to blame for inflation, and I concur. We have a complex set of issues. The fiscal house was certainly different than monetary policy, and the extraordinary nature of the partisan American Rescue Plan, and $2 trillion injected into a recovering economy, and Democrat policies to keep people out of the workforce for longer than the rest of the Western world also contributed to inflation. So that is a political debate here on Capitol Hill, Chairman Powell, and that is on the political side. What I want to ask you about are the policy tools that you are using. Now, certainly you, as chair of the Fed and the Open Markets Committee, took extraordinary measures in the midst of the pandemic to ensure that we didn't have further contagion, and including extraordinary lending facilities, purchasing securities, keeping the federal funds rate at zero. These were the right tools at the right time. On the fiscal side, you had to partner with bipartisan bills to keep our economy afloat during government shutdowns. But like all the good firefighting measures, we should put them away when times change. I want to talk to you as you put these measures away, how you expect the economy to respond. So let's start here. What is your level of commitment to fight inflation?
Well, so it's unconditional, our commitment is, and the reason is that we need to, in a particular situation, we have a labor market that's sort of unsustainably hot, and we're very far from our inflation target. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment, where the benefits are spread very widely and where people's wages aren't being eaten up by inflation. Really, it's something that we need to do, we must do, in order to have that kind of a labor market. We'll need to do it.
So as you pull back these emergency measures from COVID, and you normalize rates to what they look like sort of in the long run, how do you expect the economy to respond?
So when we raise interest rates, and also to a lesser extent when the balance sheet shrinks, what happens is rates go up across the economy and financial conditions generally tighten. And you can think of it as in interest-sensitive spending is an important place that'll be affected, and that's things like automobiles and other durable goods. If rates are higher, then demand for cars will moderate, will decline a bit. The second channel would be asset prices generally. We don't target any particular asset prices, but higher interest rates tend to bring them down broadly. That tends to mean a little bit less spending because people's wealth has perhaps declined a little bit. And the third channel can be the exchange rate, where that also has disinflation effects. So overall, we have these effects on the economy. Our intent, of course, is to bring inflation down to 2% while preserving a strong labor market. As I've mentioned, that has become significantly more challenging with the events of the past few months, particularly the war, which is driving gas prices up and raising energy prices and also food prices and disrupting supply chains further.
So at the same time, you have a massive balance sheet. First begin with mortgage-backed securities. As we have a roll-off of the Fed's balance sheet of mortgage-backed securities, what are expectations for how that affects housing?
Yes! I've been waiting for this question. Yes! Thank you, this guy. Who is this guy? McHenry. McHenry, thank you so much for asking this question. Thank you, sir. Thank you, thank you, thank you. Let's hear what he has to say to this. I got to hear this.
So I think what will affect housing is the rate. The housing industry and market are slowing down from a very, very hot pace, and that's partially because of higher mortgage rates. The effects of shrinking the balance sheet will be marginal compared to the effects that we're seeing and expect to continue to see from rates rising mortgage rates.
But what are your expectations and any further announcements? Can we expect further announcements on the assets you hold and the securities you hold? Or are there going to be
more
balance
purchasing
sheet, announcements in the coming weeks?
Are you going to purchase more or sell?
I would say this: we have a plan. We've articulated it. The markets are forward-looking. They see it. the markets are in a good place, I think, understanding what we're going to do, and that's we're going to be allowing these securities to mature and run off our balance sheet at a pace that we've said, and it'll be 90 or 95 billion, I guess, by September. Now it's about half of that. So that's what we've done, and we expect, the idea is that that'll just be on an ongoing basis in the background, and we think the markets can handle that. Treasury issuance is way down, so we think there will be demand for these securities. The Treasury will then reissue them in whatever form they think is appropriate when it relates to Treasuries. So,
Thank you.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chair, it's good to see you, and I know you'll hear a lot of probably political stuff going back and forth, but the American public is trying to understand the language of which we're talking today so that we can really understand what inflation is. Fact of the matter is, I just recently was over in Europe. There's inflation in Europe, just like there's inflation here, although as I talked to Christine Lagarde and others, they say the cause of the inflation may be different. So if the causes are different, they said that maybe demand here, but not a case of demand there, is to resolve inflation in Europe. For example, I was in Moldova, 30% inflation rate, gas $15 a gallon, Turkey 80% inflation rate, gas $13 a gallon, and I could name places in Europe, from Europe to the United States. Is it that we had, whether it was the supply chains, the China shutdown, complete shutdown, the zero COVID policy, Russia's war in Ukraine, COVID period, isn't just a massive storm of everything is what contributes to inflation and causes it all over the world?
Pretty much. Yeah, that's pretty good.
It's a little bit of everything, right? So if I'm talking to my constituents, trying to explain to them what inflation is and what causes it, I would not single out any one thing. I would probably have to talk about the conglomerate of things, because if you take away 2 or 3 of those things, we might not be in the situation here. All of it unprecedented, all of it really out of the control of anyone. We're out of control of Democrats, out of control of Republicans, out of control of the president, out of control of other governments. Is that not correct?
So some of it is out of our control. For example, the price of oil and most of the price of food. And to your point, Europe has much more. It's much more about energy and food prices. Very difficult problems, and also they, of course, have the European Central Bank has different countries, which and so they have to worry about the difference, the spreads between different countries, and that's a different challenge that we don't have here. We have the difference here for us is we actually have a very strong economy and well-recovered economy, and so more of our inflation is from demand, and we do have tools to deal with demand. That is the place where we actually can work, and that's what we're using our tools.
And some of that was because during the crises that we had to do certain things, stimulus and other things, to make sure that we kept our economy stable. I mean, if without doing those things, we would have been in trouble. So the things that we did going through COVID, the stimulus, trying to make sure people kept their jobs or kept money coming in at the time, was what we had to do. Otherwise, we would have been in worse shape or not have as strong economy as we have now compared to other countries. Is that not correct?
Yes, I would say it this way, that our inflation is a consequence of very strong demand, in part driven by supply, by what Congress did to support activity, in part driven by what we did, but also...
But that helped stabilize our economy at that time, right?
It did.
And if we did not do those things, our economy may not be as strong as it is right now.
I think that's right.
That's correct.
Our economy is strong.
And let me jump to something else real quick, because the one other thing, I know you testified before the Senate yesterday, and what concerned a number of my constituents that I talked to was the question about can we resolve inflation without increasing unemployment? Because our folks are concerned about losing their jobs and not being able to, it'd be worse if they were unemployed. So my question to you is, can you speak to what the Fed has seen during the last few years with respect to the relationship between unemployment and inflation? And is it possible that we can continue to have a strong labor market while also curbing inflation?
It's certainly possible that we can, and there is a relationship between unemployment and inflation. The challenge now is that inflation is at a 4-decade high, and some of it we can deal with, some of it is really going to be dealt with on global markets, the price of oil and that kind of thing, and we can't affect those. But the challenge is we're tightening monetary policy, and that's designed to drive growth down to a level that's more sustainable and lower, give the supply side a chance to catch up, and give inflation a chance to come down and bring inflation down. That's what we're trying to do. We don't have precision tools, and we raise and lower interest rates. It affects the whole economy through many channels, and so there is a risk that unemployment would move up from what is a historically low level, though. A labor market with 4.1% or 4.3% unemployment is still a very strong labor market. Today's rate is 3.6%, and there are 2 vacancies for every unemployed person. So that's a labor market that's kind of overheated.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Chair Powell, thank you for joining us again today. I just want to start by saying how sick and tired I am of the president's inflation blame game. One day it's Putin's fault, another it's the oil companies and the meat packers, or perhaps it's corporate greed. Now we're blaming other countries like Estonia, Turkey, Europe. I give you my avid assurance that no one in Missouri's 2nd Congressional District gives us a rip what the price of gas and groceries are in Europe. They care about what they are at the corner of Manchester Road and Weidman. No one in this administration is willing to accept responsibility for the dismal economic situation America is in today. Inflation, sir, more than tripled in 2021, from 1.4 to 7%. And from June to the end of September 2021, inflation hovered, I think, around 5.4%, and then began a steady increase until reaching an historic 8.6%.
Yep.
That is now crippling Americans' spending power today.
Should have started
Chair
easing
Powell,
back then.
when inflation remains steady at 5.4% during that period in 2021, what factors played into the Fed's decision to keep rates at nearly 0 during each FOMC meeting in June, in July, and in September of 2021, sir?
Yep.
So during the summer of 2021, just giving us hindsight, inflation was coming down month by month. If you look at monthly readings for CPI or PCE, they were coming down month on month on month through September. And so that I think, told us that our thesis that this was going to be a passing inflation shock was at least plausible. I think that the data turned pretty hard in October and November, and we very much changed our position, and since then have tightened financial conditions quite significantly. So it was a matter of a few months when we were really looking at this and thinking it's going to be passing. Most macroeconomists thought that it would be a passing thing. It turned out to not have been so far, and so.
But we saw it move from 1.4% to 5.4%. So I don't, we did have a steady period of time. I wouldn't say that it was declining, but I'm just surprised that we weren't moving more quickly at the Fed. I mean, I want to be honest, sir, that the Fed, I think, underestimated actual inflation. What do you think you missed?
Well, we did underestimate it. With the benefit of hindsight, clearly we did. So it comes down to this judgment that we had to make. It has really nothing to do with our framework or anything like that. And every central bank had to make this same judgment, which was looking at the supply chain problems and the shock to labor force participation, millions of people out of the labor force. We had to decide whether that was going to be a lasting thing or whether it would kind of turn around quickly. We had very high levels of labor force participation. Suddenly they're much lower. The thought was people will come back. As soon as COVID is over, we have these new vaccines. They're going to You
guys seeing this? 2.6 March, 4.2 April, 5.0 May, 5.4 June, 5.4 July, 5.3 in August, 5.4 in September, 6.2 in October, 6.8 in November, 7.0 in December. Like, is he literally talking about this right here? You saw it stop. You started to see it maybe go the other direction for 1 month, and then it went back up again. And you're historically going back to 2008, watching rates increase from 2008. They started at 4.3, went down to 4.1, back up to 4.3, down to 4.0, down to 3.9, up to 4.2, up to 5, up to 5.6, 5.4, 4.9, 3.7. Looks to me like they got control of inflation starting right around July. Right here. Huh. Interesting. So maybe if we just drew this line straight up all the way. 1 to 1.3, 1.8 to 1.7, 2.9 to 2.7, 1.7 to 1.9, 0.8 to 1.1. Looks like there's oftentimes a decrease anyways from July to August. So you had a 1 point drop, not even a 1 point. You had a 0.1 drop. And you said, oh, we got things under control? Okay. All right. Yeah, sure. I guess. I don't know. I think seeing this drop, maybe if it leveled out at 5.4 and it dropped down to 4.9, then maybe you could make that statement. But a 0.1 drop? I call BS, Mr. Powell. I call BS.
Americans are going to get vaccinated. We'll be done with COVID by the end of the year. So basically, these supply side issues, broadly speaking, just didn't get better. There were recurring waves, and that was the judgment we had to make. We knew it could be wrong, and I think when it started to look pretty wrong, we pivoted. And
Now,
we
President
pivoted
Biden
pretty hardly,
continues.
like 7 months ago.
President Biden continues to say that a recession is not inevitable, as his government agencies, and Dems in Congress continue to spend billions and trillions of taxpayer dollars, burden businesses with costly rules and regulations, and on top of it, the president refuses to unleash American energy independence. The president's policies continue to take inflation-taming options, I think, off the table and hamstring the Fed's ability to focus on price stability. President Biden not only limits the energy production here in America and spends trillions of our taxpayers' money, but he also threatens tax increases and promises to cancel billions in debt. How can you still say, sir, that the Fed has a pathway to a soft landing for the economy?
Well, that's our intention is to achieve inflation getting back to 2%, and
with all I've laid out,
a strong labor market. I'm sorry.
With all I've laid out, and the increases you're going to have to take.
So as I mentioned, I think that path has gotten more and more challenging, thanks to the effects on oil prices and food prices, really, and also the supply chains from the war in Ukraine. It was never going. We never said
Not
it was
just
going to
the
be
war in
easy.
Ukraine, sir.
Yes.
Well, it's the rise in energy prices and the rise in, which has been, began in the latest rise from February.
The latest rise. This has been going on for a year and a half. I appreciate the chair's indulgence. I will yield back the balance.
I want to give her a hug. Can I get a hug, Miss Wagner, please? I just want to hug you for that statement there. Yes, ma'am.
Balance of my time. Thank you, Chairman Powell.
The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for being here, Chair Powell. I greatly appreciate the opportunity to have a few thoughts with you, share some thoughts. In February of 2021, you indicated that millions of people were out of the labor force, which is what you've said today, millions. And with millions of people out of the labor force, the Biden administration and persons on my side of the aisle sought to do something about that, to help those who were unemployed. The inflation that my colleagues speak of has to do with unemployment, the help that we gave people who were unemployed at the time. Persons who are unemployed, Mr. Chair, they need help. They can't feed their families. Small businesses were screaming for help. We helped small businesses to get through a turbulent time. This was a pandemic. The vaccines had to be distributed and developed. That's a part of that inflation that they're speaking of. People needed rental assistance. People were literally going to be evicted by the millions, but for the assistance from the Biden administration and Congress. We wanted people to go to work. We provided some child care. If you want people to go to work, schools are closed. You got to help people through these turbulent times. They never talk about what the inflationary costs that they speak of really did, how it benefited American people who were suffering. They overlooked that. They weren't going to help, and now, since they didn't help, they're going to say everything that they can to demean the help that was given. No, they didn't vote for it. They don't extend the hand of friendship to people in times of need. So when they don't do that, they have to find a way to denounce the help that was given. It's really shameful. It's painful, and it's sinful to hear people use a term, inflation, to indicate that people who were unemployed shouldn't have received help. The small businesses that were begging for help shouldn't have been helped. Vaccines shouldn't have been distributed. People shouldn't have gotten rental assistance. They shouldn't get child care. Now, I would respect them if they would say these things, that these are things that they opposed. But they're not going to do that. They use one word, inflation. And unfortunately, our messaging to all of the American people has been somewhat lacking. But I want the people that I serve, who pay attention to the supermarket more so than the stock market, to know that when they needed this help, we were there for them. And Mr. Powell, you indicated that there were millions of people out of work in February of last year, just prior to this help being accorded people. I welcome your commentary.
I'm sorry.
I welcome your commentary.
You welcome my commentary. Sorry, I didn't catch the last part. So, you know, our job is maximum employment and price stability. We did what we did during the pandemic, acute phase and response, and you did what you did, and now we are where we are. And so we have a job to do.
Make us look good, Powell.
It's very important that we do it.
We
Not
did the
least
right
because
thing.
of the people you talk about. The people you talk about are really suffering from inflation now at the grocery store. And
tell them,
the
Powell,
only
it
way
wasn't
we
our
can,
fault.
Get back to that, get back to a place where inflation is low again, get inflation back down to 2%, and help those people is by trying to get demand and supply back in balance.
Let me intercede and say this. You said something that I find favor with. You said, we did what we had to do. We did what we had to do. We did what we had to do. We were the adults in the room who did what had to be done. Others who declined to do can now be critical. I yield back.
Thank you very much. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Thank you for holding this hearing, and thank you, Chair Powell, for your testimony and your time here today. Financial freedom is American freedom, and frankly, Americans do not have the financial and economic freedom they need to invest in themselves, their businesses, and their families. Unfortunately, Americans are too busy making ends meet to focus on anything else. Inflation is running rampant across the United States, with consumer prices rising 8.6% in the past year, the largest price increase since 1981. From fuel to meat to housing, my constituents and all Americans are suffering at the hands of this hidden tax, except it's not so hidden anymore. It's punching Americans in the face, as my friend Mr. Stile put it yesterday. So how did we get here? It's pretty simple. We gave up American energy independence. We locked down our citizens and businesses for nearly 2 years, pumped the economy with well over $5 trillion in what's called stimulus funds. And now, as we recover from the pandemic, we simply do not have the energy resources necessary to meet the increased consumer demand. There's a history of Democrat policies we can point to that put us in this position, from refusing to adopt an all-of-the-above energy strategy to recklessly passing $2 trillion in partisan spending through the American Rescue Plan, despite the fact that nearly $1 trillion of bipartisan relief was unspent. But the bottom line is we need solutions now because inflation is beating up the American people. We have to wake up and realize that we cannot continue these spend-your-way-to-prosperity policies. Everyday inflation threatens the financial security of American families, of our constituents. We need solutions. Let me just return to my point about the spending. In December 2020, we'd authorized nearly $4 trillion in bipartisan COVID relief. Yet just 3 months later, Democrats pushed through another $1.9 trillion with hardly any oversight mechanism included, even though a quarter of all COVID relief remained unspent. When President Biden was recently asked if the $1.9 trillion spending bill caused inflation, he said he didn't think the bill had even a minor impact and called the idea, quote, bizarre. Chair Powell, do you agree with the President's conclusion that the $1.9 trillion that was included in the American so-called rescue plan had not even a minor impact on the inflation we're seeing today?
I'm sorry, I wouldn't comment on what any elected official said, and it's really not up to us to score fiscal interventions.
Again, sir, if you would, respectfully, I'm not asking you to comment on what the President said. I'm asking you personally, do you believe that the $1.9 trillion American Rescue Plan did not even have a minor impact on the inflation we're seeing today?
We didn't comment on the Tax Cuts and Jobs Act. We didn't comment on the CARES Act, and we won't comment on that act. And from that standpoint,
it's interesting, sir.
Reclaiming.
It's interesting, sir, that you won't comment on this, but you were more than willing a year ago to talk about inflation as some transitory something that everyone has acknowledged now. It's going to be here for a while. Even though it seems like the President's Build Back Better package, this massive spending package, is dead on arrival, certain elements might not be dead. Chair Powell, do you have concerns that if Congress injects a new round of stimulus into the current economy, it could, and in fact will, add to the inflation we're seeing today?
Again, really, it's not our role to give you advice on what to do. You know, we report to Congress, not the other way around. We're sticking to our mandate and our mission, and we have a lot of work to do on that front, and not really giving you advice on what you should be doing. We take fiscal policy as something that comes to us, and we deal with it as part of everything else.
I'm very disappointed, sir. I mean, you are supposed to be in charge of the monetary policy of this country. You're now embarking on raising interest rates because that's the only tool you think you have left. This is not just a dog chasing its tail anymore, sir. This is a dog that's starting to devour its tail and its back end because of the debt that we are carrying. I want to thank you. You acknowledged we're in a bad spot. We're knowingly walking toward an even worse inflation, a recession, and God forbid, food shortages. Yet we're relying on old monetary policy tools to keep us from falling off a cliff. Sure, we can raise interest rates over and over, but the only way to curb in a disaster this bad is to raise interest rates to a catastrophic level, or as like Larry Summers suggested, we allow unemployment to go to historical highs. It's not feasible. We need to put ourselves on a strict spending diet. And we
Yep.
have to have strict oversight on the funds that Congress has already allocated to make sure not even one single dollar is going to waste. And we need to put control back in the hands of small businesses on Main Street. Thank you.
Yep.
The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Matt.
I'm going to go ahead and cover some numbers here. I'm going to pause it, and I will go back. NC Proud Dad asked me to go back to what Powell said at the very beginning of what it was he had asked there, and I don't want to ignore NC Proud Dad. Actually, let's go back and listen to just the beginning of what Powell said at the beginning of that last speakers, and forgive me for not knowing names. Let's listen to that real quick, and then I'm going to do numbers, and then we'll continue where we left off.
So, you know, our job is maximum employment and price stability. We did what we did during the pandemic, acute phase and response, and you did what you did, and now we are where we are. And so we have a job to do, and it's very important that we do it, not least because of the people you talk about. The people you talk about are really suffering from inflation now at the grocery store, and the only way we can get back to that, get back to a place where inflation is low again, get inflation back down to 2%, and help those people, is by trying to get demand and supply back in balance.
Let me intercede and say this.
You did what you did, and now we're doing what we're doing.
Congress has already allocated to make sure not even one single dollar is going to waste.
I like what that guy had to say right there. I really did. The feds are spending money right now, keeping this economy afloat, and what we need to see is we need to see a failure in the economy. Don't spend more money to continue to back this up. Let the economy fail. If you want truly for a capitalistic economy to work, you have to let it go through cycles. You have to. You cannot prop it up. If you prop it up, you're asking for a bigger problem the longer you prop it up for. Let it fail, and you can get to recovery much, much faster. It's going to suck. It is going to suck, but we got there. We got there together, and we'll get through it together. But you got to let it fail. You can't just keep propping it up. Let's run through the numbers. I'm going to refresh Fidelity real quick here. My wife's hard at work making tortilla soup, chicken tortilla soup, and it smells so delicious. All right, taking you guys over to the other page real quickly. We'll cover these numbers real fast, get this out of the way, and then I can start that back up and take my break. Let's see what we got going on here. Give me 1 second while I move a couple pages around. Taking a look at off exchange. By this time in the morning, I would expect to see off exchange somewhere around 49% in the off exchange and about 10 to 11%. Wait, 10 to 11? No, 11 to 12% in the EDGX. Currently, we're at 48.89 in the off exchange, and the EDGX is at 10.19. These are extremely average numbers. Very average numbers for off exchange. 59.08 is the percentage. There's a very good chance today that we see the off exchange lower than normal, which should be a price increase. Provided that we have buying pressure, I would expect to see some kind of price increase based off these numbers. We'll have to see what happens here. Currently in Borrowed amount for the day today, it was 158,000 shares. It's now down to 126. Cost to borrow averages at 20.34. That 126 is going to pretty much keep our estimated current short-term interest of the free float at 22.57%. For those of you who are just joining, we did have a decrease in shares on loan day over day. It's down to 192.19. About 1.2 million shares had been returned overnight. Taking a look at options. Okay. Taking a look at the options, highest amount of volume currently at 12.5 for the calls. That's down half a dollar from what we had earlier. Total amount of, but there's real close. It's really close. There's 12,000 contracts at 12.5 and 11.2 at 13. So it's really close. But 12.5, there's 12,000 contracts, up from 4.8. And on the puts, highest amount of puts is at a $12 strike price. It went from 1.9 thousand contracts to 5.1. So almost a 2.5 to 1 ratio in puts versus calls. Market now signaling for a closing price somewhere between 12 and 12.50 for the day today. Currently, AMC is being traded number 14th most heavily traded stock in Fidelity by order, with a 74% buy to 26% sell ratio. And GME is 28th with a 58% buy to 42% sell ratio. Trigger price for SSR for the day today is $11.34. Shares available to borrow in the last hour. Let's see, they borrowed another 5,000 shares there, and out of the ETFs, maybe another 1,000 shares or so. So nothing I'm going to count yet. If we see another 5 to 10,000 shares being borrowed, I'll probably increase by 50,000 because I've not counted them for 2 hours. But so far for the day, we've seen about 350,000 shares borrowed. The fees are at 17%. They were 18.6 earlier. 124.3 thousand contracts are out of the money on the calls versus 8.3 thousand contracts that are in the money. 31.8 thousand contracts are out of the money on the puts versus 12,000 contracts that are in the money. Ooh, is that for real? Let me refresh this real quick. Excuse me a second, I gotta sneeze. NASDAQ is up 1.48, Dow Jones is up 0.52, and the S&P 500 is up 0.87. The market is advancing over declining with 4,208 advancers to 2,589 decliners. The market is not doing what I thought it would do over these 2 days at all. The VIX is up 0.17. However, the market is up even with the VIX being up, which is kind of odd. IWM is up 0.85. Tesla is up 1.19. Amazon is up 2.55. Cinemark is up 0.29. Doge is up 3.05. Bitcoin is up 2.75 at 20.5K per coin. GME is up 3.31. HYMC is down 2.26. Hood is up 7.21. NCMI is down 9.63. And AMC is down 3.02. Refreshing inflow versus outflow, we currently have $3 million more of inflow than outflow. Currently traded 13.06 million shares for the day today after 109 minutes of trading. Putting us on a pace for about 46.7 million shares traded for the day today. I suggested in pre-market 20 to 40. So we're probably going to hit those numbers for the day. On the weekly, we have more buying pressure than selling pressure with an RSI of 37.61, which is below average. On the daily time interval, we have more buying pressure than selling pressure with an RSI of 46.33, which is just about average. On the hourly, we have more selling pressure than buying pressure with an RSI of 39.19, which is below average. On a 30-minute interval, we have more selling pressure than buying pressure with an RSI of 33.06, which is very below average. And on a 5-minute interval, we had a crossover within the last 15 minutes with more buying pressure than selling pressure and an RSI of 42.8, which is slightly below average. Let's kind of pull back out here, see where it is. Looks like we had this big drop here in the beginning portion of the day today. Looks like we consolidated between $11.97 as a support and $12.42, which is now a level of resistance that we've hit almost three times. Looks like we're doing just a bunch of consolidation at this price point. I very highly believe that I will be extending this wedge out further and further as time goes on. Just trying to get an idea for when we may see a breakout on one side or the other of it. Ultimately, we have price falling and is this, hold on a second, I gotta check something out real quick here. I feel like today is a very, very opposite looking day to yesterday. Let me just check this on TradingView real quick. I'm kind of curious. I was just kind of curious if we were kind of following like a mirrored and flipped version of yesterday's pattern. Not quite, but it was kind of, it had some, I was seeing some very similar references, what looked like similar reference points here on the beginning portion of today to the ending portion of yesterday. Not quite. Let's see what happens at 11:38 Eastern Standard Time. No, I take that back. This might be my time. Yeah, Eastern Standard Time. Let's call it 11:30. Let's see what happens in the next 7 minutes. I wonder if we're going to have another breakout very similar. Watch for this to move upwards potentially in the next 7 minutes, 6 to 7 minutes. And I'm gonna head to break, guys. I want to hear what Jerome Powell's saying as well, so I'll still be here, but I'm just gonna be off to the side. If I gotta make a comment, I'll make a comment. We're still in the squeeze phase, MG Toe. I know it feels like it. let me read through. I'm going to start with where Ray Mills said during Clinton administration we didn't have all of the far left green nuts. You know what, Ray? We got nuts on both sides. We really do, man. Bunch of nutty people everywhere. You know what they say? Point a finger, and you got 3 other ones pointing right back at you. Balaclava, my policy on that. I won't comment on that. We know it's not 100% correct, normal cat. We know that to be the case. But tracking it consistently, I think, helps us give an idea as to where, over time, it's been moving to and what's happening. So it's not a factor of how accurate it is of the complete big picture. It's more about which way is it trending. I'm not sure what time he's done speaking Balaclava, but I'm just going to continue to play it, though, for as long as he is. All right, I'm going to turn off my camera and mic and kind of sit back and let Congress, the Senate speak for me. Can you please tell us the process of switching from R2 to R1? Yeah, I guess I'll briefly state what needs to happen. They're going to sell off their ETF positions from the Russell 2K, and then they're going to buy them back in at the levels to where the market cap is for AMC's position once it moves into the Russell 1K. So basically, what they do is they take the 1,000 securities, and then they rank them based off of market cap, and wherever you fall in position is what percentage or portion of holdings that are going to be affecting the ETF. So there's going to be a rebalancing of all of those and what do they call it? Reconstitution. And when that rebalance happens, we're going to end up on the bottom half of the list. I can almost guarantee you. I don't know exactly where it is that we're going to fall in. We'll probably find that information out later, but I can almost guarantee it'll be the bottom. I'm guessing the top of the 1/3. That's where I'm kind of guesstimating. So as it stands right now, we're really high in market cap for the mid caps. So that means we have a higher holding. For example, like in IWM, I think there's 11 point something million shares in IWM. When they sell those shares off and then have to buy back into the IWB or IWN, I'm not sure. It's probably going to be IWB. When they buy into IWB, it's going to have to be for a lesser amount of shares, which means some shares are going to be put into the market. I think that's the part I never really fully nailed down, but I think that's what's going to have happen. And if they do, I know there's a big demand for shares right now, and it should cause some. We should see some volume. We should definitely see some volume, but I don't think it's going to happen until the later portion of the day. Historically speaking, whenever they have reconstitution, it ends up being most of the volume tends to hit in the later half of the day, normally, or in the aftermarket hours. So that's what I'm expecting to see happen. All right, I'm going to go ahead and switch off here and put Powell back on.
Committee on National Security, International Development, and Monetary Policy is now recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, if you'll indulge me 1 minute. It's important for the American people to understand what's being said here today, because it's being said in other rooms in this building. What the American people are seeing today is something that my Republican Party friends have given over to recently all too often, and that is rank dishonesty in the service of acquiring and retaining power. A party without any resilient or discernible principle has stumbled upon inflation. There's inflation all over the world. Germany, Japan, Africa, South America, the United Kingdom. There's inflation all over the world. But the Republican Party has decided that inflation is Joe Biden's fault, or the American Recovery Plan's fault. I've read the monetary policy report from start to finish. It gives the Russian invasion of Ukraine, supply chain bottlenecks, high fuel costs, high wage growth. It does not mention Joe Biden or the American Recovery Plan. By the way, the American Recovery Plan is a particularly rank piece of dishonesty. Set aside the fact that it cut childhood poverty in half. As Mr. Green pointed out, if that isn't something to celebrate and to perhaps have the slightest bit of humility as you attack it, I don't know what I can do for you. The American Recovery Plan, as Mr. Emmer pointed out, was about 1/3 to 1/4 of the fiscal efforts that this Congress made on a largely bipartisan effort to lift our economy to the point where it is today. The chairman said, strong and well recovered. Unemployment at 3.6%. So many jobs out there that many of them are going unfilled. Did we overshoot? Maybe we did. But the American Recovery Plan, this thing that cut childhood poverty in this country in half, was about 1/4 to 1/3 of the fiscal efforts. The other money was supported by President Trump. But by the way, it's not those dollars that are still sitting in Americans' bank accounts. It's not CARES dollars. No, that was supported by the Republican Party. It's only those dollars in the American Recovery Plan that cut childhood poverty in half. Energy prices. I read the monetary policy report. I'll quote it. Because of the Russian invasion of Ukraine, oil prices rose sharply. I've been around here long enough to know that putting facts and truth out is like spitting into a hurricane, but it's important for the American people to understand that. Mr. Powell, I released yesterday, I hope you got a copy, a white paper on a central bank digital currency. It's offered with humility because we have a lot of issues to work out, but I hope you've had a chance to take at least a quick look at it. I wonder if you have any reflections, or importantly, what are the next steps now that you've gotten commentary from lots of people? What's the next steps with respect to the Federal Reserve thinking about a CBDC?
So I did have it. I printed it out. I have it here. I have not had a chance to read it carefully, obviously, given all that's going on. But no, so I think generally we're doing a great deal of work. The President signed an executive order, and administration, parts of the administration are working on this. I think it's something we really need to explore as a country. It should not be a partisan thing. It's a very important potential financial innovation that will affect all Americans. And our plan is to work on both the policy side and the technological side in coming years, and come to Congress with a recommendation at some point. And we don't prejudge what that would be. I know your views are very positive on it. But I think one thing I did see in your report was the beginnings of thinking about how Congress might authorize it. And I do think that's a very, very important aspect of this, and it's great to have Congress starting to think about that.
Thank you. Thank you. I think I agree with that, and I think that has bipartisan support. In my remaining minute, I'm going to ask you a question I ask you a lot, Mr. Chairman. We're obviously seeing pretty dramatic swings in the financial markets. Money is no longer free. We're seeing that in the SPAC market, the high yield market, the equity markets, cryptocurrency. In my very short remaining time, Mr. Chairman, what should we be focused on? What is concerning you with respect to systemic risk that may develop in the face of rising rates and rising inflation?
So, basically the financial markets have been functioning well, and the banking system in particular is very strong, well capitalized, lots of liquidity, better understanding and management of its risks. The place where there have been issues, and we don't see them elevated at this point has been illiquidity in some markets relative to where it had been historically. But
Any markets in particular where you worry about illiquidity?
No, I wouldn't say that we're seeing anything that's particularly concerning. But I think sort of systematically, liquidity in the Treasury market has come down from where it was, and we've been looking for some time at ways to address that. But the markets are clearly functioning reasonably well.
Thank you. Thank you. My time has expired.
Thank you. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
I thank the chair. Chairman, thank you again for being here. According to the Congressional Budget Office, the federal government will spend an average of $545 billion per year, which was the estimate before rates went up. And these are on interest payments on the $31 trillion of national debt. So that's $545 billion is more than we spend on the Department of Veterans Affairs. So given that the national debt is currently at about 125% of GDP, with the Fed's commitment to tackle inflation, would that be limited by rising interest rates, making the servicing of the national debt even more expensive?
No, absolutely not.
Explain that.
No, we are, we're not in a situation where we need to consider fiscal questions like that. The U.S. is on an unsustainable fiscal path, meaning the debt is growing faster than the economy, but it's not in an unsustainable position. We can service our debt, and the markets understand that, and we can conduct our policy without thinking about questions of fiscal sustainability, and we do.
When your colleague, Secretary Yellen, was before this committee, she told me that federal debt, which was then about 105% of GDP, she said, quote, "That's not a number that I think is fiscally irresponsible." She also went on to say, quote, "If interest rates are zero, we could substantially have a higher debt burden." And in the formula in the following question, she alluded to Japan and the fact that it could be about double of where we are now, meaning about $60 trillion of debt if you use her math. So do you agree with Secretary Yellen that having a national debt of over 100% of GDP is fiscally responsible, given that interest rates can change and that historically low interest rates can't always be expected?
I guess I would say it this way. We're not on a sustainable path, and we haven't been for some time. And that means that simply the debt's growing faster than the economy. By definition, that is unsustainable. There will be a point at which it becomes a problem of servicing the debt. We're not at that point. We're not close to that point. But we will need to get back where revenues and spending are better aligned. We don't need to pay the debt down. We just need to have the economy growing as fast or faster than the economy over a long period of time, and we must do that. I wouldn't say any particular level. There is no level that I can point to where there's a lot of science behind it being a problem, but we know that the path is not sustainable.
It's interesting that you allude to growth being part of the solution. I want to talk about regulation for a minute, particularly since the Biden administration delayed oil and gas lease sales again this week due to environmental protests. So if we pursued policies to increase American energy production by approving more leases and building more pipelines to transfer that energy and cut down on regulatory barriers to make it easier for folks to produce energy and produce anything, wouldn't that make a real impact on energy prices and inflation in general without us needing to use the Fed to slow the economy with monetary policy to deal with inflation?
So these questions of the whole set of questions around energy are really questions for elected people. We don't have a mandate there. Obviously, the more supply there is, the price of something can go down. But these are trade-offs that you really have to weigh as elected officials, rather than.
I'll narrow it just for a minute. Do you believe that the vast amount of regulation is an impediment to economic growth?
I will say this, we try hard at the Fed to weigh the costs and benefits of regulation, and we do think it's important to think about it that way, because there are benefits to regulation, but there are costs, and we don't want the costs to be any higher than they need to be, because that does weigh on economic activity. Yes.
I mean, when you talk about somebody trying to buy a home and now they're questioning it because of the rise in mortgage rates, and then I hear for years that the 25% of the cost of a new home is due to regulation at some level. So that's the point I'm trying to make, is that we need to be very cautious with our regulations, because a lot of, it's constraining our growth, and the growth ultimately which solves this fiscal problem. So the point I'm trying to make is that we have much better tools like deregulation, which can free up supply, rather than just monetary policy. And freeing up supply could largely solve the inflation problem for hardworking Americans and not send us into a recession. So again, I thank you for being here, and Chairwoman, I yield back.
Thank you. The gentlewoman from Iowa, Mrs. Axney, who is also the Vice Chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chair Powell, for being here. It's good to see you. We've been talking inflation, of course. We know it's hurting Iowa families and families across the country, and all of us here have an absolute responsibility to address this. And I appreciate the comments of my colleague, Representative Himes, because I've sure heard a lot of talk about how bad inflation is from my colleagues over there on the other side of the aisle, but I sure haven't heard much about the solutions that they want to provide. So I'm here to work on those solutions, and I'm glad to have you here to talk with us about that. We actually need to reduce inflation, and we've got to figure out what's driving it. So the San Francisco Federal Reserve Bank just put out some research yesterday looking at how much inflation was driven by supply versus demand. What they found was that supply factors are responsible for more than half of the current level of inflation. And of course, I don't need to tell you that while prices increasing are hurting people across a heck of a lot of sectors, gas prices have really been driven up over the last few months. So, Chair Powell, on gas prices, could you talk about some of the supply constraints that have pushed gas and energy prices higher recently?
Sure. So, two big things would be, just one, the price of oil is set globally, that's one. So we just take that price, and the second piece of it is the spread that refiners earn. So if refinery is at capacity and spreads are high, then you have a high spread there, and we know that the price of oil went up quite a bit. Started going up early in the year, and it's now come down a little bit in the last week or so. But those are the two things that have contributed to the spike in gas prices that we saw. We did see gas prices moving up, but they really moved up quite sharply beginning in the early parts of this year as the war came into focus.
Thank you. So you talked about a couple of pieces where folks are making more money, and you talked about the refining process and that crack spread, and I think they're around $60 right now. So basically what's happening is they're making more money because supply is down. So would you agree that increasing the supply of gas could meaningfully lower prices?
I'd say it's hard to argue with that. Sure.
Okay. Well, the U.S. hasn't built a major refinery since 1977. So, of course, as we know, this isn't a recent issue. It's a long-term lack of investment. And so with so many parts of our economy, and you actually touched on that earlier. Now, here's the question I'd like to ask you. Will raising interest rates help increase supply here with fuel? And are there other economic tools to do that?
No, we can't have any effect on the price of oil or certainly the supply of energy. And the tools are in the hands; they're not in our hands.
Okay, thank you for pointing that out. So I know that the Fed absolutely wants to play a role in bringing inflation down, but I want to make sure that we are looking at those solutions and trying to understand what better tools we have. Are there better options out there that you could suggest right here?
Honestly, we're an agency with a narrow but important mandate and a set of tools, and our focus is on using our tools. We think there's a job to do on demand, and I don't see us giving advice to Congress or other agencies on how they might use their tools.
Okay, well, I appreciate that, and hopefully at some other time we can talk a little bit further about that. I want to move on to housing here as well. In the 2010s, we saw less homes built than each of the previous 4 decades, and we're more than 5 million homes short of where we should be. Boy, do I see that all over Iowa, in small towns in particular as well. I've talked to businesses that want to expand, but they can't do so because there are not enough houses there. And so housing is one of the most sensitive areas relative to interest rates. So I want to ask the same thing here. Will raising interest rates help supply there? And are there other tools that we should be looking at to do that?
So I would agree with you. There's a problem with longer-term housing supply and the difficulty of creating adequate housing. What our tools can do is they can, in the near term and medium term, they can restore a better balance between demand and supply in the housing market. You've had extraordinarily high housing price increases really across the country over the last couple of years, and that's because of a lot of demand and very low rates. And you're seeing the housing sector slow down to some extent because of higher mortgage rates now.
And so do you have anything that we should be on our radar or that we could be looking to do to assist with this?
I do think that these are issues for Congress around housing supply. If you talk to builders, and we do talk to builders, we had a group in last week, they will talk about the longer term issues, lack of supply of lots, lack of workers, lack of appropriate zoning and things like that. I mean, these are national issues.
Thank you.
Thank you so much.
The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Morning, it's a pleasure to speak with you again. Before we get started on my questions, I just wanted to comment on Representative Axney's testimony or conversation or questions. I love the fact that she's beginning to recognize how heavy the regulatory burden has been in the refining space that has led to an underinvestment, and the Biden war on energy, especially on American-produced energy, continues to bear the fruit that they expected. And that is a deep concern for Americans that are paying more at the pump. We collectively find ourselves in the present situation because we fail to anticipate the future, even if that future is inherently uncertain and probabilistic. You said a few moments ago, we have a job to do on demand. I like that. And in the recent past and present, the policy signals, I feel like, have been unambiguous for the Fed. Inflation's at a 40-year high. The labor market is robust. Unemployment bouncing along multi-decade lows. Economic growth has been very high. But I worry that that lucidity is a luxury that is fleeting. I believe the future will be more ambiguous as we head into a time where economic growth seems to be approximately zero and labor market weakness is beginning to emerge. I think those policy signals will be less clear going forward. Economic growth in Q1 was negative, albeit for reasons I think you called technical in nature, but still negative nonetheless. Q2 economic growth is currently projected to be approximately zero according to the GDP Now tracker and many economists. Weakness in the labor market, while nascent, is beginning to emerge. Still yet, inflation as a lagging indicator remains, as you put earlier this week, very, very high. I've certainly praised the Fed's tardy yet sudden total focus on price stability, which will come, as you said, at the cost of aggregate demand reduction. Technical reasons or not, America will feel aggregate demand reduction where GDP growth is already zero as a recession. So I am curious to hear your thought process in an environment where inflation is steadying or coming down, but still yet at multiples of your target, and unemployment is escalating quickly and economic growth is negative. Tell me a little bit about how you'll think about that environment and approach that from a policy and rate setting perspective.
I guess I'd start by saying that that's not the environment we see or expect. We actually do think that growth this year, in the second half of this year, should still be fairly strong. It is coming down from the very high reopening levels of last year, but the first quarter was somewhat anomalous. Private spending was actually at a very healthy level.
Tell me about how you'll think about that environment. I assume that you could be correct, but there's a chance you could be incorrect about that soft landing prediction.
So the way our tools work, what we're trying to achieve is to have a moderation in demand so that supply can catch up, and so that'll take pressure off of resource utilization, and inflation can come down. That's what we're trying to achieve.
But inflation will come down after that fact. Demand will come down first. Inflation will lag that, where inflation remains multiples of your target, but unemployment, because of that sagging demand, goes up. economic growth is depressed because of that sagging demand. Tell me how you'll think about that environment.
So the way we think about it from a policy standpoint is of course, we raise interest rates and shrink the balance sheet. That affects broad financial conditions.
Indeed.
And that affects the economy. So the question we'll be asking is our policy rate, that's the thing we control, is it at the right level so that it's affecting financial conditions in the economy in the way that we need and intend? And
I
that
want to
is
know how you will intend to affect them where unemployment is going up and economic growth is negative, but inflation remains high.
Well, I think you would, in that hypothetical situation, I
Yeah.
think you would say that would be a setting in which inflation could be expected to come down. As I've said, we'd like to see inflation coming down as well. So the question is, you've got
So
choices.
you could move
You
rates down or steady rate escalations in advance of inflation hitting your target as long as you saw it beginning to come down. If economic conditions or your other mandate, full employment, begin to show weakness.
As one of my colleagues used to say, at every meeting, it's the same question. Do you raise, leave them the same, or bring them down rates, right? So I think, I think we'd have to see what's happening. We'll try to make good judgments in real time.
Right.
But the main thing is we can't fail on this. We really have to get inflation down to 2%. So we're going to want to see evidence that it really is coming down before we declare any kind of victory. And so I think we'd be reluctant to cut.
Well, this will
until we
have real
saw.
cost to Americans, so I want to make sure that we're forward thinking about what is going on in the real economy, not just watching a lagging indicator that is inflation. And with that, I'll yield back.
Thank you. The gentleman from New Jersey, Mr. Gottheimer, who is also the Vice Chair of the Subcommittee, National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Mr. Chairman, the most recent Consumer Price Index report indicated that the largest component of the CPI, shelter owned and rented, has increased 5.5% since last year. Estimates I've seen show apartment rental costs up 15% or more over the last year. Do you believe the CPI measure of shelter costs understates the actual increase in housing costs? And do you have any suggestions for actions Congress can take to lower housing costs for Americans in the short and long term?
There's some sense in which it might understate costs because it's not capturing leases that haven't turned over yet, right? So it's really looking at leases that are turning over.
So probably it's a higher rate.
Overall, we think it's a decent measure. It also remember that in the CPI, housing services has a weight that's double in the measure that we look at personal consumption expenditure inflation. We think that's a better, more sophisticated, a better representation of the inflation that's actually happening in people's lives. So we would tend to look at that.
Thank you, Mr. Chairman. I do want to shift to another issue that's covered in your June report. I've been engaged in discussions on cryptocurrency policy and have long warned that a run on stablecoin has the potential to stabilize financial markets. My concerns were realized in part last month when the so-called stablecoin terror collapsed. Your report highlighted the danger of that event and called for congressional action to protect consumers and financial markets. My draft legislation, the Stablecoin Innovation and Protection Act, would establish a definition and requirements for qualified stablecoin and define as cryptocurrencies redeemable one-to-one for U.S. dollars. This legislation would reduce financial instability in the markets and protect consumers and support innovation in fintech. It would create also a pathway for banks and non-banks to acquire qualified status for the stablecoins they issue. With federal oversight, do you believe non-bank entities can be reliable issuers of qualified stablecoins if they can prove they are fully backed by cash or cash equivalents?
So, as you know, we've recommended that Congress look at this, and there are many approaches, including yours. The President's Working Group did recommend that stablecoins be issued by insured depository institutions. I think it's great that Congress is looking at different approaches and evaluating those questions. What you really want, though, is you want to be sure that those entities are appropriately regulated, and in our view, in some sense, at the federal level. So, but I think that's going to be a question for Congress. You know what the PWG came up with, but I think there are different approaches.
Do you have any views on who the primary regulator should be at all? You think that's all up to Congress? Like, would the OCC would you have a problem with the OCC being a primary regulator?
For national bank charters, yes, but I mean, the thing is, stable coins are used now principally in the capital markets, as you know, around the platforms, the digital finance platforms, and that's more in the bailiwick of the SEC. If there were going to be payment stable coins, we should be involved, and if it's going to be about banks getting involved, it'll be the banking regulator. So I think it's going to be, we're blessed by a plethora of regulatory agencies in the financial sector, so that'll need to be sorted out.
you think that's something, given the challenges we've had in the last months, that's something we have to move quickly on? Are you concerned with how long it's taking Congress to actually act there?
I think it's very important. It's no different than any other big technological innovation. You know, airplanes, for example, there comes a point at which a new regulatory framework is needed to protect the public and create, you know, preserve innovation and competition, foster, support all that. But that time is coming for digital finance, and I think I'm encouraged that there are now a bunch of bills and you know, proposals, and that Congress is working on this. I think it's important that it get done, you know, quickly, because as we've seen, these companies can grow really quickly, and we've also seen that they can have reverses as well.
And you think overall the ideal role of the Fed in overseeing stable coins is what? What ultimately you think long term, what's the role of the Fed?
Well, you know, so the one question is around CBDCs, right? Is do we want a private stablecoin to wind up being the digital dollar? And I think the answer is no. If we're going to have a digital dollar, it should be done by us. We don't know that we need a digital dollar as such yet, but I think that it should be you know, government guaranteed money, not private money that is really created for the benefit of the private issuer. So that's one thing. I think also we're very important in payments. So anything to do with payments that the public is involved in, we should be involved in that too.
Thank you so much. I yield back. Thank you.
Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry, for holding the hearing today, and thank you, Chair Powell, for being here with us. A few moments ago, Mr. Himes noted that the American Recovery Plan, I think he meant American Rescue Plan, is not mentioned in the Monetary Policy Report. Chair Powell, is it Federal Reserve practice to comment on bills passed by Congress in the Monetary Policy Report?
No.
Turning to a question that we've obviously talked a lot about today already, you have inflation and rising prices on things like food and fuel are having a devastating impact on people all across Middle Tennessee and indeed across the country. You have told us that you will not comment on fiscal policy, but you have also previously urged Congress to support fiscal spending, some of which caused this inflation, in my view. Democrats are still pushing a reckless spending proposal, although reports are that it will be smaller than the one they tried to ram through Congress late last year. So, Chair Powell, will you commit to pushing back as strongly against reckless spending proposals that would exacerbate the current inflation as much as you push Congress to support more fiscal spending during the pandemic?
So I didn't support any particular bill, but I did say that there was more to be done. And I, by the way, I completely ended that practice at the end of 2020. Was it 20 or 21? Anyway, 2020. I completely stopped talking about that publicly at all. And the reason I did it before was, first of all, I was being encouraged by leadership on both sides of the hill in both parties. They were asking me for ideas. Don't you think we need to do something more? Can you help us? That kind of thing. But that's all done. That's over with. And the Fed should not play or seek to play a role in fiscal policy. We have our own mandate. We sure need to stick to that now.
In light of that statement, would you agree with this statement that the analysis that the Fed had through much of last year and that the administration to some extent continues to advance, with respect to inflation and the policy prescriptions has proven to be far more transitory than the inflation itself?
Well, if I understand your question, we did think that these were going to be passing forces. We thought that these shocks that were hitting, and supply-side shocks, we thought they would be like oil shocks have been, where they come and go, and other supply-side shocks, commodity shocks of various kinds. As the course of 2021 went on, it became increasingly clear, particularly in the fall, that wasn't going to be the case. We weren't going to see that kind of progress, and we pivoted, 7 months ago now. We pivoted to address this with our policy tools. I think our judgment in real time proved to be incorrect, but it was not an irrational judgment, and it was one that was very widely held at the time by, by other central banks and economists generally. And but it wasn't about economics. It was, how long is this going to last? Are these things that are happening to our economy, which are unprecedented, are they going to get better? Like, for example, millions of people dropping out of the labor force, or the problems we have with the global supply chains. There was no model of that. We can't look at the last 20 times it happened. So that's, but for sure, in hindsight, it was not transitory.
Thank you. The Committee for a Responsible Federal Budget estimated that canceling federal student loan debt held by Americans could increase the inflation rate as much as 0.5 percentage point and would add $1.6 trillion to the national debt. This estimate notably also did not incorporate the possible effect that student debt cancellation would have on increased college tuition prices. Chair Powell, has the Fed done any analysis on the inflationary impact of these proposals to forgive student loans being actively considered by congressional Democrats in the administration?
Not that I know of. We would look to CBO and legislation. We tend to start to put it in our models of the economy when we think there's really likely going to be legislation.
Generally, though, would you expect forgiving $1.6 trillion in debt, whether it's student loan debt or credit card debt, to have an inflationary impact?
Well, again, I'm going to leave that to CBO to score, and also the Office of Management and Budget. We just routinely do not score congressional proposals. It would get us involved in political things, and why would we be independent then? So to be independent, we need to be out of these very difficult fiscal issues, which are really your job.
Thank you, Chair Powell. I yield back.
Thank you. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, without question, the Fed has a role to play in healing our economy. But as with any treatment, the wrong medication can cause even more harm and make the patient more ill. Chairman Powell, at your latest press conference, you stated, quote, "Wages are not principally responsible for the inflation we are seeing," end quote. I certainly agree with that assessment, as do many economists. Considering that wages are not driving inflation, why is the Fed addressing inflation with tools which primarily impact wages, such as interest rates?
Well, our tools principally impact inflation, not necessarily wage inflation. So our job is price inflation. But I will say on wage inflation, the issue is that over time, wages are really very important. Over time, looking forward, are very important, particularly for service companies where most of the costs are really in wages. And wages, we all love to see big wage increases, but these increases that have been having, some of them are just substantially bigger than would be consistent with 2% inflation.
Thank you. Well, throughout today's hearing, to that point, you've indicated that the Fed doesn't have more precise tools at your disposal. Chairman, the root causes of the inflation we are seeing are supply chain disruptions outside of the Fed's control, whether it's COVID-19 lockdowns in China or the Russia-Ukraine war, which is why this knee-jerk response to raise interest rates is so alarming. The Fed cannot control the factors causing inflation, but this policy choice would plunge millions of people back into unemployment, dampen wage growth, and tip the economy into a recession. There's an old adage, Chairman Powell, if all you have is a hammer, everything looks like a nail. You've recently said that the Fed's tools, like interest rates and the balance sheet, are famously blunt and lack precision. So in that case,
He did.
Do you agree that the Fed needs new tools that are more precise to better fulfill its statutory mandate of price stability and to maximize employment?
No, I don't think we're looking for new tools. I would just say that a big part of the inflation that's happening is really not going to be affected by tools, but a big part of it is going to be affected by our
Read
tools.
my
and that's
lips.
the part that's related to demand.
No new
Mr. Chairman,
tools.
but by your own account, you stated on the record that the Fed's current tools are ill-suited to deal with the inflation we are seeing. So perhaps now is the time to expand the Fed's toolkit to meet the unique moment that we find ourselves in. For example, one tool that could help the Fed tailor a more precise response to inflation is direct credit regulation. This would allow the Fed to regulate the availability of credit in the specific sectors of the economy experiencing high inflation without impacting other sectors. Would you support Congress passing legislation to give the Fed more precise tools to tackle inflation, such as this idea?
That's not something we would seek. Of course, it's up to Congress to make those decisions, though.
But at your own admission, your tools are too blunt and not precise enough. So what additional tools do you believe the Fed needs to respond more precisely to inflation?
Well, again, our tools they're blunt, but they are the right tools to deal with broad aggregate demand, and that is a more important determinant of inflation than energy and food prices. As painful as energy and food prices are, the bigger piece of it is related to demand. We can't help with energy and food prices, to your point, but we can help with aggregate demand, and we do that through the tools we have. We're not seeking a deeper involvement in the economy like you're talking about, but again, that's a question for Congress. Congress can change our toolkit or our mandate.
Well, in this moment of overlapping crises, from supply chain disruptions to high inflation, I do believe we need precise policies that respond to the needs of the American people. The Fed knows that raising interest rates will not address the root causes of rising prices, but they will just keep doing so, even at the cost of millions of working class people's livelihoods. We need a more sophisticated toolkit for the era we are in to truly heal our economy and tackle inflation responsibly. Thank you. I yield.
Actually, we don't need a more. I don't agree. We don't need a better toolkit. We just need to let the market take care of itself and stop supporting it. It's the market is sick. It's disease. She's right. We're using the wrong kind of medicine. It's making it worse. She's right. What's the answer in this particular situation? It's to not treat it. It's the market is self-healing. Believe it or not, it is really self-healing. You have to let it go through the process. If you don't let it go through the process, then you're just going to make it more sick.
Thank you. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you for being here, Chair Powell. Appreciate it. Just a point of clarification. You noted that you ended your public statements in support of fiscal stimulus by the end of 2020. Is that correct?
Yes.
And so it'd be after that the Democrats, under one-party control, passed $1.9 trillion of additional fiscal stimulus. After it had already stopped making public statements in support of additional fiscal stimulus. I have the timeline correct?
Yeah, I mean, again,
I'm not asking you to opine. I just want to make sure I had the timeline correct.
I took no position publicly or privately, and neither should the Fed chair do so.
Understood, but your public statements in support of additional fiscal stimulus ended in 2020.
Yeah,
the Democrats, under one-party control, passed $1.9 trillion of fiscal stimulus after that period of time. I just want to make sure of the timeline. I understand. Let me cognizant of the time we have, and you've noted that you think the Fed should not play a role in fiscal policy. I have grave concerns of the fiscal policy that we've seen playing out in Washington, not asking you to opine on that. Looking at 2021, we saw real GDP growth about 5.6% in that year. Is that correct?
Yes.
Over 5%, a reasonably robust rate. At that period of time, in the year of 2021, we saw the Fed's balance sheet increase by about $1.5 trillion. Is that correct?
Sounds about right.
So at the period of time where we were seeing reasonably robust economic growth, the Federal Reserve was continuing to build its balance sheet to a tune of $1.5 trillion. And so during the year 2021, the Federal Reserve ultimately purchased about 54% of all federal debt issued by the Treasury. Is that accurate?
I don't know that. If you have the number in front of you.
I have the number in front of me. I think it's worthwhile. Roughly half of the federal debt that was issued in 2021 was acquired by the Fed and placed on the Federal Reserve's balance sheet. My concern is that hid the real cost of borrowing that was being driven by the Biden administration at that time. And my concern is that the Federal Reserve, by increasing their balance sheet by $1.5 trillion at a period of time when Democrats put forward a gigantic stimulus package, after you had stopped your public calls for requesting additional fiscal stimulus, that's all part of the problem. It's both the fiscal policy and the monetary policy coming together. But let me keep going here for a moment. The federal government paid in debt payments last year $580 billion. Is that correct?
I don't know.
That's the numbers I have. It's about 5.8% of our budget, fiscal side.
Notice Powell's glasses are back on. This guy is asking the right questions right here. I just want you guys to know these are absolutely the right questions.
In the projections of CBO interest over the next decade, one of the CBO projects that it will triple to $1.2 trillion. But that's assuming federal debt remains in a range of 2.4% to 3.8%. That's the CBO's projections to get to debt payments increasing to $1.2 trillion by the end of the decade. But we're sitting here at a period of time when the 10-year Treasury yield has crossed 3%, 3.16%, I believe, as of yesterday. A year ago, that was 1.48%. So we're already approaching the high interest rate threshold that CBO has for interest on the debt to triple. Do you project that interest payments on the debt, the interest payment number that's impacted by the interest rate set by the Fed, will remain in a range of 2.4 to 3.8%, or do you believe that it will dramatically be above that?
We don't publish projections on on Treasury rates.
So as interest rates are moving, as you're doing that, I think appropriately so, to address the inflation environment that we're in, the Federal Reserve doesn't project the cost on the debt moving forward?
So internally, we don't publish, as what I said, but internally, we of course do have a path for the 10-year, for example, and for many, many years, it's always showed rates returning to levels even where we are or even higher. Well, that's what goes into our models, because we assume over time, for example, we're reversing, we're going to be shrinking our balance sheet by in the range of $1 trillion a year in coming years. So that'll put more supply out. That should put some upward pressure on rates. So we do. It's not our business to project this publicly, but that our assumptions are that rates will return to levels that are somewhat higher.
Well, let me for the record state that I'm very concerned that we're going to see interest rates remain high. The Committee for a Responsible Federal Budget notes that 50 basis points is $143 billion a year in debt. I'm concerned that we're on a path that's very unstable. Appreciate you being here. Madam Chairwoman, I'll yield back.
Thank you. The gentlewoman from New York, Ms. Ocasio-Cortez, is now recognized for 5 minutes.
Thank you so much, Madam Chair. And thank you, Chairman, for coming in to speak with us today. Chair Powell, in the summer of 2019, which admittedly was a different world, during a Financial Services Committee hearing, you relayed to me that, quote, I would look at today's unemployment as well within the range of plausible estimates of what the natural rate of unemployment is. Do you recall what the unemployment rate was around that time in 2019?
I want to say 3.5%.
Yes, it was 3.5%. And what is the current unemployment rate today?
3.6%.
3.6. You also said, quote, when unemployment went way up, you didn't see inflation go way down. So you don't see inflation reacting to unemployment the way it does because inflation seems very anchored. Again, that was at that time. Chair Powell, would you say that some, briefly yes or no, but would you say that some of the contributing factors to today's inflation include ongoing supply chain issues, including volatility of commodity prices as a result of the ongoing conflict in Ukraine, and companies also raising prices because they can?
Well, I would say on supply side issues, for sure, those are playing an important role.
And am I correct that American workers' wage gains have actually trailed inflation? In other words, while the cost of goods went up by 8.6% on average, wages did not increase by that much.
It depends. For some people at the lower end of the spectrum actually have been getting positive real wage gains. For most people, though, inflation has been higher than their wage increases.
So on average, we have a wage growth at about 6.1%. So average wages are trailing inflation. It does seem that American workers are not primarily responsible for the inflationary issues that we're seeing today. But despite this, we are seeing some comments from individuals like former U.S. Treasury Secretary Lawrence Summers earlier this year said that in order to contain inflation, the U.S. needs 5 years of unemployment above 5% or 1 year of 10% unemployment. Do you agree with that assessment?
So I understand how that number can be arrived at or derived, but I think there's so much uncertainty, and in particular, the answer is going to depend to a significant extent on what happens on the supply side. If we do get these supply side problems worked out, which I think is certainly going to happen in time, then you wouldn't see anything like that. But it's a highly uncertain time, and our intention, of course, is to bring down inflation while keeping the labor market strong.
I think it's important to drive home what a 10% sustained unemployment would look like in this country. For context, we didn't even reach 10% during the Great Recession. We did experience 10% unemployment in 1982 following the Volcker shock. But in this market, to get to 10% unemployment, that would require about 10.5 million additional people out of work. And historically, we know that black unemployment is usually double that of white unemployment, correct?
Yes, it tends to move at twice the speed, both up and down, but certainly moving up.
So when the former Treasury Secretary says he wants 10% unemployment overall, he's also saying that we need black unemployment of nearly 20%, or implies that. But Chair Powell, I do think that despite the tools that you don't have, Congress does have tools as well. Would you say that the following actions granted in the scope of Congress could be deployed to impact inflation, using antitrust laws against companies that are raising prices using their market power?
Sorry, I didn't hear the last part.
Would this action, would using antitrust laws against companies that are raising their prices have an impact on inflation? Laws? Antitrust?
Antitrust laws. Okay. Sorry.
No worries.
The acoustics in here are difficult.
No worries. Would that have an inflationary impact?
It's hard to say, really.
Would subjecting those companies to a windfall profits tax have a potential impact on inflation?
Again, I don't.
And would requiring government contractors to keep a lid on their pricing have certain impacts on inflation?
You know, there's a long history of price controls when inflation's been high, and it was not a successful one. Really, it comes down to getting demand and supply in alignment.
And if the Fed's tools mostly impact demand, but most of those inflationary issues could be potentially impacted by supply, how high do you think the Fed would actually have to drive unemployment to actually have an impact?
Well, that's going to depend on a lot of things, and you know, ideally we can raise rates, and it's very important that we get inflation back down, particularly for people at the margins of society who are suffering the most from inflation, and maybe a longer conversation we can have.
Thank you.
Thanks.
Thank you very much. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being with us today. Congratulations on being confirmed to your second term as chair. We got some rocky times ahead. Wish you luck. Last time you were here, we discussed how rising interest rates really inflates debt servicing costs for the federal government. And I know what you're going to say. That's a concern for fiscal policymakers, the Congress, to take into account, not the Fed. And that is mostly true. But I still think it's worth everyone being fully aware of just how costly servicing our debt will be now that interest rates are returning to historically normal levels. According to the CBO, interest payments on the debt are the fastest growing part of the federal budget. CBO projects that servicing our debt will cost taxpayers $8.1 trillion of the 10-year budget window, $8.1 trillion. And their inflation assumptions are projected interest rates are fairly lower than current levels and quite a bit lower than where rates are likely headed to get inflation under control. And I thank you for your efforts to get inflation under control, but for every half percentage point rate hike, that is an estimated $133 billion of annual increases. I'm going to say that again, $133 billion in annual increase in debt servicing costs. That is just a staggering amount of money. So we, Congress, must get our fiscal house in order. We have to. There is no other option. The dollar's position in the world as the global reserve currency is solid, and there are no immediate signs of that changing. But if we continue on our current trajectory, that will not always be a given. So my question is, are you worried that if our current fiscal path continues, which I should note with each rate hike it looks worse and worse, that the dollar's position in the world could be challenged in the long term? Is that a concern?
Certainly in the long term. The dollar is the reserve currency, and I don't see it as particularly under threat at the moment, given the advantages that we have, which are many. But you're right, the U.S. federal budget is on an unsustainable path, and we will have to deal with it. The sooner the better. And unsustainable just means that the debt is growing faster than the economy, which by definition, over time, can't be sustained.
Thank you. For the record, I also want to follow up. You stated the following as Congress considered the Biden stimulus. Quote, in addition, workers and households who struggle to find their place in the post-pandemic economy are likely to need continued support. The same is true for many small businesses that are likely to prosper again once the pandemic is behind us. That was from your speech on February 10th of 2021. I just wanted to add that in for the record. One final question. During a meeting last week at the International Association of Insurance Supervisors, the IAIS issued a consultation paper on comparability criteria looking at the use of international capital standard versus the aggregation method. As you know, the U.S. has committed to using an aggregation-like approach here in the U.S. through the National Association of Insurance Commissioners Group capita calculation and the Fed's proposed building block approach. Moreover, the EU and the UK, through their covered agreements with the US, recognize these approaches to group capital. Nevertheless, Insurance Europe, a federation of European insurers representing more than 95% of the European market, takes the view that there cannot be two versions of an international capital standard. So my question is this: will you continue to advocate and support the aggregation method as an alternative to the international capital standard?
I think I'm a little rusty on that, but I will say this. I know that we're strongly committed to capital standards that work for U.S. insurance companies.
I get that, but I guess what I'm getting at is we have a different way of regulating insurance here in the U.S. We all know that, and it works for us, and we do not need to let these international bodies change our way of doing things. We need you to stand up for the American way of doing things and for American businesses. Can you commit to doing that?
So I think that's what we're doing. So,
okay.
Yes.
Thank you. Madam Chair, I yield back.
Thank you. The gentleman from Massachusetts, Mr. Auchincloss, is now recognized for 5 minutes.
Thank you, Madam Chair. Welcome, Chairman. I want to start by asking you about inflation expectations, which, as you obviously well know, can be very difficult to dislodge once they are anchored in the mindset of consumers, and what the Fed can do both to address inflation, but also to convince Americans that inflation is going to be lowering in the medium term and thereby prevent inflation expectations from getting anchored.
Well, so if you look at inflation expectations, and of course we measure professional forecasters, households, market-based break-evens and things like that, a broad range of things, you do see that people expect inflation to be high in the very near term, but they expect it to come down fairly quickly and get back to. So generally, as a general matter, the evidence is clear that people do expect inflation to come back down to levels that are consistent with our price stability mandate. But this is the first, we haven't had a test like this. I would say we haven't had an extended period of high inflation for a long time, and so it's not a comfortable place to be. Short-term inflation expectations are higher, and it does add, it adds to our desire to move expeditiously and with force to get rates up and ultimately to get inflation down.
So, building on that, 1 degree removed, the only thing more painful than expected high inflation is unexpected high inflation, and it makes it the degree to which businesses and consumers do not have confidence in the Fed's ability to control inflation, or the U.S. government at large, makes it harder for them to make capital investments in the long term, makes it harder to do wage negotiations. Is there a measure of the degree of confidence that both business and consumers have in the ability of inflation to remain low that you are tracking, so that we can try to measure the degree of confidence people have in not having to see unexpected inflation in the future?
So first, I agree. But ultimately, this is the point is that if the public retains confidence that inflation will come down, if their expectations remain accurate, then it will come down. That is we think that's how it works,
self-fulfilling,
right? So by many measures, we track them all. I mean, we put them all in one big measure called the Index of Common Inflation Expectations. We do that, and we publish that at various times. And they're sending basically that message that essentially, yes, inflation expectations are anchored. But as I said, that's good, but it's not enough. We need to get inflation down because inevitably over time, these expectations are going to be under pressure.
Are you able to track, though, it seems like you also want to track volatility within that index of inflation expectations to see how much confidence people have that they're not going to see unexpected inflation?
Yes. We look at the distribution, and there's some small signs, concerning signs, and we just can't allow that. We really have to. Ultimately, our whole framework is about keeping inflation expectations well and truly anchored, so that inflation will return to that anchor.
And your credibility in that is autocatalytic in inflation expectations. So I think it's critical that the businesses and consumers have that confidence.
Absolutely.
Can you explain how quantitative tightening, I guess we would call it now, is going to play into that? Unrolling quantitative easing of the last 10 years?
Sure. So it's quantitative easing in reverse. So what quantitative easing does is it reduces the supply of risk-free, longer-term assets, and that tends to drive rates down as people want those. And when we loosen our balance sheet, when we shrink our balance sheet, what happens is the public will be holding more of that paper, and we won't be holding it, and that should have some upward pressure over time. Markets are forward-looking, so they're already pricing this in.
And you don't project any changes in how you're going to do QT?
So we put out a plan. We thought very carefully about it. We've announced it. Markets have seen it, and it's sort of priced in. And I think we would intend to keep to that plan. Of course, one of our principles is that we're always going to be flexible if that's warranted.
Last question for you in the final 30 seconds here, Chairman. Can you give us an update on FedNow and your plans for access both to established banks as well as to financial technology companies?
So FedNow is supposed to go live next year. We believe we're on track to do that. We've got people working really hard on it for some time. I didn't catch the last part of the question.
And how are you gonna make access available? Is it going to be just for certain types of banks? Is it going to be for financial technology companies? How are you going to adjudicate access?
So that's something we're looking at. We are, mainly it's for the broad sweep of banks, and we'll have to look at going beyond that.
I yield back.
Thank you. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Chairman, welcome. Glad to have you here. Would you agree that housing is a leading economic indicator on the health of the economy or on the direction the economy is going?
It's certainly an important indicator.
Because it affects so many different facets of the economy. Because it affects so many facets of the economy, is that right?
I'm sorry, I'm having a hard time hearing.
Because it affects so many facets of the economy. In other words, when you housing, whether it's commercial or residential, you buy a lot of products that are across the spectrum.
It's an important, very important sector of the economy for the reasons you point out.
And one of the reasons that most economists are predicting a severe recession is housing as a leading economic indicator. I've done that. That's what I've made my living. Do you realize it's very simple to solve to get the housing at a point that it was under the previous administration. I'm from South Carolina. People are moving there. Do you realize in the last probably 4 months, there's been a severe cutback, despite the fact that people are coming in and need it. And it's because of this administration's war on energy and natural gas. The Fed can't regulate that. Putin can't regulate that. It's a direct result of policies of this administration. And one of the reasons that it's basically going to come to a standstill, the war on energy, you can't afford gas for your product. It's a war on the workforce that this administration has done. When you pay people not to work, it's kind of a disincentive to go to work. Supply chain that has been mentioned, when the call I got 4 days ago, a leading producer of chicken cannot get corn to feed the poults, the young chickens, is kind of a problem. Interest rates, which is at your disposal, is severely going to affect the housing industry. When you're paying a 6% long-term mortgage rate, along with every other cost increase directly caused by the policies of this administration, the housing is going to come to a stopping point, as it is now likely to have. Regulations have been mentioned here. We now face on simple projects regulations, and I would point out many of them needless to be 35, 38%. When you combine all of these things, housing is going to take a tremendous drop. That will affect the economy, wouldn't you say?
I think all of those things are affecting the economy.
Is greed that has been mentioned here a leading cause of inflation?
I think it's a macroeconomic phenomenon that's caused by the things we've been talking about.
Was greed not a factor 4 years ago? I mean, if it's a factor now, were they just less greedy in 16 through 20?
It's hard to see why there would have been.
Right. And was he responsible for the low gas prices that we experienced from 16 and 20?
Not as far as I know.
I don't think he had much impact. If he did, it'd be a sad state for the United States. I think one of the congressmen mentioned about the debt relief of college students that's been proposed by the current administration. How will that have an effect on the economy? And I think the number that's been talked about to forgive $50,000 per student, will that affect the inflation and the economy?
As I mentioned, we don't score these bills from an inflation standpoint.
It wouldn't be positive, though, would it?
Sorry?
I doubt it would be positive, would it?
Well, I don't know. I mean, that's for elected folks.
All right, and on the central bank digital currency, would you have to have approval from Congress before the Federal Reserve got involved?
I can't imagine that we would move forward without authorizing legislation.
So you'd have to have the approval of Congress.
Yeah. Yes.
Well, thank you for what you're doing. You're using the tools that you have at your disposal. Most of this can be eliminated if we had a policy now that was pro-business, pro-growth. But thank you for what you're doing, and congratulations on being reappointed as chairman.
Thank you.
Thank you. The gentleman from California, Mr. Vargas.
I just want to point out there that he did say yes when the last gentleman there, which I don't remember his name now already, but when that last senator asked the question, and the congressman said, "Do you have to have approval from the U.S. Senate in order to have to be able to issue a CBDC?" And he did say yes. It was quiet, but his answer started with him saying he would think that they would need to, which I find very curious. But when more pointedly directed, his answer was a final yes. I'm going to hold him to that. I'm going to hold them to that they have to have approval in order to issue something. I don't know if an executive order would override that or not, but that could be partially the reason why he said yes. Without an executive order, that would be true, probably.
Is now recognized for 5 minutes.
Thank you I'm over here, Mr. Chairman. Thank you very much, Madam Chair and Ranking Member. Mr. Chairman, thank you very much for being here, and congratulations, I think. I'm not sure. You're running into pretty heavy lift here going forward, but very much I appreciate you being here today. I believe that inflation is real, obviously, and it's hurting a lot of people. It's the causes, I think, that are being manipulated and frankly lied about. And there's one big criticism that I make of you, and also, and especially, I guess, Secretary Yeltsin, and that is that you haven't explained inflation within the context of the world environment, what's happening globally. My good friends on the other side of the aisle love to blame inflation singularly on President Biden and his policies. I didn't get a chance to ask Secretary Yellen any questions when she was here last time, kind of low on the totem pole here. But I wanted to scream because every time she led with her chin as opposed to explaining that this inflation is globally. But now that I have you here, I get to ask you some questions. What is the inflation rate in the European Union?
Overall, I wouldn't put
It's
a number down.
8.8% according to Statistica. Did they receive any money from the American Rescue Plan?
Not to my knowledge.
What is the inflation rate in Estonia?
In Estonia, don't know. I mean, they're roughly comparable to ours.
It's 20.1%. It's not very comparable to ours. It's over 3 times higher than
Big
ours.
European democracies.
Estonia. Did they receive any money from the American Rescue Plan?
Not to my knowledge.
How about Latvia? What is the inflation rate in Latvia?
No idea.
It's 16.8%. Did they receive any money from Biden or the American Rescue Plan?
Not as far as I know.
How about Bulgaria? 13.4.
I knew that one.
Poland, you knew that one?
No.
Oh, I apologize. I'll let you try with Poland. How about that? They're a friendly nation. 12.8. Did they receive any money from the American Rescue Plan? And if they didn't, why do they have inflation that's so high?
Not as far as I know.
So why is their inflation rate so high?
Well, in Europe, the inflation that they're seeing is principally, I believe, due to energy prices and food prices. It's due to the war, and it's due to, the situation with Russia being their principal energy supplier.
So not the American they didn't receive any money, though, from the American Rescue Plan?
Not as far as I know.
Okay, let's keep going. Romania, 12.4. Slovakia, 11.8. Hungary, 10.8. Croatia, 10.7. Greece, 10.5. The Netherlands, come on. You ought to know the Netherlands.
I sense that we're going down, so be lower.
10.2.
See?
But you do see I'm glad that it's going. Germany, how about, let's skip to Germany. Very similar to us.
I'm not going to guess.
8.7. And the reason I wanted to go through the litany of these things, I keep hearing from my good friends on the other side of the aisle that inflation somehow magically exists because of Biden's policies, because of the American Rescue Plan. Well, if that's true, then there shouldn't be this other inflation in other countries. It's a global phenomenon. As Clinton used to say, it's the economy, stupid. Here it's the pandemic, obviously, and things that happen. We have a situation around the whole world, yet you don't explain it globally. And I shouldn't yell at you because I really like you a lot, and I really do think you're doing a good job. I'm trying very hard. But I did want to yell at Yeltsin because she didn't explain anything globally. Don't you think you have a responsibility to the American people? I know in my district, most people believe that inflation's only happening here because of the rhetoric that they hear on the other side. And you guys, I think, have the opportunity and the responsibility to give them the full picture, not this limited picture. And I hope you do so.
Again, with that, I'll yield back. Thank you very much, Madam Chair.
The gentleman yields back. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. And actually, I think my timing for my question's perfect. Chairman Powell, I'd like to discuss with you today an issue that is of significant concern to me and many of my colleagues. The SEC's regulatory agenda has more than 50 significant proposals that are currently underway or approaching a final vote. These rules cut across every asset class under the SEC, the Securities and Exchange Commission's jurisdiction. The sheer complexity and volume of these overlapping rulemakings could negatively impact markets and the public that depends on them. SEC Commissioner Hester Peirce, warned that the speed and character of these rulemakings could create dangerous conditions in our capital markets. Now, this is against a backdrop of the U.S. economy facing significant challenges. We've discussed that all morning. Inflation at more than a 40-year high, with substantial increases in the cost of food, housing, and gas prices at record prices. Also, supply chain backlogs and labor shortages continue to weigh on the economy, with consumer and business confidence plummeting. And of course, we're still studying the impact of the global pandemic and the consequences of the ongoing Russian invasion of the Ukraine. In Oklahoma, small businesses, farmers, ranchers are navigating through surging energy prices and volatile agricultural markets for inputs like grain and fertilizer. Poor crop conditions and high commodity prices are expected to worsen the situations throughout the summer and into the rest of the year. In uncertain times like this, market participants need to seek to protect their retirement savings, to hedge risk, and to safeguard their livelihoods. A top priority should be supporting liquid markets to protect the U.S. economy from the face of these substantial headwinds. I know you don't comment on other entities within the federal government. I know these regulations that are going to have such a tremendous impact are not coming from your area, but unfortunately I'm concerned that the magnitude and the significance of rule-making proposals coming out of the SEC in such a short amount of time runs counter to the goal. We know that regulatory uncertainty creates adverse market environment for economic growth and market stability. So, Chairman Powell, I'll not ask you to comment on the SEC, but could you speak to the importance of market liquidity during periods of economic uncertainty?
Please.
Yes, so markets are there to, one of the things they do is process information and consider the implications of it, and it's critical that markets be liquid enough to do that. And if that happens, then financial conditions can adjust and equity prices of various kinds can adjust. And that's one of their big functions, is to do that and to absorb news, sometimes very difficult news, in a way that preserves stability.
I think Congress and the public should have the opportunity to fully grasp the impact of the SEC sweeping proposals. If we really want to tame inflation, we should begin by not making the current situation worse. The SEC's approach will battle markets during a time when strong capital markets are essential to our economic growth and our constituents back home.
This guy, this Mr. Lucas, hold on a second. I don't know who the hell he is. Hold on a second. Virginia? Lucas? Virginia? This guy's got to go. This guy has got to go. What the the way we fix things is we make them back to the way they were. That's how we fix everything. We got to get back to everything being the way that they were. Yeah, get rid of this guy. If you're in Virginia right now, this guy is not on your side. He's on big business's side here. This man is an institutionalist inside and out. Big time. Not on our side. Guaranteed. He's siding right there with Hester Peirce. Oh boy. Yep, this guy's got to go.
After all, you're working hard on the demand side of the equation, but we in Congress and the administration should help with the supply side of the equation. And that is not making it more difficult to invest in and create more goods and services in this country. That said, Chairman Powell, as you've acknowledged, the Fed's monetary policy tools can do very little to mitigate rising gas prices. However, the increased cost of gas has an oversized impact on consumer inflation expectations. Folks see the price at the pump going up and experience the price per gallon at an all-time high. Could you discuss how the Fed envisions its ability to rein in inflation expectations, driven in large part by gas prices? Or put another way, if gas prices remain at record levels, is an aggressive response from the Fed all but guaranteed?
Well, if gas prices remain at the current levels they're at, then inflation, the problem is inflation means continuing to go up. So it isn't so much the level as the rate of change, as you know. So I think we are mindful that even though these things are outside of our control, the gas prices and food prices for the most part, that adds a little bit of urgency in our wanting to get our rates into a place where we're addressing inflation directly, because the public reacts to all kinds of inflation, not just core inflation. Our tools generally go to core inflation. So, we don't think we can use our tools to change energy prices, but we do think that they add to our desire to get expeditiously to the appropriate levels.
And clearly, Congress and the administration, the majority, has a responsibility to increase supplies of resources, not discourage that. Yield back, Madam Chair. Thank you, Mr. Chairman.
Gentleman's time has expired. The gentlewoman from Ohio, Ms. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Oh, I got the wrong one. Okay, I got the wrong one. I'm looking at the picture right now. That is not who that was. Hold on a second. That was not the right person. Let me find out who this is. It is not the senator, because I'm looking right now, and that was not the same person at all. Hold on one second while I figure out who he is. Frank Dean Lucas, Congressman. Let's see here. I think this is him. Frank Lucas. What is that, Oklahoma? Hold on a second. I don't know the shapes of my states. Let me just make sure that's him. That looks like him. Hold on one second. Let me just go backwards just a tad. Yeah, that's got to be him. Frank Lucas, Oklahoma. Republican. Forget what I said about Virginia. That was a woman. This is Frank Lucas. Frank D. Lucas, Oklahoma. He is a Republican. Gotta go. I'm sorry, but you've got to go. You are a big business man who's only in for making sure that the markets stay the way that they were beforehand. And we're here to fix the markets. We are here to absolutely fix these markets, and I say no. You must go. If you're here for corruption and keeping the way that the market has always been, I say goodbye, sir. Goodbye. Maybe I need to move a state north so I can go vote. I'm gonna move north a state and vote. He's got to go. I'm sorry. I don't care, Republican, Democrat. If you're all for keeping business the way that it was, it's got us to the point to where we are at right now, and you think going back to that is what's going to fix everything, you don't need to be working for us any longer. Goodbye. Leave. Go someplace else. Changes are what we need. Balaclava, I was wrong on that, but we're going to take a look at numbers anyways at 12, so I will break then, and I'm just going to continue to keep playing though. I got to hear what all these people are saying. I want to know where these people stand. I want to understand why our government's thinking the way that it's thinking, and I've got to see this stuff, and I think it's important. I know not everybody wants to see all this, but I think it's vitally important to know who stands for us and who stands against us.
5 minutes.
Thank you so much, Madam Chair, and thank you, Chair Powell, for being here as you're navigating through all these federal issues during this difficult economic time. Chair Powell, after our hearing concludes, this committee will be voting on a few pieces of legislation. So I'm going to take advantage.
Wait, I got to stop this real quick just because I read something that somebody said here. Where was it? Björk said, "Yep, it's been like this forever." Yes, sir. Yes, sir. It has been like this since I've been in the markets. Nothing has changed. It has only gotten worse. It's not like we got here overnight. Nothing has changed. Thanks for making me get back up on that soapbox. I cut this lady off here. I apologize. Ma'am, please respectfully continue.
Of having you here to shed some light on a few of the things that we will be considering. I can't think of a better person to give us some insight on these issues. First question is, we'll be voting on an amendment that would delay the SEC's small business advocate from conducting outreach to underserved business owners until after gas prices drop to the pre-COVID level. Chair Powell, in your opinion, will delaying the SEC's outreach to minority business owners affect gas prices in any way?
With all respect, I'm reluctant to comment on proposed legislation.
Well, let me ask it this. Let's say if it's not legislation, is there a correlation between what gas prices would be in relation to what they were with pre-COVID with inflation?
Again, I'd be expressing an opinion on someone's amendment, and if I start down that road, I don't know where it stops. These are matters for elected people.
Well, would you say that the global markets and inflation is across the country, that we're seeing this everywhere?
Yes, inflation is happening everywhere now.
I'm dealing with a lot of fair housing issues in my district. And, I have a long history of working with public housing and relocating people. And as we look at issues with housing, do you think housing is any way tied to inflation?
I'm sorry, I didn't catch the question. I apologize.
Do you think what's happening in our housing market is tied to inflation in any way?
Yes, it is. Yes. So housing costs are about a third of the CPI. Housing, we call them housing services, and that's really rents plus the way it works is in effect an owner of a house is charging something called owner's equivalent rent, or paying something called owner's equivalent rent. So yes, it's an important factor in inflation.
Okay. So can you tell us, in your opinion, in light of Congressman Vargas's question, as he was giving us an idea of, as some of our colleagues are trying to tie things to the American Rescue Plan, they're trying to tie it to us taking care of the least of us, that if it is tied to inflation, why in other areas or countries and they don't have the American Rescue Plan? And how do you answer more about Mr. Vargas's question? I mean, I know he gave you a litany. I'm not trying to put you on the spot with quizzing you on what their inflation rate is in comparison to ours, but I think you got where he was going with this. Is there anything else you'd like to elaborate on in relationship to where he was going?
Sure. So I'll just say these things there are differences between, even though we have a very similar inflation rate with a lot of the large European democracies now, pretty close. There are differences between countries, and the difference with the U.S. Compared to the European countries is that ours is more about demand. We have areas in our economy where demand is substantially in excess of supply. That's not mainly a feature of the European economies, where they're really feeling very, very high inflation because of energy prices and also food prices now. That's part of our story too. We're also feeling energy and food prices. But we have this other part that is more core inflation, that is more susceptible to being managed by our tools, and is really the object of our tools.
My time is already up, but in light of your response to my first question, I just need to say for the record, I can't conceive of a single connection between gas prices set by global markets and giving advice to small businesses. And the same, I have a hard time coming up with a theory of how allowing discriminatory housing will help stem inflation. And I think my time is up. I yield back.
Gentlewoman's time has expired. The gentleman from Texas, Mr. Session, is now recognized for 5 minutes.
Thank you very much, Chairman. Chairman Powell, thank you very much for taking time to be with us. This is important to the American people who hear our questions. This is important for us as we weigh and measure and gauge your input, which we believe is exceptional. I've stated that to you in the past, that I believe that we need to have confidence in what you're doing. Today, I'd like to, if I can, without dissecting your thinking, use some of the words that you have provided for us today to see your thinking. You had stated that as it relates to the Fed, quote, "We don't give advice to agencies." Now, that's a quote from you today. We don't give advice to agencies. Do you think that advice is different, which I do, than tools which you have to do your job? But I consider part of what you do best, perhaps the Fed, is advice. Can you help me to understand we don't give advice to agencies?
Well, so I think particularly on fiscal matters, fiscal matters affect people's lives. It affects industries and people and you know.
Whoa, wait, hold that thought. I've got a lawnmower going in the background here, and it's like I really think it's important to hear what it is that he's about to say here, and I'm going to go backwards because this is one of the things that's kind of been playing out in my mind too, his refusal to talk about fiscal policies. If you're in control or you have tools in which you can affect the general economy, which impacts people, then your advice or what you think those who are in charge of fiscal policy, what they can do to help you to make your job easier or better or make it so that you can help achieve the same goal of trying to fix the economy should be in line. And so by you not saying this is what we probably need to do to get to point A, to point B, to point C, to point D, to recovery, then what are you doing? You're only reacting to whatever fiscal policy that there is. And reacting is not what we need to have happening right now. We need to work together to try to move towards fixing the economy. You doing your job reactively to whatever fiscal policy that is created is great, but you can take it a step further by telling those who are making the fiscal policies what would help you to make your job easier or better or how to get there faster. He's holding out on us, guys. When you don't do what it is that you need to do to try and work together to get things to the right situation, you're holding out. And you're not being a team player. You're just cleaning up messes. That's it. You're just a mess cleaner. You're a water boy. Are you a player or are you a water boy? My mama said the Ublangata. He's acting like a water boy right now. He's just fixing what's broken. We don't have a player on our team. We have a water boy. And I'm a little disappointed, to be frank. And I'm glad that this representative is asking this question, not just because he's from the state of Texas, But I'm really curious to see what his answer is going to be. All right, guys, it's time to take a look at the numbers anyways, since I've got this doggone lawnmower in the background that I can't hear over, and I'm off my soapbox. I'm going to go ahead and, Massalorian, how's it going, man? Good to see you. I'm going to go ahead and start running through my numbers here. I did see Pantheon talking about laying some kind of gauntlet down or some kind of challenge or something. I don't know. I'm not sure what the challenge is exactly, but I hope it's something. I hope it's not. I hope it's not something I'll do. I do crazy things. I do crazy things. So you'd be surprised what I'll do if a bet's involved. I love bets. It's for the championship. Oh. I'm not even paying attention, man. I'm really not even. I know so many people are paying attention. I'll tell you what. Let me look into it now. I guess I'll weigh in on it. I know it's not like a very guyish thing to say, that you're not watching sports, but I'm not. Like, what the heck do you watch then, right? Yeah, I don't know. Let me look into it and I'll get back to you. But let's take a look at our numbers real quick here because it is 12 o'clock. I'm not gonna be able to see what it is that you guys are writing here, so let me hold your thoughts for just a minute while I cover these numbers real fast. Starting with off exchange, you guys cornered me. I'm not prepared to talk about championships. I just want to mention today, guys, that we are seeing extremely low off exchange data today. Not a whole lot of movement through there, and usually that results in price increase and not decreases. This could be the sell-off for the ETFs starting now. This could be that. That could be what you're seeing, why the price is moving downwards and yet no off exchange, not a huge amount of off exchange movement. We'll have to take a look at OBV day over day starting tomorrow to see if that's actually what it is, because if that's true, if it is actual selling that's occurring right here, more than likely what you're seeing is the exchange between sold shares from the ETFs repositioning for tomorrow. And like I said, there would be some downwards pressure in price when that probably occurs, but there's going to be high demand for those shares though. So perhaps maybe we start seeing that off exchange being heavily utilized tomorrow. But as it stands right now, 47.23 in the off exchange and the EDGX is at 11.41. Adding those two numbers together gives us 58.64, which is about 6.36% lower than what we're used to seeing by the end of a day. So this is definitely low off exchange volume today. Very, very low. Incredibly low. My guess is that, they're going to push selling. They're going to push the selling through the lit market because it does push downwards price movement, which helps them to close positions as much as possible. So it kind of makes sense. Total amount of shares having been borrowed for the day-to-day, according to Hortex, is showing 211,000 shares, which is slightly up, I think, from 2 hours ago, which was 126,000 shares. That's going to have a slight increase on estimated current short-term interest of the free float to 22.58%. The cost of borrow is at 23.35. It's rising. Shares on loan, for those of you who are just joining for the day-to-day, is down day over day by about 1.2 million to 192.19. Taking a look at the options, there's probably going to be a redistribution of options because it was signaling for a closing price around $12 to $12.50, and we're below that now. So let's take a look and see where we're at. Highest amount of volume currently at $12.50, and 2 hours ago there was 12,000 contracts. There's now 16.8, And on the puts, the highest amount of volume still at a $12 strike price. It went from 5.1 thousand contracts 2 hours ago to 7.5. Still more than a 2-to-1 ratio in calls versus puts, and the market's still signaling a close somewhere between 12 and 12.50. Options have not really. Let me just check something real quick. Yep, they have not really rebalanced yet for this price movement down, which could mean that they may be expecting price to go back up before the end of the day. Taking a look, let me move a couple screens over here real quick. Taking a look at Fidelity. I'm so proud of my dog. He's not freaking out today with the lawnmower. AMC is, yeah, see, this is definitely, this selling pressure is not coming from retail, guys. It is absolutely not coming from retail. Our volume is actually almost getting us into the top. We were running at like 14th, I think, earlier. We've actually moved up the list. Oh, there he goes. We're moving up the list to 11th most heavily traded stock on Fidelity based off of orders, and our buy to sell ratio is 77% buys to 23% sales. This tells you retail is buying this dip. Retail is 100% buying this dip. This selling pressure is coming from someplace else, and the only thing I can think of right now would be institutional. So this is probably the beginning effects that we're seeing from ETFs being sold off. Let's see, GME on this list had fallen earlier this morning, and they're in 30th. They're coming in the last possible spot. 30th position, so their volume's low. 56% buys to 44% sells today. They've been struggling. They've been really, really struggling with their buy to sell ratios. I would expect this means that our volume's probably up right now. We'll check it here in just a second. SSR trips at $11.34. Shares available to borrow. There's 20,000. I'm not going to count these yet. They did borrow another 5,000 shares 1 o'clock, about a minute ago. The fees for borrowing right now is at 17.1%, up from 17 earlier. I'm not going to count those 5,000 shares, but so far, Stonko Tracker is showing about 350,000 shares borrowed for the day. I'm about ready. If there's another 5 or 10,000 shares borrowed, I'll probably up it to 400,000 shares borrowed for the day today. Currently, there is 129.3 thousand contracts that are out of the money on the calls versus 3.2 thousand contracts that are in the money. 26.6 thousand contracts are out of the money on the puts versus 17.2 thousand contracts that are in the money. The NASDAQ is up 0.19, Dow Jones is down 0.41, and the S&P 500 is down 0.2. Currently, the market is failing over advancing with 3,659 decliners to 3,209 advancers. Excuse the background noise. It's going to get loud here in a second. Oh, he's done. The VIX is currently up, starting to move up. It's up 2.14. IWM is down 0.37. Tesla is down 2.08. Amazon is up 1.18. Cinemark is down 1.73. Doge is up 1.39. Bitcoin is up 1.66 at 20.3 K per coin. GME is down 0.6. HYMC down 7.52. Hood is up 2%. NCMI is down 9.14, and AMC is down 6.59%. Refreshing inflow versus outflow, we're currently $4 million more in inflow roughly for the day today. 20.42 million shares having been traded so far for the day today, and we are beyond halfway through the day. Let's see what kind of pace we're on here. Let's see. I really need to come up with a Excel spreadsheet for this. 36.7 million shares is the pace that we're on right now. That is within the 20 to 40 million shares that I predicted in pre-market. We're definitely on the right pace for finishing within that. I was expecting low volume for the day today. On the weekly time interval, we currently have more buying pressure than selling pressure according to the Hortex indicator, and RSI is low at 36.91, which is below average. On the daily interval, there's more buying pressure than selling pressure with an RSI of 44.1, which is slightly below average. On the hourly, we have more selling pressure than buying pressure with an RSI of 29.89, signaling that the stock is oversold currently. Just now starting to signal that. On a 30-minute interval, there is more selling pressure than buying pressure with an RSI of 23.68, with, again, another signaling of oversold period. That is a very extremely low RSI on the 30-minute. On the 5-minute, there is more buying pressure than selling pressure with an RSI of 29.09 after a heavy double dip into the oversold region. So we've got at least 3 different time intervals saying that we've got oversold shares on this trend. We did print a TD9 as well as having hitting the lower Bollinger Band, which usually means a return to the simple moving average. There's a return to the simple moving average. It could continue to start pushing back down at this point. It'll just depend on whether or not there's buying pressure or more selling pressure. Trying to take a look at where this is headed. Let me just check something real quick here. It's possible. We've got 3 different points here on a descending parallel channel with 2 touch points right here. It's possible that we're on a descending parallel channel, which is bullish when it breaks out. The question is how far down will it go before you see the breakout? Oftentimes, the support lines tend to be the Fibonacci retracements that you have, and then you could draw out like a box. But there may also be some other points of resistance. So like in here would be a breakout potentially dropping into that range. That's 1134 to somewhere in that range, bouncing off of perhaps 1134, but following this trend channel. It could break out before then though. This is just a suggestion, potential breakout box. And with that, I can see what it is you guys are writing again. And I will start with Yo saying it's all manipulated to hell. Yes, the Wall Street Journal article says that Kenny G is moving his Citadel to Miami. That is true. I have it pulled up. I've already got it pulled up over on the screen over here. I was going to show you guys because I know there have been several mentions about it. I just read it to you. Billionaire Ken Griffin is relocating his big hedge fund firm from Citadel, Chicago to Miami. The third major employer to announce the move of a corporate headquarters from Illinois in the past 2 months. In a letter to employees Thursday, Mr. Griffin said he had personally moved to Florida and that his market-making business, Citadel Securities, would also transfer. He wrote that he views Florida as a better corporate environment, and though he did not specifically cite crime as a factor, company officials said it was a consideration. Mr. Griffin has been the wealthiest resident of Illinois, so his departure will hurt state tax collections. On both the individual and corporate side, it could also be a blow to Chicago's philanthropic scene. Mr. Griffin has given more than $600 million in gifts to educational, cultural, medical, and civic organizations in the area, spokesman Zia Ahmed said. Let's see, is there anything else worth noting in here? My guess is that they will probably not lose access to the server that they have and I would not count this as the employees packing up their boxes. Although I would be very curious to know how much bigger the new building is in comparison to the previous one, or smaller. That would be something very interesting to find out. If anybody knows what the new location is, which should be able to be found out, it'd be interesting to see if they are downsizing or if they are increasing the size. Yep, sorry, I got the news article on here. I know. ABC says no state taxes in Florida. Brian says Florida has more old people to Ponzi on. Sounds to me like you could go to Oklahoma. There's somebody over there that I think is on his side. Oh, son of a... Thank you. That's what you meant by the chart's not on the screen. My bad. I didn't flip you guys over. Son of a gun. Sorry about that. I was showing you all kinds of stuff and you couldn't even see it. Alrighty. Shall we finish listening to I was actually sitting here the whole time watching. I don't feel like I really had a break yet. If you guys want, I really want to listen to Jerome Powell talking to our congressmen and women who are asking him questions. So I'm willing to sit here and listen to that. Otherwise, if I'm not, I'm going to go on break for a little while and give you guys some music to listen to because I want to see it. It's my channel. I decide. Just make up your own decisions, Casey. Do it. Have a choice. Don't be. Oh man, I almost said that. Don't be like your wife and to ask you where you're gonna go. You do it. She's listening. Let's see here. I'll tell you what. I'm gonna listen to it. I'm gonna listen to it with you guys. Let's just do it. I don't really feel like it's my channel though. I feel like we do this together. So I like you guys to have input. I'm here to help provide information, and if you guys really don't want to see it, I would just save it to the side for myself for later. But look at that Macedonian in the background there, advertising me Macedonian's videos. Doesn't he look like? He looks like a boss right there. So, are you still here, Mass? You look like super pissed right there. Legit, like super, like you look like you're gonna kill somebody. All right. Pantheon's like, Casey, I'm done hearing you talk. Play the video. Here we go.
Tax levels and spending, that in our system is the province of elected people. And, for someone who's an appointed person who hasn't stood for election and has a very narrow mandate, I just think that's not appropriate. If we're going to wander into those kinds of things, then what would be the case for our independence? If we're going to be involved in every political issue, that isn't directly connected to our work, then why would we be independent? We should just be another agency. But we have this independence, and I think to preserve it, we need to stick to what we do and, you know, resist the temptation to work on every problem, even the ones that are not assigned to us.
Well, let me say thank you for the answer. You do know, however, as we were talking about student loans, it's a rather large amount, about $1.2 trillion that is out there. You stated that you believe that would likely be dealt with in legislation. Now, that's what you said, likely to be dealt with in legislation, student debt. I think even private advice, not within your tool structure, but this advice that we're trying to land on, would be really important, because it will be, the way I see it, the next large hit to inflation. And this is why Republicans, or at least this Republican, says that I believe that this administration, the Democratic Party, are making friends with inflation. They are using the toolbox that they have of politics and money and spending policies to make friends with inflation. So my point would be to you, I sure hope that someone could send an unnamed memo to someone saying that you have an opinion, if you have an opinion on that. Next point, we have had some discussions about unemployment. How is unemployment calculated?
So you have to be actively looking for work within the last month to be and not have a job to be unemployed. If you're not looking, then you're out of the labor force, and that's so you're not participating in the labor force. So those are the factors.
So what we want to do, some members of this committee have wanted.
Well, I'm so sorry, guys, but I'm so sorry. But like, why is he legitimately asking that question? Like, does he not know? Did he not like look that up before he went in there to talk to the head of the Fed? Like, does he just not know how you calculate unemployment? What is wrong? Why? You have 5 minutes. You have 5 minutes to ask a very important person who's in control of inflation for the United States of America, and you sit there and you ask him how you calculate unemployment? Please. I really hope that he's building to something here and that he's just trying to make a point. I mean, I just really hope.
To look back and to say, well, perhaps under President Trump, it was 3.5%. Now we're 3.6, so not a big difference. And yet the huge number of jobs that are available is really the factor. When there are not jobs, that is a problem. But to simply say, well, Trump was 3.5, now we're 3.6, everything is fair, it's all done. I think the other advice I'd love to have you have from the Fed is to someone about getting people back to work. Because today, the government has given zero instructions for federal workers to return to work. And I think that it is causing a mindset among many, we don't need to go to work, thus reflected in 3.6% unemployment and millions of jobs awaiting. Mr. Chairman, thank you for taking time to be here. It's my hope that you would find in your toolkit advice that becomes perhaps more important, and I thank you, sir.
Thank you.
The gentleman's time has expired. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Madam Chair, can you hear me?
Yes, sir, we're loud and clear, and we can see you.
Okay, thank you. Okay, I want to thank Mr. Powell for and welcome him back to the committee. I know it's a great deal that is going on. And Mr. Powell, I think earlier there might have been something that came from one another of my colleagues, and it was a rise in interest rate to combat inflation does come with a rise in unemployment rate and possibly contributing to an economic recession. While white unemployment rates have dropped to pre-pandemic levels of 3%, and in QI 2022, the national black unemployment rate remains still at 6.5%. And I know something you can't say, but what suggestion can you offer to help prevent Black and other minority communities from facing future economic inequities as the Federal Reserve continue to raise rates in the near future?
If I heard your question correctly, it was whether we're considering additional future interest rate increases, sir?
That's correct.
Yes. So I think just last week, my colleagues and I wrote down our forecast for this year, and we anticipate ongoing rate increases over the course of this year. Yes, additional rate increases.
Do you believe that the Fed's current inflation projection of 2022 and 23 remains a good benchmark to consider, even with these vulnerability potentials growing in the upcoming months?
I think these are the projections the latest projections that individual FOMC participants submitted were submitted last Wednesday. So I think they're still fresh, and there's a range of expectations of people on the committee, but I think they're a reasonable set of projections. Yes.
Okay. And Mr. Powell, several of my colleagues on the other side of the aisle have been debating about the Biden policy and so forth, which I know you can comment on. But there is a concern where we were kind of caught off guard with the war in Ukraine, and then at the same time, our vulnerability of all of the things that we depend on for other countries. In your deliberation, when you all are working with the situation that has arrived, that came from the Russia-Ukraine war and other real estate and other stress in China spilling over into the United States, does the Feds give a recommendation back to the administration on how we should proceed in the future? Because everything, we've done a lot of things with other countries and depend on a lot of countries for resources and so forth. And it looks like we're becoming very, very vulnerable. Well, it doesn't look like it. We're becoming very vulnerable to this dependability. Do you all make a recommendation back to the administration on how we should proceed in the future?
No, sir, we do not.
Okay, and so early on you said that it's prominent let up, that policy position should be considered by the legislature or the administration. Am I correct?
I'm sorry, I lost track of what you said there. I apologize.
I think to some other colleague of mine, you stated that those policies should be left up to the Congress or to the administration. You all don't really deal with that aspect of it. Am I correct?
Well, I'm sorry, which aspect of it?
About what recommendation could be made for all of the things that we have offshore that we depend on from other countries. Yeah. And I might not be really clear, but for example, like the gas situation with Russia, and wheat and stuff with Ukraine and stuff of this nature.
No, we're not in those discussions. Those are really discussions that happen inside the administration, the Treasury Department and the White House and the other agencies.
Okay. With that, Madam Chair, I yield back.
Gentleman yields back. The gentleman from Missouri, Mr. Lippenheimer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Long morning for you here and afternoon. Question for you with regards to a quote that on March 17th, the CFPB put out in a blog on rising interest rates in which they said, and I quote, "The CFPB is the arm of the Federal Reserve System that is fully focused on consumers, ensuring that markets are fair, transparent, and competitive," end quote. Do you believe the CFPB is an arm of the Federal Reserve? And do you have any control over their actions?
Well, they're an independent agency. We have no control whatsoever of their actions. They are actually, though, legally a bureau. The law makes them a bureau, and the profits that we make off of our balance sheet, we give all of them to the Treasury Department, except the part that we give to pay for the CFPB.
So does that make them an arm?
For all practical purposes, they're fully independent in all of their policies.
They're not an arm of the Federal Reserve, then? I wouldn't consider that an arm. They have a relationship, but they're not an arm.
Technically, they're a bureau, but
they're not under you, so they're not. I don't know how they could be.
No, we have no supervision.
Okay.
And, we collaborate with them, we coordinate with them, we talk to them.
Well, this is overreach by the director. I just want to make sure that everybody's on the same page. This is a bunch of nonsense, so it needs to be put in its place. Chairman, you've got your hands full right now. This is Wall Street Journal from Tuesday. We had economists say recession is likely. Down here, we said stocks are not bottoming very soon. So we've got some concerns. I know yesterday you were in the Senate, and
Where the hell did he get a newspaper from? I didn't even know newspapers were still a thing. I don't even think I've seen anybody doing a newspaper route. This guy just pulled out a newspaper. He's all, I got this really old document here. I think it's called a newspaper, but it got printed today. Here. Wow, guys. Wow. I'm sure I knew newspapers were still a thing. Don't mock me, but I just think that's kind of funny. It's a nice little prop he had there.
There was a lengthy discussion on inflation, which there has been here this morning as well. And in my mind, there's 4 root causes of inflation. And we've had economists in your chair a few weeks ago, and I had one in my small business committee a couple weeks before that, and I asked the same question of them. I said, it looks to me like there's 4 causes of inflation: monetary supply, rules and regulations, energy, and supply chain / job problems that we have with workers in the economy today. And they both agreed that's basically your 4 problems that are underpinning inflation. I asked them to give me a percentage on each one of them. They said roughly 40% for money supply, 20. So I guess my concern is that, if you look at those 4 causes, you're trying to help fight inflation. It's one of your mandates. And you really, under money supply, is the only thing you have any ability to do something with. And even then, it's probably only half of it, because Congress has control over how many dollars are put into the system with additional bills, like the $1 trillion stimulus package from last year, taxes and things like that. So it looks like you have a minimal amount of impact out of those 4 things. So it looks to me quite oftentimes whenever you're trying to control the inflationary stuff with the interest rate, it's kind of over here trying to do a little something, when over here there's all sorts of stuff going on, and the administration seems to be in contradiction to some of the things you're trying to accomplish over. Do you ever feel like that? Do you believe that may be a position that you're in right now?
So we're very focused on the part of the job that we can do and using our tools to do it.
Well, I understand that, Mr. Chairman, but I would seem that it would think that you're, all these other factors fall outside your purview here, and for you to try and manipulate it, and everybody rely on you to solve the inflation problem by tinkering with the interest rate over here. It looks like that's a little overhyping the situation, but one of the things that is very concerning is the regulatory cost. In my discussion with the economist, he said, look, and this is the administration's own figures, last year, Biden administration the cost of compliance with new regulations was $201 billion. That's astronomical. That's a huge cost that has to be built into all the small businesses and other businesses whenever they produce products and services for sale for customers. They've got to build in an additional $200 billion in costs every year. Would you agree that's a huge driver of inflation?
It sounds like a big number, yeah. And as you know, we try at the Fed to weigh costs and benefits and take that into consideration.
Would you agree that those other 4 things that I said are underpinning inflation, would you agree that those probably are the 4 major problems?
Yeah, so overwhelmingly, most economists would not think of it in terms of of money supply, but would think of it in terms of supply and demand. And although there may be a role for money supply, they would think in terms of supply and demand being
Well-
out of balance. And that's
well,
how I think about it.
You know, the definition of inflation I've always had was too many dollars chasing too few goods and services. If you throw more money in, you have more money to supply to the consumers.
There's 40 plus years of history and actually Milton Friedman at the end came back and said, that's not really working anymore.
Mr. Chairman, I just
It may
got
be
one
working
more,
again, though. Is the
one more quick comment for you with regards to this. It looks to me like whenever you're
Gentleman's
modeling,
time has expired.
when you're trying to
Gentleman's
model
time
and
has
you use these
expired.
4 different things, I hope that your
Gentleman's
models
time
are
has
including these
expired.
things in your modeling. I appreciate just a 13
Gentleman's
seconds to
time
be able to
has
finish my
expired.
question. Thank you, Madam Chair.
Absolutely, thank you. Gentleman from California, Mr. Chairman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Chairman Pell, I want to thank you for bringing to the attention of this committee over the last several years the systemic risk posed by tough legacy LIBOR, some $16 trillion of instruments where we would not know the interest rate that the debtor is supposed to pay the creditor, and $16 trillion is a big problem. We passed the relevant bill back in March, and for those who think Congress can't possibly deal with a problem until after the last minute, we passed it a year and a half before the LIBOR hit the fan. That bill requires rulemaking by the Fed, and the rulemaking is supposed to be done by mid-September. And that would put us in that's the final step in making sure that these LIBOR instruments are not a subject of uncertainty, because even 1 basis point, 1/1000th of a percentage point of risk or uncertainty, turns out to be significant when you're dealing with $16 trillion. So Chairman Powell, can we count on the Fed in getting these regulations out by mid-September?
Yeah, so, by the way, thank you for all of your efforts.
That last guy, oh my gosh. Sherman? Is that what it was? He's gonna give you that crazy look. He'll be like, I don't know what to do. You just looked at me crazy. I'm sorry, but it's killing me here.
It's on this technical problem, which have really helped move it along. And in terms of the rule, yes, we know the deadline. We know it's a tight deadline, and I'm assured that people are working very hard to meet that deadline.
Thank you. You're shrinking your balance sheet. A lot of focus on how much you're shrinking your balance sheet, but it also, what matters is the content of the balance sheet. You can invest in treasuries, or you can invest in mortgage-backed securities. If you go to an all-treasury portfolio and sell off your mortgage-backed securities, that'll probably raise mortgage rates. And we're trying to deal with housing inflation and housing affordability. So whether it's the mortgage on an apartment building that might be built, or whether it's a home mortgage, keeping mortgage rates low, I would think would help inflation. Is there any possibility that you would take a look at that and perhaps keep in your portfolio some of your mortgage-backed securities and perhaps have a mix of mortgage-backed securities and treasuries in your balance sheet?
We're committed to having a mostly treasury, not all, but mostly treasury balance sheet. And we don't have that now. And treasuries are going to start to roll off, mortgages much less. So we have not decided to start selling mortgage-backed securities, but we've said that we'll look at that again when this process is further along. And if we do, I don't actually think that the things we would do would have much of an effect on mortgage rates compared to, well, the effects that we've already had.
He didn't say they're not going to buy more. I keep waiting for him to say that he's not going to buy any more, though. When is somebody going to hammer him on that and say, but are you going to buy more? If the government is going to take on the mortgage-backed securities and supporting the downwards pressure that mortgage-backed securities are seeing to keep the economy alive, how much more money is it going to take out of the Treasury in order to support that, sustain keeping the market afloat? How much more? Because so far we're up to two. Did Thick say how much we've done in Trilly today, guys? What are we in today? We still got more time here. Thick hasn't come in with the Trilly yet, the Trilly numbers. But he'll come in here. I guarantee it. Thick will come in here and spout off what do we think we're at on the Trilly. It's gonna keep on moving up. They're gonna keep on buying or purchasing more mortgage-backed securities and whatever it is that there are other things that they're purchasing in order to sustain market conditions.
We have obviously faced a recession risk. Biden says that a recession is not inevitable. Do you agree?
I don't think that a recession is inevitable.
Thank you. There seems to be a great debate in this committee as to whether inflation is the result of COVID and the effects of the Ukraine war, which affect the entire globe, or whether they are the result of Biden and his policies, which, believe it or not, are not applicable to Germany, Britain, or Canada, as much as we in America like to think that we are the entire world. And then we look at inflation rates, and we see higher month-to-month inflation rates in Canada and Germany than here in the United States, higher year-on-year in Germany and the UK. So we're in a situation where only if you believe that Biden is responsible for German inflation can you reach the conclusion that it's Biden's policies that have caused inflation in the United States, which is pretty much on a par with what we see in other developed countries, particularly Europe. A part of this is the idea that if Biden just gives a speech saying we'd like to see a fossil-free future, that somehow impairs the amount of oil that is produced in the United States and somehow then affects worldwide oil prices. I would put into the record this article from Forbes titled, U.S. oil companies have increased drilling by 60% in 1 year. And without objection, I hope that could be done.
Without objection.
And I would point out that we had higher oil production in this country in the first year of Biden than the last year of Trump. Then we had higher oil production in 2022 than 2021. And in 2023, we will have the highest oil production in the United States in our history. Unfortunately, that'll probably not be the lowest gas prices in our history. So whether it's good or bad, we've discovered that making speeches does not suppress oil
time has
production.
expired.
I yield back.
The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. And it's just so ironic that, that my colleague is talking about oil and pumping. I literally just left my office with a group of folks from Alberta. There is an alliance of 6 energy companies up there that are going to get, by the way, to net zero on their carbon emissions by 2050. But Canada supplies 62% of all the oil that is imported here in the United States, or they did, but they can't pump it here, or they can pump it, but they can't pipe it here because Keystone Pipeline, which was bought by the Canadian government, was canceled by this administration. So hell yeah, we can blame the Biden administration for some of this inflation. And I'll refrain from that again, but heck yeah, they are directly responsible for gas prices and what we are seeing here. So you're trying to spread this around that it's Putin's fault, that it's everybody else's fault. Meanwhile, this president is flying to Saudi Arabia and won't go to Alberta and won't pick up the phone and talk to Justin Trudeau about getting Canadian North American oil here. That is security. Let's not stop going to our adversaries and go to our allies. All right, so need to take a breath here a moment, and Mr. Powell. I'm glad you are here, and I do believe you attempt to be less political than maybe some of your other predecessors, but I do want to briefly point out something that Mr. Stiles and Mr. Timmons raised earlier regarding your comments in February 2021 as Congress was debating the Biden stimulus. Mr. Timmons cited those comments earlier. Well, in fact, your quote is still highlighted on the website of the House Budget Committee, the majority's House Budget Committee, under the headline, quote, "Experts and leaders agree the country needs the American Rescue Plan now." So your words are listed alongside quotes from the Minneapolis Reserve Bank president, the president of the Federal Reserve Bank of Atlanta. And again, this is from 2021. And I just wanted to hear, the hearing record to reflect this timeline, first of all, and ask you, do you think that maybe your quote should be taken down from that website, knowing what we know today?
it's not up to me whether people take down the quote.
Well,
I don't remember the
let me
context.
tell you, though, if you're trying to be apolitical, that and allowing those words to stand with this mess that has been created in the economy doesn't stand. So I guess that's up to you, but if you're going to strive for that, I would suggest at least have some of those folks sitting behind you. They might want to make a phone call. All right, we have discussed during your last visit that I've long advocated for a rules-based approach to monetary policy. We talked about the Taylor rule. I've suggested the Yellen rule. Now with your reappointment, it could become the Powell rule. I don't care what it's called, but I am very concerned that we are not looking at those guideposts and having those guideposts. I'm glad to see that that in the Fed's most recent report, you did once again include a section on monetary policy rules, which had been omitted from the previous version, and you and I had discussed that at that. I want to read a quote from the June report and then get your thoughts. Although simple rules cannot capture complexities of monetary policy and many practical considerations, make it undesirable for the FOMC to adhere strictly to the prescriptions of a specific rule. Some principles of good monetary policy can be illustrated by these policy rules. So my question is this: what principles do you believe are important when the FOMC is making decisions on monetary policy?
Well, what principles are important? Well,
and we've got a minute with a quick gavel, so please go.
Sorry. So, I think to try to think systematically about monetary policy and not be, fully discretionary, to try to have a frame of reference. What are we trying to do? The Taylor rules, what they do is they embody the dual mandate. It's really what you're looking at in the standard Taylor rule and all of the spinoffs is how far are you from your price stability mandate? How far are you from your employment mandate? And that tells you, it's a frame of reference. And I think that's a useful thing to have.
Okay. We got 30 seconds less. Obviously, what I'm trying to push for is more transparency from the Fed. I also want to very quickly revisit your interaction with Mr. Gottheimer, where you spoke about the importance of preserving innovation and competition in the digital asset marketplace, which I agree with 100%. In fact, Republicans on this committee included that as part of their working principles last year. So let's talk about that light touch that when it comes to legislation. However, one of my colleagues also noted that regulators right now are being very heavy-handed, which I'm concerned about as well.
Expired.
And I will follow up in writing on that, but we need to be hearing about how heavy-handed regulators are. Thank you. I yield back.
Thanks.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Nice to see you, Chair Powell. I want to just start by thanking you for your service over these last couple of years. I know you and I have talked before that your rhetoric, your language, making it clear to all of us and to the nation that we needed a balanced fiscal and monetary policy in response to the downturn created the political space for us to do what we did. I don't think we could have done that without your voice. And the fact that we had not only as rapid a recovery, but as equitable a recovery as we did was because we had that space. And I think history will show that we owe you more gratitude than we've given you. And I thank you for that. The fact that wages grew fastest for the bottom quintile did not happen but for that fiscal policy that complemented what you were doing. And yet we find ourselves today with people talking about fear of a recession. And I would submit to you that the fear of a recession is not because our economy is weak, but because our democracy is weak. If we were to use our tool on this side of the dais to say, what should we do to address labor markets? We'd reform our immigration system. What should we do to reduce people's exposure to high-priced volatile fossil fuels? We'd make massive investments in cleaner, cheaper energy. What should we do in response to housing supply constraints? We'd invest in housing. I could go on and on. Everything on that list is deeply, deeply partisan because the markets are looking at the United States and saying, do people in this line of work, those 537 of us who have the privilege to hold federally elected office, do we see human pain and suffering as a problem to be solved or as a frailty to be exploited for our political ends? They look at my colleagues who 2 years ago thought it was harder to stand up to Vladimir Putin and support Ukraine and say they're going to do the same thing again. They look at the talking points that all of you get every Monday It says, talk about Biden's energy crisis, his border crisis, don't do a damn thing. I admire your obedience. Do you have an ounce of leadership in your bodies? And so now we're left here in this moment, and I'm not going to ask you to opine on policies. I understand you can't do that. But you were so eloquent 2 years ago in saying, if we don't balance fiscal and monetary policies, we are going to be looking at a recovery that looks much more like the Great Depression or the 2008 recession, where it was a long, slow recovery. What concerns do you have right now if the only tools we use to respond in this moment is monetary policy?
Well, honestly, as you can imagine, I'm very focused on monetary policy, and I think that the thing that I assume you're hearing from your constituents at home is about inflation, and that is our assignment. You know, it's not that we control all of it.
Well, I guess, and I'm sorry to interrupt, but we are. But when I talked to the CFO of a manufacturing company a month ago, and he said, my business school teacher taught me to do just-in-time inventory, and now I'm trying to manage to just-in-case inventory. That requires capital.
Guys, all right, I got to tell you a little story here. Just in time, just in case. If you are managing a company and just in case, you are going to lose. I cannot tell you enough. There is a great book out there, and I know I say don't read. I say it all the time. I say I don't read. There is a great book out there, and I can't remember the name of it. I'll figure it out. I'll come back with the book. The book title is relevant, but it is a wonderful book, and I'll come back with the title here in just a few minutes. But the book is very adamant in talking about bottlenecks within an organization and why just in time versus just in case. When you have built up inventory in a company, you will fail. You will fail every single time. You never want to have excess buildup inside your production line. It always needs to be just in time. Always. It's not the Bible. It's not the game. I'll figure it out here in just a few minutes. Give me a little bit of time. I'll come back with the book name. But I'm telling you guys, he is nailing this on the head. Just listen to the rest of what he has to say here. I'm sure it's going to be good.
He talked to chip manufacturers who are saying, I need money to build, but I need a labor force to grow there, and I don't know how to do that unless I have access to capital. Raising rates is great at curtailing demand. It's also great at curtailing supply. So what concerns do you have if all we do is raise rates?
Well, you're right. There would be supply effects as well. For example, to look at housing, you know, if housing starts will slow down, and I get that. But ultimately, we have a job to do, which is to restore price stability so that the economy can function well. It's really the bedrock of the economy, and it's most important for the people at the lower end of the spectrum who are now seeing their wages and savings eaten up by inflation. So we need to do that. There's lots of other things that need to be done in the economy, and that aren't the business of the Fed, but we have that job, and that really is our focus, along with, of course, preserving a strong labor market. The two mandates are equal. In the current situation, the labor market is very strong. It's extremely strong. Two vacancies for every unemployed person, 3.6% unemployment, and wages moving up. So it really is a question of getting inflation under control, and that has to be our focus.
Well, I guess I would just ask you to use your voice as eloquently as you have over the last 2 years. I'm not asking you to tell us how to do our job, but the supply pieces matter. And
they do.
When the market is baking in a recession, I can justify that logic if the only tool we use are the tools under your purview. Thank you. I yield back.
The name of the book is The Goal, written by Goldrat. We'll just say Goldrat because I can't say it. Eliyahu M. Goldrat. Probably screwed that up to all hell, but that book is by far, if you work with supply chains, or you work in an industry where you're reliant on even within your own company where your internal customers are supplying you inventory, you can make a huge difference in supply and demand inside your own company and how you move product around by reading that book. That book will tell you and use very easy concepts for just about anybody to be able to figure out how companies truly should be ran. It's in the semiconductor industry. I can't even tell you. I've worked for probably three companies that were in the top 10 semiconductor chip manufacturers in the world. One being number two. At least I think at any given point, those three were in the top 5. And I'm telling you right now that you walk around at different people's desks and you will see that book just laying there. It is probably by far one of the best books you could possibly ever read in terms of helping to understand a production line and how it should be run. I can't say enough about it. It's a great book. For even a person like me, it was easy to read.
The gentleman yields back. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Mr. Chairman, I visited with farmers in Fleming County, Kentucky last Friday, and my constituent Charlie Masters asked me to emphasize the extreme pain he and other hardworking Americans are experiencing as a result of this inflation crisis. And specifically, he told me that he couldn't afford the skyrocketing cost of diesel fuel for his tractor. He added that, quote, "I don't know how the government says the inflation rate is 8.6% because for those of us in the real economy, it feels more like twice or 3 times that rate." That's how painful this is, Mr. Chairman. I appreciate your humility in acknowledging that both the Biden administration and the Fed were wrong last year when they assessed inflation to be transitory. Clearly, the failure to more urgently tighten monetary policy was a serious mistake. So while far too late, I appreciate the current commitment to aggressive tightening, including the recent 75 basis point rate hike. But on behalf of Mr. Masters and my other constituents who are suffering with these price hikes, I encourage the Fed to exercise fortitude in restoring price stability and staying focused, even in the face of financial market volatility. Staying focused on fixing the supply-demand mismatch in our economy. So I have a question about the demand side and one on the supply side. On the demand side, clearly within the influence of monetary policy, the Fed has stated that its inflation target rate is 2%. The inflation rate last month was 8.6%, and as my constituent pointed out, it feels even worse. Given the chasm between where we are and where we need to be, do you anticipate any effort within the FOMC to increase its inflation target to 3 or even 4%? And will you commit to resist any efforts to change the inflation target that would make it even more difficult to anchor inflation expectations?
No, that's just not something we would do. We're shooting for 2%.
Great. And will the FOMC consider reversing the adjustment to the inflation targeting framework that it made in around August of 2020 to get back to a target of 2%?
We'll revisit that in a couple of years. I will say that that's really not the story behind why inflation is so high right now.
I acknowledge that, but given the work you all have to do, I would offer that as a consideration for the FOMC. What is the end point for your balance sheet reduction efforts?
Well, it really is when the balance sheet is at a size that that we can conduct monetary policy roughly in the range of 2.5 or 3 trillion, smaller than it is now.
Okay, and we were at 4 trillion. Now we're at 9 or a little less than 9. So you're saying 2 or 3.
We look at it as a
roll.
Sorry to interrupt.
Okay.
We look at it as a percent of GDP, really, and so we're trying to get back to roughly the level of GDP we were at.
I see. On the supply side, you testified earlier that supply chain issues and the price of oil are out of your control. I respectfully disagree in part. Certainly, the Fed does not and should not implement fiscal or energy policy. But in light of the impending confirmation of Michael Barr as Vice Chairman of Supervision, I am concerned that the Fed's regulatory framework could exacerbate supply constraints, and specifically, forcing banks to sideline capital that institutions could deploy to spur business investment, gold-plating U.S. banks' capital requirements, seen recently with the Basel Committee's modification to the GSIB surcharge in the EU, which reduces our domestic competitiveness, and especially the climate finance agenda and climate stress testing that would redirect capital away from fossil energy precisely at the wrong time when we need more, not less, investment in fossil energy, and when a gallon of gas is $5 nationally and rising. Do you acknowledge the role at the Fed related to business investment, regulation, further constraining potentially supply?
Well, we certainly do not want to be and are not in the business of allocating credit either to or away from any particular industry. We want those decisions to be made in the private sector.
Well, on the regulatory supervision side of the House, there is a supply side impact, and excessive regulation, especially in the climate finance area where we need more investment in energy, that could have an impact on your inflation fight. Finally, a question about Fed independence. Last week, my Democrat colleagues passed a bill out of the House that would add to the Federal Reserve's mandate by tasking the board with the additional responsibility of addressing racial and socioeconomic disparities rather than remain focused on price stability. My question is, when inflation hurts minority and low-income populations the most, do you believe giving the Fed new responsibilities that fall outside of its core competency would politicize the Fed and compromise your independence precisely when you should be focused on combating inflation?
The gentleman's time has expired.
We'd love an answer to that question, Madam Chair.
I think Mr. Powell can submit that in writing and forward it to you.
Then I'll just say, I think the public...
Just very quickly then, because we've got
Sure.
people waiting and you have a hard stop at 1.
I just was going to say that the public's been well served by the dual mandate, and I would be concerned with any statutory requirement that sets us up to be accountable for achieving things that we can't achieve with our tools, and I do think that's a concern.
Thank you.
Thank you. I yield back.
Gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Powell. As you know, one of the dominant drivers of inflation is housing. The affordability crisis is one of supply and demand. The demand for affordable housing far exceeds the supply. Do you believe, as I do, that public investments in an expanding housing supply would bring us closer to addressing the housing affordability and housing inflation crisis?
So I would agree that housing is in short supply and there's an issue there, but the question of how to address that is one for you.
Right. But if public investment had the effect of expanding the housing supply, that would have an impact in reducing inflation in the long run. Is that a fair assessment?
Again, I'm reluctant to be drawn into supporting.
Nope, I'm not just an objective description of the impact. I'm not asking for you to express support.
I think more supply generally, means that demand
lower prices, right?
Constant, then prices would be lower.
Okay. Even if you raise interest rates, prices might nonetheless remain high because of supply chain disruptions. Catastrophic climate change will, over time, open a Pandora's box of supply chain disruptions. Is it fair to say that catastrophic climate change, if left unchecked, will likely lead to more inflation and not less, and will likely render the Fed less effective at reducing inflation?
Would climate change do that?
Yes.
Over a very long period of time, I think it'd be very hard to say, and it'll depend on what's the governmental response. It'll depend on what's the private sector response. It certainly has the potential. I think some people think that dealing with climate change will put upward pressure on inflation, though.
But in the long run, if climate change disrupts the supply chain, right, that will obviously lead to higher inflation, and that's the kind of inflation that the Fed would have most trouble reducing. Is that fair to say?
Yes, but again, I'm reluctant to get into an issue that we're not climate policymakers.
Yeah.
We don't have to weigh these decisions that you do. It's really a question for elected officials.
Regarding the president, how much higher could the interest rate go? What does the worst case scenario look like?
How much higher could the interest rate go?
Yeah.
So, no higher than it needs to go, but we think.
But what's the worst case scenario?
I wouldn't say worst case, but I'll tell you what I think. The point is to get. We think that first of all, financial conditions have tightened very broadly. But the federal funds rate, our own policy rate, is still quite low. So we want to get it up to neutral pretty quickly, and then after that, we think it needs to be in a place where it is moderately restrictive, meaning above the neutral rate. And that's only appropriate because we have inflation at a 4-decade high. So my colleagues and I wrote down sort of a range of 3 to 3.5% by the end of this year, and then maybe 3.5 to 4%. Now that's all highly conditional, based on many, many assumptions. I think we'll do what makes sense as we go, but those are rough estimates, I think, of what we think might turn out to be appropriate.
And then the Fed has a target of 2%. How long will it take you to reach the target?
So we, in forecasts, I would say generally, my colleagues and I expect that inflation will move down over the course of the next 2 years, much closer to the target.
My understanding is that one of your projections is that headline and core inflation will subside in 2023 to 2.6 and 2.7% respectively. Is there any historical precedent for reducing inflation as rapidly as the Fed is projecting?
Well, yes. I mean, unfortunately, Paul Volcker had to do something very much like this, much larger, on a much larger scale. And, but yes, we core inflation, core PCE inflation has actually tracked down a little bit from the very hot levels of late last year and is closer to 4%. So I think it's plausible that through using our tools and ideally the supply side healing, that we could get inflation down to those levels next year.
As I understand it, there are two models of CBDCs, intermediated and disintermediated. The Fed can either operate through the commercial banking system or it can enable consumers to have direct accounts with the Fed. Which approach are you inclined to favor?
Intermediated.
Intermediated.
We actually don't have legal authority to provide accounts to anyone but depositories.
And you said the Fed has said it does not intend to proceed with the issuance of a CBDC without clear support from the executive branch and Congress. Do you see congressional authorization as a policy preference or as a precondition for creating a CBDC?
I think we'll need to have an authorizing law, and I think we haven't decided whether we think this is in the public's interest. If we do, we'll come to you. Again,
But as a matter of law, or is it a policy preference? Like, what is your view?
It's a matter of law.
As a matter of law, okay.
Yeah.
I see my time has expired, so.
The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, thank you for being on the Hill this week. We greatly appreciate it. And I wanted to change subjects. You've had a lot of good interaction today, and I want to talk a little bit about a rising interest rate environment and the impact on the Fed itself. The New York Fed released projections for the Fed's balance sheet as a part of its annual overview of its 2021 open market activities. And they announced to the public that the Fed portfolio could run a projected loss of about $300 billion through 2024 as interest rates continue to rise, since you have an enormous, biggest in the world, I guess, fixed income portfolio. The Fed's most recent financial statements for the first quarter show an unrealized capital loss of $450 billion during the quarter. So my first question is, does the Fed need a positive capital cushion in order to carry out its mission as our central bank?
No, we don't.
Can you explain to people why not?
Sure. So what we do is, our liabilities, our currency, for example, is a liability to us, and it doesn't earn, we don't pay any interest on it, but we own the contrary asset as Treasury bills, so we actually have substantial earnings, and we give those to the Treasury Department by law over the course of the year, and we've given $1 trillion worth of those earnings to the Treasury Department over the year. So we don't retain it as capital because we don't need it. It's literally not required for us to conduct the operations and do monetary policy. We don't, and we have a very thin sliver of capital, but it's sort of symbolic. It's just not something, we're not a private institution.
So as interest rates increase and you have to pay out interest on reserves, and you've got about $9 billion, I think, of operating expenses, there is a point in this interest rate increase where potentially you'd be at an operating loss, I take it, and that you would not be having a profit to distribute to the Treasury. Is that possible?
Yes, that can happen, but again, it will have no effect on our ability, no effect whatsoever on our ability to conduct policy, and it's not something we would consider in setting policy.
Right, and you just would treat that as a deferred asset, is that right?
Yes,
in other words, this is money you owe back to the the Treasury, when you start making a profit, you'd pay that you'd write that deferred asset off, right?
That's exactly right, and we'll pay it back down to zero.
So how does it then, since the Congress has imposed on the Fed an obligation to pay for the Consumer Financial Protection Bureau all their operating expenses, they just send you a memo and ask you to pay for that when you don't have cash? Is that added into that deferred account asset?
Yes, as a practical matter, it would be. It would be very
It's
small.
small compared to your overall operation, but
Yeah.
it's one of those, I think, errors I think Congress made, honestly, by imposing on our independent central bank, an obligation to, in theory, fund an on-budget operation. In retrospect, over the last 10 years, do you agree philosophically that ideally the Fed earnings wouldn't be earmarked for a particular on-budget operation?
In a perfect world, we would fund agencies through different means. Either many of them are self-funding. They get funding.
Yeah, I agree with you. I think it ought to be on appropriations. I've always felt that way. I think it puts the Fed in an unusual position. And here, as rates rise and your earnings may go negative as you pay out more earnings than you obtain and unrealized losses, this just puts that in mind. Let me thank you. Last time we were together and you were before the committee, we noted in the review that the rules regarding potential monetary policy rules had not been included in the report to Congress. So thank you for putting those back in to the Congress. And I heard you talk to Senator Tillis yesterday about the importance of rules. Can you tell us again how you use rules like the Taylor rule to help guide you in interest rate policy?
So they're just embedded in the work that we do, deeply embedded. And basically, anytime you make a forecast, you have to make an assumption about monetary policy. And so what you do is you use some form of a Taylor rule, and there are many different iterations at this point. I think, but more fundamentally than that, we do try to be systematic in monetary policy, and rules. You consult rules and help.
So let me just, in the few seconds remaining, Taylor rule indicates, I think, short-term rates might be in the range of 6%. You're not there yet, obviously, to fight inflation. How do you get there, and over what period of time?
So the real test is that financial conditions need to be they need to be in a place where they're causing the desired outcome in the economy, and that's what. And so there's been so much tightening that isn't reflected in the overnight rate yet.
Right.
So really, we've done a whole lot more than the changes in the overnight rate would.
I thank the chairman. I yield back.
Thank you very much, and I thank the gentleman. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair and Chair Powell. Good to see you again. I'm happy that we can now congratulate you on your confirmation as you continue to serve as chair. Also, I'm delighted that Dr. Lisa Cook, an HBCU graduate and the first Black woman on the Fed board, and Dr. Philip Jefferson, the fourth Black man, someone who teaches in my district at Davidson, have joined you as well. So as we've discussed before, you know how concerned I am about the housing market. And according to your February monetary policy report, our housing shortage has been intensified by the growing cost of construction materials. So, Chair Powell, how do you think the Fed's interest rate increase will impact the cost of construction?
I love her hat.
So I think it's going to lead to, and it is leading to, a slowdown in the housing market. You're seeing fewer buyers. You're seeing housing starts move back. That the housing market's going to be cooling off. It's been very, very hot. Price increases have been extraordinarily high. And it's one of the channels through which monetary policy works is intersensitive spending in particular. So I do think it doesn't directly affect construction costs, to your question, but many home builders do work on borrowed money, and it'll certainly affect their profits and their activities.
Do you remember that, guys? Do you remember you guys asked me, you said, what was the first thing you saw in 2008 that made you think that the market was crashing in 2008? I said, I remembered I was trying to get I was in a contract for a home build on contingency. And after a month, they did not break ground. And when we went back to them and we said, what's going on here? Why has it been a month? We're on contingency. I know you're supposed to break ground already and start building the house even though we're on contingency. and they said, "We're sorry, we're going to have to give you your earnest money back, and we are no longer taking home builds on contingency plans," even though they had already signed to the agreement. They gave us our earnest money back, and that was the beginning, the very, very beginning of the 2008 market crash. That was it. Home builders could no longer get loans. That's what they told us. They said, "We can't get a loan right now for building a house without knowing that you're for sure going to buy." That's it. That's the answer.
Thank you. You know, I've heard firsthand from construction firms, from affordable housing providers, my city and my county, and many others about the increase in construction costs and how seriously hampered these groups are, to build more affordable housing. So, I think we need to really pay a lot of attention to it, and it's really of concern. So thank you very much. I know that I'm out of time, and you probably are as well. So thank you, Madam Chair. I'll yield back.
Thank you so very much. I'd like to thank Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for Chair Powell to the chair, which will be forwarded for his response. Chair Powell, I ask that you please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.
And there you have it. Oh, wait. She's going to say something.
Thank you.
She said thank you. Aw, he said thank you back. That was so cute. They had a little special moment there. That was cute. That was so cute. I know he's getting congratulated over here, shaking hands. I wonder how tight that... Oh, that looked like a pretty tight handshake there. Anyways, all right, enough of that. It's time to take a look at our numbers. Let's see, what do we got going on? You can tell by a handshake. There's a lot of things you can tell by a handshake. It can even tell you where a person is from. There's so many things that can be seen and said about a handshake. I know some of you guys have probably seen, for example, Donald Trump's power handshake. In case you missed Empire Fire, I did post up the information for Twitter very briefly on the screen for you to see. Hopefully, you got the information that you needed out of that screenshot there of what's going on with Twitter. But 5.95% is the short interest currently for Twitter. I think that was the exact question. Alrighty, here we go. Let's take a run through the numbers here. I'm going to log into Fidelity real quick. 2-factor authentication, guys. If you don't have it, consider it. It may save you heartache and headaches in the long run. A little bit of short-term uncomfortable logging in. Sorry, I got distracted by a text here. A little bit of uncomfortability in logging into your account may save you from disaster in the future. I don't just say these things for a reason, for no reason. I say them for a reason. Taking a look at our numbers real quickly here, guys, because I want to go on a break. I feel like I haven't had a break all day today, and my ass is starting to hurt. My ass is grass. Let's see here. Let me move a couple screens over here, and we'll take a look at what our numbers real quick. Give me just 1 second. What do we got going on? I think it's been 2 hours. Has it been 2 hours or 1 hour since I took? Did I take a look at 12? I can't remember if I looked at 12. I want to say I did. So it's been an hour since we've looked at these numbers. In the off exchange, it was 47.23, and the CBOE EDGX was at 11.41. Let's refresh those. I'm currently seeing 46.75 and 11.53. That gives us a 58.28%. That's pretty close to where it was about an hour ago. Not a whole lot of change there. The there was a question. Shoot, you know what? Let me go back to the screen where you guys are asking questions because this is going to be in reference to that question. And it was by Stock Wiz saying, if AMC is added Friday, so the funds need to buy AMC immediately, or it goes into a time frame. And the answer to that question, Stock Wiz, is actually the opposite. Our market cap puts us in the lower third. I'm guesstimating. I'm guesstimating that it puts us in the lower third of positions for the top 1,000 Russell 1000 companies. So that should lower the amount of shares that are needed to fulfill the ETF rebalancing fulfillment obligations, meaning shares will be sold. Shares will be sold. Hence the reason for price moving down today. More than likely, because they can do this in advance, but they have until the end of tomorrow to do the rebalancing. So that's very likely reason why we may be seeing some of the downwards pressure or movement today. That should go into some buying. There should be some buying that goes into this. It should be a couple million shares. I'm not sure how many exactly. I haven't actually broken down the numbers to see what they were beforehand versus what they are afterwards. But hopefully I can report that to you guys Monday. Moving on from here, as far as, and that's also part of the reason why we are seeing some of the off exchange being as low as it is today. They're actually using those sell orders to drive down price. Makes sense. It makes perfect sense. You know, if you wanted to drive down price, that's how you would do it. You would use sell orders. And the off exchange is not being heavily utilized, so they are real sell orders going through. I have a feeling we'll see it in OBV as well. But I do believe that there's going to be purchasing as well. That on the other side of that, those are in high demand. Let me see here. Let me find out what's next. Hortex data. Let me refresh it real quick. As of an hour ago, there was a total of 211,000 contract, or what am I saying? 211,000 shares having been borrowed. It's now down to 199, so not too much of a change. That's pretty much leave our estimated current short share interest to the free flow where it was at 22.58. Cost of borrow is at 23.95. I believe that's about where the high or the max was earlier. The max is now at 34.08. So we are seeing absolutely a upwards driving momentum on cost of borrow. For those of you who are just joining today, shares on loan was down by about 1.2 million day over day from 193 point something to 192.19. Moving on to options. I have not seen a rebalancing as of yet for this downwards price movement, which could mean that we might move back up in the later portion of the day today. Most of the call options are still, the most amount of volume for call options is $12.50 strike price. An hour ago, it was 16.8 thousand contracts. That's now 18.4. And on the puts, highest amount of volume at an $11.50 price, which that did drop finally. It went from at 12 being 7,500 contracts to 11.5 with, nope, strike that, ignore everything I just said. It is still 12. I just can't read my numbers. An hour ago at $12 strike price, it was 7.5 thousand contracts. It's now 8.6. It is still the highest amount of volume. So the market's still kind of indicating a 12 to 12.50 close by the end of the day today, with just a little bit more than a 2-to-1 ratio in called to put volume. Goonie, don't let me forget. I can't see what you guys are writing right now. I just want to mention, I want to tell you a story. I don't know why you called yourself Goonie, but I'll tell you a story here in a minute. Taking a look at AMC and on Fidelity's most heavily traded stocks. We're in number 10. I saw somebody wrote that in there a little bit before I switched to the other screen. That's what you meant by being in 10th. 10th most heavily traded stock according to Fidelity based off of trades. Our buy to sell ratio is 81% buys to 19% sells. We are by far, hands down, the strongest buy to sell ratio out of any other top 10 stock currently. If I scroll down the list here, Berkshire Hathaway, Hackshire Berthaway is the only other one. Is it 85 as well? 85, 81 is the only other one that I see so far that has a, yep, that's the only one. It's the only one that has a better buy to sell ratio is Hackshire Berthaway. Yes, I know I'm getting it wrong. GME was in 30th position an hour ago. They've moved up one spot here. They have a 57% buy, a 43% sell ratio, which is not that great. It's about 3% less than what I'd like to see at a minimum. And they're struggling with volume for the day-to-day. SSR's trigger price is $11.34. Shares borrowed in the last hour only returns. The fee to borrow has gone from 17.1 to 17.2 most recently. Currently, there's 129.3 thousand contracts that are out of the money on the calls versus 3.2 thousand contracts that are in the money. 26.6 thousand contracts that are out of the money on the puts versus 17.2 thousand contracts that are in the money. Guys, there's a lot of stuff I realize that is not. I'm calling out a lot of things that are not what I would consider to be basic information. If you don't want to understand what it is I'm saying, why I'm saying it, or anything like that, please ask questions. Don't feel like you're the guy in the room that can't ask questions because you don't want to feel dumb. Ask them. This is a learning channel. I am not afraid to answer questions. The only question I view as a dumb question is if you ask the same question twice. Please ask questions. And I do read off almost every single thing that I read for a reason. The NASDAQ is currently up 0.64%. Dow Jones is down 0.19%. The S&P 500 is up 0.21%. The market is currently failing over advancing with 3,493 advancers to 3,411 decliners. The VIX is up 1.76%. IWM is up, actually it's breaking even right now. Tesla is down 2.11%. Amazon is up 1.84%. Cinemark is down 1.88%. Doge is up 1.23. Bitcoin is up 2.09 at 20.3K per coin. GME is down 0.22. HYMC is down 7.52. Hood is up 3%. NCMI is down 9.52. And AMC is down 8.18%. We currently have $5 million more in inflow than outflow, roughly. 26.72 million shares traded for the day-to-day. Let's see what kind of pace we're on. We're on pace for 35.3 million shares traded for the day-to-day. I suggested in pre-market that we would likely see 20 to 40 million shares traded for the day-to-day. We've actually gotten a little bit more volume on this downwards run. So if you look here and you look at volume for the day, you can see it started out, indigestion. Started out kind of high and then trended downwards and started running up high again. So we're starting to build up some volume on this downwards pressure. Remember, I said before, there was likely going to be a high demand for some of this volume, and it probably is real selling pressure. But the selling is coming from institutions, guys. That's the good news, because guess what? We're over 80% buying in retail. 80%. Over 80. Not just 80, over 80. Those are good numbers. On the weekly, we have more selling pressure than buying pressure. I said that backwards. We have more buying pressure than selling pressure on the Hortex indicator, and we have 36.65 is RSI, which is below average. On the daily, we have more selling, equal amounts of buying and selling pressure with an RSI of 43.34, which is slightly below average. On the hourly, we have more selling pressure than buying pressure with an RSI of 27.31, which is signaling highly oversold. And at 27, did I say it? 27.31. On a 30-minute interval, we have more buying pressure than selling pressure with an RSI of 18.92, heavily oversold, indicating. On a 5-minute interval, I think this is our third dip. Yes, it is. 1, 2, third dip into oversold territory. Currently outside of that, but still below average RSI at 35.56, and currently more buying pressure than selling pressure. It looks like we may be getting very, very close to the breakout of this bearish descending parallel channel. Getting close. We'll see if this is it. It's getting awfully, awfully close. Maybe not quite yet. I don't know. It's getting close, though. With that, guys, I can see what it is you are writing. Yucca Frida says, can we ask any question? No, you can't. There is one rule. You can't just randomly ask about random tickers. I'd prefer you have a request on data that you want to see about the ticker, because I don't have any problem providing the data for you. I want retail to do well. I'm not here to not tell you information. I'm just not going to comment about the tickers. On balance volume is OBV. Who asked that? Let me see. I had to scroll up. StockWiz, OBV is on balance volume. It's a great indicator to look at to see if there's actual real buying and selling volume. It's a great indicator. Highly recommend using Investopedia to go look it up and understand what that is. Or I can provide the link for you if you want. A wise woman told me you won't learn nothing if you don't ask. Oh yeah, Goonie, the story. Don't we feel so blessed, Apes, because we are in the middle of this big tidal waves in this market crash, just like Michael Burry in 2008. We have all these smart people sharing all their DD. Goonie, the story I want to tell you is Michael. Oh shoot, his something Davi. I forget his first name now. It's not Mike. I don't think it's Michael Davi. Hold on a second. I've told this story before. I always forget his first name. He's not even on the. How dare them? He's not even on the top list here. Robert Davi. So my dad, he's in Washington D.C. He worked for a company called iSafe. He was the one of the vice presidents, specifically working on law issues for iSafe. It was a company that, or it is a company that does internet safety for children. They teach kids in school how to be safe on the internet. And he was in Washington D.C. Testifying before Congress on trying to get approval for funding, because they were a nonprofit organization. And Robert Davi is who was one of the evil bad guys. His name was Jake in the movie Goonies. Who's a longtime supporter of iSafe, was with my dad in testifying before Congress to get more funding. And because that's what you do. You show up with somebody famous, and you get their support, and then they sign off on that kind of stuff. Bring somebody famous, they'll sign you off. But anyways, my dad was drinking in a bar with Robert Davi, and they were telling stories, having a good time, yucking it up. My dad's like, it would be fun to call my kids and have, tell them that I'm sitting here having a good time with Robert Davi. So they called me up, and then my dad said, I'm sitting here with Robert Davi. You want to talk to him? And I was like, who? Because I didn't know. I mean, his name didn't just roll off the top of my head like I knew who he was. And he's like, Robert Davi, the guy from Goonies. And I was like, oh, sure. Okay. It's kind of one of those awkward moments where it's like you're not really prepared to talk. It doesn't even matter who it is, but you're not prepared to talk to anybody else other than your dad when you see your dad calling you. So he hands the phone over to Robert Davi, and it was definitely him. I mean, you could tell his voice distinctively, instantly. And so we talked for a little bit, and it was awkward because I didn't really have much to say. And but I had a chance to talk to Robert Davi, and there's my little claim to fame. Great guy. He's really nice. Apparently he hit it off with my dad, and they were having a great time just laughing. My dad's that kind of guy, though. Was. Do you have a handbook on what questions are allowed? No, I don't, Yucca Frida. Curtis says, Casey, explain to me, like I'm a dumb ape, how does volume correlate with price action? Why some heavy volume days and low price movement, and vice versa? I would challenge you I would challenge you to show me a day where we have really large amounts, and I'm talking about really, really large amounts of volume and not having price discovery. I'm talking about really large amounts of volume. Now, in cases where we do have higher amounts of volume, there's only usually a couple things that cause higher amounts of volume to occur. It's either excess buying or excess selling. If you have price moving downwards, in cases of time where you have excess selling, or sorry, let me rephrase that. Oftentimes where you have excess volume and prices moving down, you're having selling that's occurring. Not always true, but more than likely is the case. And so then you have to identify who's doing the selling, which is part of the reason why I like to look at Fidelity to see what the trends are. Is it retail or is it somebody else? As today, you can see we have low volume, and I do say this all the time as well. Low volume days doesn't necessarily mean that price is going to move down. Price is easily manipulated in either direction with low volume. And that's something to remember. But I have this nifty little, I don't even know what to call this thing, chart, cross-reference chart, that I sometimes will bring up. It's been a while. Right there. General rules and volume analysis. And it shows you, you can look at volume and you can say, is it increasing or decreasing? And then you can say price. Is it price rising, falling? Is it bullish or is it bearish? When you have falling price and falling volume, that is bullish. Whenever they're going in the same direction, falling volume, falling price, bullish. Rising price, rising volume, bullish. Anytime you have a divergence of those two, where one is increasing and the other is decreasing, and I'm pointing the wrong directions with my fingers, and vice versa, it's bearish. So you want your volume and your price to be moving in the same direction to have a bullish indicator. But I think you're really asking a more in-depth question, Curtis. You're saying why? Why does it really make a difference? And I'll tell you this. Really high amounts of volume. All this volume that we see right now, like if you look at our average 3-month volume, which is up here, 49.62 million shares, that volume right there is mostly synthetic volume. That is not coming from us. I guarantee you we are not trading 49.62 million shares in a day. A lot of that is off exchange institutional volume, and it's synthetic volume. We're probably only trading 10% of that, maybe even less, which means that we're only really impacting the market by about 4.9 million shares. So why is volume important? It tells you that something is happening. If you can understand what it is, if you can figure out what's happening, it gives you an idea as to where we may be heading. So volume is truly and honestly, Curtis, I'm telling you right now, it is probably, in my opinion, one of the most important things we can be monitoring on a daily basis on this play, because it tells us our story. Only a dumb question if it's asked twice by the same person, James. It's got to be the same person. Sometimes not everybody else. I mean, if you saw the question already and you ask it again, yeah, then you're dumb. or you just need more of an explanation, one of the two. Everybody can look up stock quotes. I just don't see the purpose of it. Like you've got, I'm sure there's plenty. If you're looking at your phone watching this, you can pull it up. Leave my show. I don't, it's not a show. I don't like calling it that. Leave the live stream long enough to just go look it up. I'm trying to scroll down. Benjamin saying, Casey, why in these meetings don't they ask why the Fed have printed so much money and allowed the banks to receive bailout money, and they haven't requested margin calls for the debt? Because really, that's not the Fed's problem. Part of that is part of the problem. They're part of the problem, but not all of it. They're printing the money, but they're not in charge of requesting margin calls or making sure that people have balanced books. That's not their job. Goonie, this nickname is like my real name. That's why I choose this. Okay. Oh, Jana, that sounds horrible. I'm sorry to hear that about your mom. UKU, the only thing I have to say, I tweeted this out, I think last night, right before I went to bed. And I'm going to post it up here for you to see again. Gassy saying he didn't say we couldn't hit 1K, and now Assy begging us to do our worst means they are desperate for option plays. Don't step in those cow patties. I'm telling you right now, they desperately need us to FOMO into options when this does start running. Desperately. Don't step in those cow patties. Yeah, it really is ping-ponging for most of the day. I mean, if you sit there and you watch the order book, you can see it happening. Stockwiz says, can you scroll up and see my question about the big... Oh boy. All right. You're going to make me scroll up, way up. I don't know where it is. Okay. I have a question, maybe a stupid one. Only if you ask it twice. Imagine if a whale comes in and decides to drop $100 million on AMC. Do they route it via dark pool or via lit? It would depend on how they place their order. More than likely, it would be placed through an off exchange. But it really would depend on. I can't really answer the question. It would really seriously depend on how they went about doing it. Well, boy, I've always said this. I make a great coach. I'm a terrible player. I could talk a good talk. I can really motivate people, but I'm not going to be the guy that I'm not a great player. I could teach anybody how to play any sport, and I could probably teach them to be the best that they could ever become. Just don't ask me to play. Yeah, I know, Captain Awesome. It's time for me to take a break, and I haven't. I've been having a good time. Francis Boyce says, "Can you explain synthetic price failure?" I have a video for that, Francis, and it's in the description box for the channel. It takes 20. Well, I think it takes 16 minutes. I think it takes 16 minutes of your time, of your life. So I'm going to avoid that 16 minutes since I've already done it, and I want to try to minimize how many times I've done that. But if you check the description box, you'll find it. I try to limit how often I explain it. I hope you can understand. It's and to be very honest with you, it's probably not one of the best descriptions. I could probably clean it up a little bit. But I try to do the very best that I can in 16 minutes because I try to keep it really concise on trying to explain how it works and how you should track it. But I think it's good. I think it's pretty good. It's good enough. Well, I'm glad it put her to sleep, Jana. Ugh. Thanks, low boy. I appreciate it. I really, truly, and honestly don't know the answer, Jana. You know, I hate giving you the 2 weeks answer, but I don't know. I really don't know. Corbin Dallas says that SPF video is great, by the way. I think the cool thing about it, Corbin, is if you want to take that now, it has to be a heavily shorted stock, right? Because you're not going to see algorithmic trend analysis on just everything. It's going to be on things where the algorithms are most heavily algorithmic ping pong trading and trading between institutions that are heavily manipulated is where you'll see it used the most. So the more short interest that you have on a stock, the more likely it is that you're going to see unnatural algorithmic trading between institutions. So you can apply the SPF method for tracking price to heavily shorted stocks. How do you know if they're heavily shorted? Take your average 3-month volume, divide it by your free float, and if it's over 3%, yeah, if it's over 3%, it's heavily shorted. Over 6%, actually, I should say over 6% is heavily shorted. Anything underneath 3% is kind of normal, and that gray area is kind of 3 to 6%. That's it's hard to say. You'd have to look at short interest. There might be a couple other factors you'd have to look at to see how heavily shorted it is. I don't see that happening, Micah, but you'll know when we wake up. You'll know when we wake up and we look at I do expect something to happen like that, Micah, very easily. I expect to wake up one morning and just be blown the crap up on my phone. I fully expect people are going to start calling me in the middle of the night and trying to wake my ass up at 3 o'clock in the morning. And I'm gonna, you know what I'm gonna do? I'm gonna hang up. I'm gonna say to them, I'm still sleeping. I'll see you when I normally see you in the morning, and I'm gonna hang up the phone because there's nothing we can do at 3 a.m. in the morning. I start the live streams the minute that you can start trading in the market. At least I can. So if you have a wider range of trading ability, it's not going to be over in 10 minutes, guys. It's going to take time. The Big Tramp says, "Are we winning? I think we are." I know it doesn't feel like it, but I see a lot of things that I feel make me confident in what's happening. StockWiz says, "Will the algo hacking happen?" Probably not. Red Dog, how's it going? Yes, sir. Still riding the short bus. The Big Tramp short bus here. And thanks for saying that I'm a dedicated dude. I hope people realize that I'm not just here to leave people. I'm not here to bail on you, and I'm here for the long haul, as far as I can tell, until this is over. Oh no, I'm sorry, the Russell 1000. Okay, gotcha. So let me reread your question, Micah, and see. Uh, the time frame is, I think, by the end of the day. I think they have until the end of the trading day tomorrow to make all the transfers between the ETFs. That's my understanding. It's to provide liquidity to the markets. Yes, Kim. So essentially, what they're doing is they're providing money for a short period of time to allow liquidity, able to allow trades to occur, and then they get paid back overnight. You could go to Investopedia and look up reverse repo. I think it's reverse repo. Let me see. I'll just provide you a link. I have talked about it before. I'm just going to provide you a link, but I would read up on this to help you. I understand what you're saying as far as it being a little difficult to understand, but I would look at it as it's the Fed providing money for overnight transactions to occur, to allow there to be liquidity in the market to make those transactions happen. And they're having to lend more and more and more and more because we have a very illiquid market right now. If those were to shut off, like if they just turned off reverse repo for one day, this market would just have a cataclysmic meltdown. And to give you an example of that, if you zoom back out to 2008 to see what the reverse repos look like in that time frame, just so you understand what, and I can't even get, it doesn't look like it was heavily used as a tool, but you can see that overnight, well, you can see that there was that's not even a good picture of it. Well, you can see the timeline on the bottom of the screen down here at the very bottom if I take off all my stuff, and you can actually see it. You can see there's a timeline here on the reverse repo, but if you look at where it's been since early 2021, and you can see where the Feds really started pumping reverse repo in order to keep the market liquid, you can see where it's at. And right now our highest numbers is oops, are we at the end here? Yep. For the 22nd, it was 2.259 trillion. So we're on a very consistent upwards trend on the amount of money that they're continuously having to pump out over an overnight loans just to make the market trade the way that it needs to keep it liquid. Max Pain Ant is 1250. No, that's actually not true at all, Hayden. Yeah, MG Toe says break time. No kidding. I'm having a good day today. I got plenty of sleep last night, so I know I haven't even eaten once yet today. So, I've gone all day today without eating. Actually, no, I take that back. When I went on my first break, my wife had brought home a breakfast taco. So I've had a breakfast taco. I'm gonna get nice and I'm gonna feel the effects of this beer when I bring it out at 2 o'clock for the power hour. It's gonna be good. Let's see here. But Hayden is saying, you know what? You're right, Micah. I'm gonna go with the I'm gonna go with a adventurous ape instead of a beer. We're gonna do the 2 shots of tequila and 1 shot of Kahlua. Let me answer Hayden's question though. Hayden, your broker has to provide you with voting rights if you've purchased shares. So this is part of the problem that has been mentioned on plenty of occasions before, where the amount of votes that have come through are much different than amount of shares that have been held. And this is one of those things that Adam Aaron can't report on. Reporting of votes versus I'm really not even sure. What I would suggest is listening to Patrick. I'm gonna screw up his last name. Brine. I think there's some videos out there that exist that show that where there's CEOs that have talked about how they have definitely received voting counts that were higher, and that it happens on a very frequent basis where voting amount will be higher than what they actually have in votes and shares that are distributed. So it's a known problem, but you do get your votes. GME is in the Russell 1000, yes. Kim, yes, all-time high. Goonie says reverse repo is like a credit card, but only for an overnight. Yeah, that's right. Jana, you know what? It's because you're from California, and I'm from California, so I know what it is you're talking about. And here in Texas, a breakfast taco is a breakfast burrito. There's no difference. They do something really strange here. Don't ask. I don't know. I've been trying to explain it to them. They don't understand that it's not a taco. I keep trying to tell them, like, guys, a taco is a hard shell made out of corn. A taco is not a folded over, unfolded burrito and in flour. You can't call a taco a folded over flour tortilla. It's not a taco. It's just a unfolded burrito. But that's what they call it here. It's a taco. I don't know. I don't understand it. I know what a taco is. I'm from. I know what a taco is. I'm from California. So, they can't fool me. But I'm with you though. I get it. I know it doesn't make any sense. But you've had one before. Oh man. No, I know I'm not a Mexican. I know I'm. Oh, El Doge might be from the South. He's gonna be upset here. I'm telling you, look it up. Look it up. Look up the definition of a taco. Look it up. You gotta look it up. You're not gonna believe me till you go and look it up, and you'll be like, "What?" I'm telling you, a taco's got to be hard shelled and corn. Let's see. the ultimate debate. A Mexican dish consisting of a fried tortilla, typically folded, filled with various mixtures such as a seasoned meat, beans, lettuce, and tomato. You can't do that on flour. A dish, a fried tortilla, like you can't do that in I mean, I guess you could, but then it's something else. It's not really a taco. The only thing you can do a fried tortilla on is corn. That's a taco. That's the definition. It's not my definition. That's what it is. I think Stone 23, I think it's going to be either IWB. It depends. Are you talking about for BlackRock or not BlackRock? There's a lot of them. If you want BlackRock, I think it's going to be either IWB or IWN. There might be another one possible. I'm not sure which. The Russell 1K for Vanguard is going to be VO, I think. No, wait, that's what we are currently. Hold on a second. Let me look it up for Vanguard. I'm probably not going to get it right here. I actually don't know what it is. I'm just going to say I don't know what it is. Vanguard growth. Let's see here. I don't know what it is. I have to look it up. Maybe. I don't want to lie to you. It could be VV. Vanguard large cap ETF VV maybe? I don't know. I've seen all these arguments before. I've seen all of these arguments before. I refuse. No, a taco is corn, fried corn folded over. That's what it is. Gus says my dog's name is Taco. El Doge says Google doesn't count. It ain't Mexican either. I'm living to it. I'm living with the lie. It is that's what it is. I'm not changing my mind. You're not going to convince me. Janice says, Goonie, at this rate, we're going to see 3 trillion reverse repo in no time. I'm kind of excited. Is Taco a ticker? No, not that I'm aware of. Maybe it is. I don't know. Let's see. It is Del Taco. Oh man, how did Del Taco beat out Taco Bell for the ticker? Does Taco Bell have a ticker? I don't even know. No, it's got to be under. They're a group chain, and I can't think of what it's called. Del Taco gets it though. Not bad food there. We're in America, Anthony. I hate to break it to you, but we're technically in America talking about American food. So yes. Stone says it's IWF, IWD, and IWB. I think it's going to be IWB because IWM is what we're currently in. But you're correct though. There are I think there's also an IWN if I'm not mistaken as well. But there are IWF, IWB. I'm not sure which one though. I really don't know the answer. I think it's going to be IWB, but I don't know for sure. It could be IWF. That's correct. We are in IWM currently. There's a great website for that, Stone 23. It's called ETF.com. You can go there, you can pull that up, and it actually show you. And I'm actually planning on using that site when it comes time to figure out what the rebalancing looks like. But I'm going to use ETF.com. I don't know what the reporting time frame is on this website. But you can just go there and you can type in like AMC, right? Just hit enter on it, and then it'll tell you right here. You can just go to 73 ETFs with AMC Entertainment Holdings Incorporated Class A. Click on that, and it'll tell you. Oh, son of a gun! Clicked on the wrong one. It'll tell you a lot of information that's really kind of cool. Like 73 ETFs hold AMC. 40.4 million AMC shares are in ETFs. There you go. There's the number that we're going to write down right now. Hold on a second. 40.4 million, because this is going to change. The biggest holder is IWM. Largest allocation of shares is in meme. But we're going to see how much the ETFs change by. And I would imagine that if we move down into the bottom third from a top third position, we'll probably see that number cut in maybe a 2/3. So maybe there's going to be about 30 million shares that hit the market. Maybe. I don't know. Maybe 25, 25, 30. I'm guesstimating. I really don't know the answer. But there's some other cool facts too that are below. You can look at like ETFs with the most AMC exposure, top performing ETFs with AMC, ETFs with the most AMC shares, top ETF strategies. But IWM, like you said, 11.3 million shares that are in IWM, which is BlackRock's. Oh, you know what? IWN is. Oh, my bad. IWN is a mid cap. It is their 2000. It's another 2000 of theirs. I thought that one was the 1K. Oh well. IWF, and B, I guess, are the other two that are the 1K. VO is Vanguard's mid cap. I don't know what their large cap is. I think I just looked it up and it was VV. But you can see we have much smaller holdings in Vanguard than we do in BlackRock's. So, but it's a great website. If you wanted to just type in GME, you can do the same thing. And then just go, there's 102 ETFs with GameStop in it. You can do the same thing with that. You can see that their biggest holder is IJH. Oh. I don't know why they call it a mid cap, but it should be a 1K on this one. It should be a large cap. I don't know why these are saying mid caps on these. I don't know. But it used to be that GME was also in IWM as well. These very well could be the ones that we transfer over to. I don't know. Kolb said, I thought they were about to start tightening down on reverse repo. Yeah, like last year. You're right. They did say they were going to start tightening down. You're not wrong. Well, we didn't quite get down all the way down here, guys. We fell down to 1144 is the lowest price we got to. We did break out bullish out of this descending parallel channel here. And we are still moving upwards. Didn't quite make it down to my box. Almost. Not quite. Getting the breakout here right around 1427. It's time to go make my drink to do our afternoon toast. So let me go. Yum. I think it is Yum or something like that. It's something like that, Tyler. I want to say it is Yum. Yum brand. Like if you look it up, if you look up the ticker, I think you're right on that one, Tyler. I'm not 100% positive, but I do think that you're right on that Yum. And There's some very interesting stuff. If you, I don't want to, I don't, like I say, I don't really talk about other stock tickers, but there are some interesting things to note about Yum. If you take a look at the average volume on the average 3-month volume per the amount of free float that it has, it is almost one of those gold standard stocks that you can look at because it is not heavily shorted at all. All right, guys, I'll be right back. Give me just a couple minutes here to mix up a drink, hit the restroom real quick, and decide what I'm going to toast on for the day today. It's not just Sub has a boss. It's not just IWM. It's a lot of different ones. But 40 point, that is a number to track down, which I've got noted in all of the ETFs. All right, I'll be right back, guys. Give me just a few minutes. I'm going to try and read through the rest of here. You're welcome, Stone23. Schwab showing margin requirement of 200% for shorting AMC. That's awesome. I don't know. We'll see, MG Toe. We'll see tomorrow, because tomorrow is the final date that they have until to switch. Congratulations, Jenna, on the new shares. David says, hello, Casey. How do you explain the AMC 24 billion buy volume on the yearly candle, given that there's only 516 million shares issued by AMC? Thanks. Synthetic volume, David. It's the only explanation. There really is no other explanation than that. The amount of shares that would have to be traded to get 24 billion, considering, I mean, look, it's you know the answer. You know the answer, David. It stinks to high hell. It stinks to high hell. The only way that you have high percentages of your float traded like that, there's only two things that causes that to happen. One, stock price is absolutely dropping through the floor and the company is about ready to go bankrupt, and everybody is selling their positions. And so you would see that in OBV where everything is just dropping, right? That's the only way you would see something like that. Or two, the only other way is synthetic shares being traded, heavily traded, and price movement should relatively not be doing a whole lot. You know, there's just a whole bunch of shorting going on. It's synthetic movement. And you're nailing it on the head. All right, be right back, guys. Okay. So first off, I'm going to toast to my son. I know it's kind of a selfish toast, but and I'm actually going to toast to two people actually. Now that I just thought about it, just to make myself feel a little less selfish. To Jana's mother, to her health, and may she recover quickly. But I'm also going to toast to my son, who just had his wisdom teeth removed, and he's in a lot of pain. So to both of them and their quick recovery, cheers. Hopefully Jana got to hear that. Alrighty. By the way, I just finished off that Dwayne Johnson's alcohol, or Dwayne Johnson's alcohol. His tequila. I used his tequila. I bought a bottle of Dwayne Johnson tequila, and I just finished it off. I will probably never buy another one again. It's all right. It's not bad, but it's not great for mixing up one of these adventurous ape drinks. Which, by the way, guys, for those of you who are new and don't know what that is, a while back, I ran out of beer, so we looked up, or I looked up something to mix up that I had in the pantry, and I had Kahlua. I had a couple different things, but I had Kahlua and tequila, and apparently 2 shots of tequila and 1 shot of Kahlua, and it's called a brave bull. And I was like, well, that's kind of what we are. We're a bunch of brave bulls around here, except we call ourselves apes. So we renamed the drink to an adventurous ape, and that's where I'm drinking. So cheers again, Molotov, whatever you want to call it. It's not Molotov. Molotov. I don't know what it is. Cheers. Big Tramp, we're in the squeeze. We need a big volume day to really kind of push us into what I would say is the bang. Mazel tov. Thank you. I said Molotov. Yeah, it's an alcoholic drink if you don't light it. Same difference. Now it makes me wonder. Is there some kind of correlation? Thank you for the suggestion, El Doge. I will look into that. Can I buy it at Costco? Well, doesn't matter if I can or not. I'm writing it down anyways. All right, one more look at the numbers, guys, before we end out this day here. Two-factor authentication might save you one day. Oh, it's not happening anymore. Okay. I just managed to avoid two-factor authentication on Fidelity. It looks like they may have changed it now to where you can do it every hour again. All right. Take you guys over to the other page here. While I do that, let me move over a couple of screens and we'll take a look at what's going on. This alcohol is going to hit hard. It's going to hit super hard with no, like, a breakfast taco and that's it. I'm gonna start slurring my words here in a minute. Just give me a few minutes here. Let's see if I can get through this. Off exchange, 46.75 as of an hour ago, and the EDGX was at 11.53. Let's give that a refresh. 47.49 and 11.59, giving us 50. Wait, is that right? Hold up a second. Hold on. Yeah, that's right. 59.08. That's pretty low. It's higher than it was an hour ago, so they're definitely suppressing more price discovery through the off exchange than they were an hour ago. but still lower than our normal averages on a daily average. Taking a look at Hortex, as of an hour ago, there was 199,000 shares that have been borrowed. Now reporting 149. That's going to slightly dip down that estimated current share interest of the free float to 22.57%. Cost to borrow at 23.51. Haven't seen it that high in a while. Cost to borrow max is at 34.08. Those numbers are very, very high. For those of you just joining, where the hell have you been all day? Just kidding. Shares on loan, we're currently at 192.19. That's about 1.2 million less than it was yesterday. Just throwing that out there. I think I'm funny. That's all that matters, right? Sometimes. Let's see here. At a $13 strike price, an hour ago there was, oh, hey, look at that. It's actually risen. So 12.5 strike was our highest amount of volume an hour ago with 18.4 thousand contracts. 13 is now our high with 21.5. And at a $12 strike price, the highest amount of volume that we had for puts was 8.6 thousand contracts, is now 8.8. The market's, believe it or not, it's signaling for a 12.5, somewhere around $12.5 close, which, I mean, I'm not seeing it, but whatever. According to Fidelity, AMC is the 10th most heavily traded stock with a 82% buy to 18% sell ratio, which is amazing. Perhaps one of the highest numbers if it hadn't been for Hackshire Berthaway. GME still in 29th with a 58% buy to 42% sell ratio. Fidelity is still strong. Fidelity. AMC is what I meant to say. I don't know why I said Fidelity. See, the alcohol's hitting. SSR 1134 would have been the trigger price for the day today had we triggered it, but we did not. No new shares have been borrowed. Oh, nope. They did borrow about 40,000 shares. So I'm going to call it 400,000 shares according to Sonko Tracker borrowed for the day today. It's a little bit more than that. It's about 425,000. Actually, I'll just go ahead and put 425. Fees 17.2%. 129.3 thousand contracts are out of the money on the calls versus 3.2 thousand contracts that are in the money. 26.6 thousand contracts are out of the money on the puts versus 17.2 thousand contracts that are in the money. Market's currently up at 1.17 for the NASDAQ. Dow Jones is up 0.26 and the S&P 500 up 0.57. We currently have 3,850 advancers to 3,099 decliners. The VIX is up 1.52. IWM is up 0.68. Tesla is down 1%. Amazon is up 2.72. Cinemark is down 1.52. Doge is up 2.12. Bitcoin is up 3.62. GME is up 1.35. Hycroft is HYMC is down 7.52. Hood is up 4.54. NCMI is down 5.8 and AMC is down 7.62%. Do realize that very oftentimes our closing price for the day has a big factor into what synthetic or a SSR trigger point would be for the next day. If you were to do a synthetic price failure at 1057 and add 10% to 1057, the price would be 1162. our closing price may be really damn close to 1162 today. Just keep that in mind. That means that they're probably going to shoot for synthetic price failure for tomorrow and SSR. Just keep that in mind. And what that means to us is that we could be seeing up to another 10% downwards movement in price. Drone, I have my information. I can see what it is you guys are writing again now. Oh, wait, I did that too early. Son of a biscuit. Wait, hold on, I'm not done yet here, Drone. I can see what you wrote, but I wasn't done. Alcohol's kicking in. Feels good. Let's see here. What do we got going on? Inflow versus outflow for the day-to-day. We've got $7 million more in inflow than outflow. 30.53 million shares having been traded so far. What kind of pace are we on? We're on pace for about 33.5 million shares traded. Thick says, yeah, blame it on that call. 33.5 thousand shares traded for the day today is what we're on pace for. I said in pre-market it would be somewhere between 20 and 40. We're hitting almost smack dab in the middle. On the weekly, we have more buying pressure than selling pressure with an RSI of 36.81, which is below average. On the daily, we have equal amounts of buying and selling pressure with an RSI of 43.78, which is below average. On the hourly, we have more buying pressure than selling pressure with an RSI of 30.75, which is below average. On a 30-minute interval, we have more buying pressure than selling pressure with an RSI of 24.53, which is signaling for oversold. And on a 5-minute interval, way more buying pressure than selling pressure with an RSI of 51.27, which is average. Ugh. This alcohol is hitting hard without food in my stomach. Now I can see what you guys are writing. Yeah, Drone, you can contact me. My information's on the bottom left-hand side for Reddit and Twitter. At AMKC Shaw on Twitter and Cold Steel user or / Cold Steel _BOP. And you may have actually contacted me already, and I may have not gotten back to you right away. I normally try to, but yesterday, I don't know. Maybe I just didn't get a chance to get back to you. El Doge says, I just noticed your camera and you look just as I imagine. What? Santa Claus? You rock, brother. I have not a barba. I'm not sure what that was supposed to be. You rock. I don't rock. You rock. No thoughts on FDX, and I usually don't accept random shoutouts of stock tickers. That's my only rule on this channel. It's going to, yes, Jack Wolf, this drink is going to zero. I am definitely draining it all. What does that mean, drone? They found wood from the sunken pirate ship washed up in a cave this year. I thought that was all edited in. I had no idea. That's interesting. I'm reading everything it is that you wrote here. I had no idea that was actually true. But I would assume the beeswax would have something to do with maybe like. Actually, I have no idea. What, candles? I don't know. I used to live in Oregon. I'm laughing at Yo's comment. There's a quote from Bernie Mac. $12.50 is the max paying today, Savvy. Janice says I'm shorting the adventurous ape. You should be. It's gonna be gone. Hayden says rule number 2 should be no Raiders talk. Is that because I'm wearing a Kansas City hat? I'm curious. Yeah, I just saw that conversation come through on Reddit here. I just got that notification. So if you try to contact me through Reddit, I just saw it. So I'll try to get back to you. Savvy says I was really looking forward to the Massalorian live stream last night, but AMC discussion was off the table. What? Really? John is saying so you can maintain database with Pine. Are you asking how do you maintain a database? Oh, I know what you're doing. I know what link you're referring to, John. Uh, that's a good question. It's a very good question. That's actually the very first time that I was trying to get an IT guy to work on this for me. On building that indicator, he was like, "Well, it looks like we need access to the database." The problem is you gotta have access to the database, which requires you to have a subscription. Oh, my bad, guys. I should be on now. Yeah, I publicly want to state that I have no beef with Raider Nation either. Please don't stab me or shoot me. Yo's the smart one here. They only wanted to talk GME. Really? I'm sure there was something behind that. My mom says, I see you now. Here I am. Yay! A link. A link. I can give you a link. I think I know. I mean, in reference to Pine Basics, give me just a second. Give me just a second. Where did I have that conversation at? Pretty sure it was here. Yeah. That's one of the links. I think the other one, um, yeah, that's one of the links. I was actually talking to somebody last night about that. We were kind of looking at it a little bit before, and yeah, it sucks if you don't have they force you to have a subscription to be able to edit Pine. I mean, actually, you can do it on your own. That's not true. I mean, you can do it on your own, but you have to have a subscription to be able to have access to the database. So it kind of reduces your ability to be able to do things. Limitations on Pine. Can you draw numbers on many tickers simultaneously? You can draw multiple tickers on. If you have a subscription, you can draw multiple tickers on TradingView. Yes. John, I want to stress, I am not here to try and suggest people should get subscriptions to TradingView. I'm not a monetized channel. I don't get anything from recommending things to you guys. I've just recently purchased a subscription to TradingView. I've done nothing but a free account on TradingView for as long as I can remember until like this last month. So please don't feel like you need to get a subscription on my behalf. Please do not do that. I am not here to sell you guys things at all. There's no reason if you're just wanting to just use it regularly, you don't need to buy anything. I think drone. I think that the Bollinger Bands, which I show quite often here on Weeble, I think the Bollinger Bands would probably have the scripting that would be required to show zones. Because really what you're looking for is you're looking for a 5% change, 5%, 10% change, sometimes 20% change during certain periods of time. And Bollinger Bands are essentially looking at a range of data and then providing or spitting back a desired output. And I think that Bollinger Bands would probably be, very, very close to the scripting that you would need to mimic the indicator that I'm looking to draw up, which is those percentage zones for when a stock's going to trip market halts. Boy, this is so much more difficult talking with 3 shots in you and no food. The Big Tramp says, "Sell me your Big Tramp." I don't even have one yet, man. I gotta sell my own. Guys, I want to show this one more time today. First off, I didn't find this Big Tramp. Thick did. Thick found the Big Tramp. Somebody else modified the Big Tramp to be able to put me inside the window, and then Bjork added the cool pinstriping, and I can't say who the other middle person was because they asked not to, but Bjork was the one who set me up with a cool design on the side that says Lowrider. Wait, what does it say? Yeah, Lowrider Big Tramp on it. and made it a lowrider, legit a lowrider, which is so cool. And the license plate says Casey Shaw, so I mean it's legit. It looks cool. I like it. But I'm just gonna throw this out there that Brian Carpenter put this together in the and submitted this in the Discord under memes and funnies. I got to show this one more time today because I mean this just like made me so happy. I can't even begin to describe to you guys like the joy I had from seeing this fan art, superb fan art here. This, I'm not trying to get other people to do this kind of stuff, but legit, I'm gonna copy. Provide. He actually gave me permission to do it already, but this picture is gonna go on the big tramp. You got Butthead over here saying, oh, "Cool," and then you got Beavis over here going, "Yeah, yeah," and I'm over here going 2 weeks. And it's got the Casey hat and AMC T-shirt on. I was laughing so hard. I couldn't. And of course, he drew this up. You can tell he did this. I'm wondering if this in the background, because if you ever send me a picture, I do this kind of stuff all the time. But I'm sitting here wondering in the background if this terrible arrow that I just drew is pointing at a picture that he actually painted, which I'll never know the answer to unless I actually ask. So I should probably ask. But that if he did that, I wish I had half this talent. I wish I had this talent right here. I would trade my music talent for drawing talent, even if it was just this good. I would trade it in a heartbeat. I think it's so cool. Thank you, Brian. I appreciate it, man. I don't know what to say. Loss of words. I was at a loss of words when I got the big tramp too. So I'll tell you what, I'll sell it to you after I use it for a while. Big tramp. Captain says, I think I figured out why Ken is going to Florida. Turns out his mom is so loose. I can't read that. Oh, man. I'm trying to read through what you guys are saying here. What did El Doge say? I missed it. What did he say? Everyone here, can you guys put me in your prayers? I'm going through depression. I'm having one of those episodes. Yeah, man, absolutely. I don't know, man. I don't know what to tell you. We've all had our moments. It's tough. I don't know. Reach out to me. And we can talk. Maybe I can help. I don't know. Maybe in some way or another, I can be able to help you to feel more confident about what's going on in your life. Who knows? Reach out. I'm just reading through some of the other messages. ABC says, Casey, you should add our names to the lowrider like decals. But that would make me feel like I'm winning people over, and I'm not here to win people over. But you know what? We'll do something. I know I understand what it is you're saying, and I do want to do something like that, some kind of recognition of everybody that's here. Captain says, don't trade off your music talent. Come up with an AMC Ape jingle and make it your big tramp horn sound. That's not a bad idea. That's not a bad idea. I like that. Yeah, I'm gonna have to ask Massalorian what that was all about, Savvy. I'm kind of curious. You know, actually, I'll tell you what, El Doge. I'm gonna read you a quote. I'm gonna read you a quote from something real quick here. Don't ask me where the quote comes from, please. But let's live life in the moment and not worry about what tomorrow's fears await us as there are thieves in the bushes. We will be ready and we will have lived. Live your life, man. Go out, do stuff. Do not just get stuck watching stock tickers all day long. You don't have to do that. Continue to live life to the fullest every moment that you have. Ah, see, Joseph Lee's making it make a little more sense. So Massalorian had a GME segment with a GME investor guest. That makes a lot of sense. That actually makes a lot of sense why he would do that. John, you got to send them through Twitter or you can send them through Reddit. I have the contact info for those accounts on the bottom left-hand side of the screen. Yucca Frida, I told you don't look it up. I made it up, man. It's my quote. I made it up last night. That is a Casey Shaw original quote. But it kind of takes from like a lot of different quotes. I mean, if you think about it, there's little bits and pieces in there that you probably could pick out that probably come from a lot of different quotes. I mean, I didn't sit there and like take the time to look a bunch of quotes together and kind of mix and match them all together. But I feel like when I say it, I feel like it comes from different things that I've heard in my lifetime, whether it be from the Bible or whether it be from some book that I read somewhere, whether it be from a song. I have no idea, but I feel like it rings true. Marantz rants as a special guest. He's huge in a Trump voice, Jimmy supporter. So last night, yeah, all right. So that makes a lot more sense now. Why he was doing just a Jimmy segment. I mean, if you're gonna have somebody on your stream to talk about something specifically, you try to keep it related to that, which I understand. I did no such thing, Björk. Hey, Björk, come on now. You know me better than that. You can't go there. You know I specifically said no such thing. No, 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 no. I'll tell you what though. Let me show you guys a little something real quick here. I don't know if you guys can see this or not in the video. I know it's pretty small, but I'm trying to make it big. Oh, you see my logo. Oh, it's backwards. I've got the video screen switched so I look like I'm looking out the front of the car. But you know the logo that's in the bottom left-hand side there. One of my moderators sent me a special gift of 3 mugs with my logo on it. And guess what Adam Aaron's getting tomorrow night when we go to see him at the movie? He is going to be getting an official AMC KC mug. They are not for sale. Absolutely not for sale. They are limited. There's 3 in existence, and that's by my own doing. That's all there will ever be. And Adam Aaron's going to have one of them. I have one of them. Eventually, I'm going to give the 3rd one away to somebody here. And I haven't decided how yet. But you won't get to pay for it. You're just going to get it. I've been thinking long and hard about it, how I would hand that out. It's kind of in the back of my mind. Yucca Frida says, "Can I bootleg the mug?" Hey, everything is free here. You guys have free access to this. You guys are as much of a part of this as I am. Everything that I do for you guys is for free. There is no, I don't own anything here. This is us. You're as much a part of it as I am. But don't go out there trying to make people pay for something with my logo on it. Don't you dare do that. I'll get pissed. Excuse me for 1 second, guys. I'll be right back. Juanito, I came back and I saw the first thing that you said was, please don't ever do super chats. You don't have to worry about it, man. We're good. No super chats. I am not monetized. I don't have any plans on being monetized. And all of my moderators, except for some of the new ones, know that they're supposed to hold me accountable. You know, AMC Panda, it's not. It's just like the logo on the left-hand side of the screen. It would be cool if it had the van on it too, but no, there's no van though. This is true, Jeff. He did move his, or at least it's been announced that he's moving his headquarters to Miami. Cat Scat, you're welcome. Not yet, Yucca Frida, but I can almost guarantee you that it's on the list. I mean, I can't imagine driving around in anything else. Guys, the the market options were suggesting that we would close somewhere between 12 and 12.50 today. And look at this last minute run to break up above $12 here. We've got to break past this line of resistance at 11.97, but my goodness, what a drive. What a drive we're making here at the very end. Yep, not going to happen, El Doge. The way I figure it is that we're all in this together. I'm going to make plenty of money off of this play. There's no reason that I need to make money off you two. You're already making my money. Like, in the end, you guys legitimately holding this is going to help make me money. Me holding this is going to help you make money. We're in this together as a community. We're doing this together. I don't need your money. We're gonna be fine after this is over. I'm not worried about it. Who was Jana? You were shorting this drink, weren't you? It's almost bankrupt. I'm almost gone. I think I'll finish it before the end of the show, end of the day. Yeah, I don't think so, KL. I don't think so. It'd be cool to think that that was the case, but $12 I think was kind of in the cards for probably most of the day anyways. That adventurous ape is gone. I finished it with just a few minutes to spare. Thank you, Vado. You're awesome. Alrighty, guys. It's that time of the day. And you know what that means. I know it's like bittersweet every single day. It is. It's bittersweet for me. I know it's bittersweet for you. But it is that time of the day. Eat, sleep, drink, get plenty of rest, because tomorrow's our last day, and it's the day where we switch from the Russell 2K to the 1K. Spend time with your family, spend time with your friends, spend time with your pets. Go out and do something, for crying out loud. Watch a movie. Take somebody to a movie. I don't know. Do something, though. But above all else, don't have a good night. Have a great night. I almost forgot. I almost forgot.
T-minus 90 seconds and counting. All systems are go. We're about 90 seconds from the launch of Space Shuttle Discovery. T-minus 60 seconds and counting. We are transferring to orbiter internal power at this time. Discovery is now running off its 3 onboard fuel cells. Coming up on a go for auto sequence start. And we have a go for auto sequence start. Discovery's onboard computers have primary control of all the vehicle's critical functions. T-minus 17 seconds and counting. 15, 12, 11, 10, 9, 8, 7, 6, start, 2, 1, booster ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
Separation confirmed. Guidance now converging. Discovery's onboard computers commanding the main engine nozzles to swivel, aiming the shuttle for its precise target in space for main engine cutoff. Should have a good forward leg now at
Okay, you sound good.
Discovery Houston, negative return.
Copy, a negative return.
Twenty, 20, 20.